9 o'clock here in New York City on this Wednesday, February 10th, 2021. Welcome to Yahoo Finance Live. I am Miles Upton, joined, as always, by Julie Hyman and Brian Sozzi. Let's take a look at futures this morning. We are seeing at the open, the Dow, S&P, and Nasdaq futures all up just about 0.5% as the market kind of collects itself after a little bit of a rough patch, which coincided with all of the meme stock action, which certainly has cooled down a bit in the last couple of weeks. Now looking at markets again, kind of continuing that orderly climb higher that we saw at the end of 2020 and at the very beginning of this year. Let's also take a look at Bitcoin this morning. Certainly a lot of focus on the digital currency this week. Monday morning's news that Tesla had purchased about $1.5 billion worth of Bitcoin, sending the cryptocurrency up above 48,000. Right now, 45,650. And it's interesting, we saw Bitcoin go up to a record just ahead of kind of all the meme madness. And then we sort of forgot about what was happening in crypto land for a little bit. But that rally, again, kind of consolidated and, like the broader market, has now continued its climb higher. But we begin this morning with earnings as fourth quarter earnings season continues to roll along. It's been a very busy last 18 hours. We have another busy session after the close today. And since we saw markets close on Tuesday afternoon, names like Lyft, Twitter, GM, Under Armour, Coke have all come out with their quarterly results. Let's start this morning with General Motors, what they said in their latest quarterly update. Brian Sozzi, I know this is a company you follow quite closely. And as we can see here, beating on the top and the bottom lines.
Yeah, still a proud 91 Pontiac owner, Miles. But yes, big earnings beat out of General Motors this morning. I hopped on a media call this morning with CEO Mary Barra and new CFO Paul Jacobson. And as you can imagine, lots of focus, at least in the media world, and I suspect by analysts soon on the call, about the chip shortage. GM called out a close to $2 billion hit this year because of the chip shortage that is now rippling across the auto industry. Barra saying that they do not expect any delays in their truck production, so that was a good positive thing. Now, I actually asked CFO Paul Jacobson about the losses in the Cruise division. Remember, this is division that just signed a pretty big deal with Microsoft. Those two are tag teaming to develop autonomous cars, electric cars, et cetera. That business lost $900 billion on an operating basis last year. Jacobson telling me that loss will probably be the same this year. So that segment continues to bleed a lot of money. But again, all focus right now for GM on the chip supply shortage.
You know, and Brian, on that point, I want to bring up that, yes, it is something that's affecting the whole industry, but there's one example that shows it's not inevitable, the negative effect. And that example is Toyota, because Toyota also came out with numbers. Toyota says it's not worried about chips. Why? Because it has a stockpile of chips. It somehow maybe saw this coming or just wanted to guard against the possibility that it would happen. And Toyota now has a 4-month stockpile of chips. When it reported its earnings, also early, I guess overnight, you could say, and those are the comments it made. It also raised its full year earnings forecast by 54%. So I haven't seen, I don't think, any of the other automakers that has made this kind of a move that Toyota has made to do this stockpiling. But it is quite interesting that they were prescient enough, were lucky enough to make this move. And so you have to wonder then how that is going to affect Toyota's sales. If you go to a dealership and you can't get a GM, are you going to go across the street to the Toyota because their comparable model is in stock? I guess we'll have to see how that plays out over the coming months.
Yeah, and it's a season where we're talking about a lot of companies that actually make cars. So it is worth discussing the chip shortage on that end. But we've also talked to a lot of EV SPACs that don't make cars but claim they're going to make
or anything.
Yeah, exactly. Oh, I think we have a Miles freezing problem. Oh, there he is. He's back.
All right. This has just been, I don't know, maybe I need to refresh my computer because it probably hasn't been turned off in about 5 weeks. But anyway, just saying, EV SPACs, they probably have a chip problem as well. And they don't even make cars, but apparently they're going to make hundreds of millions of dollars in profits in like 3 years, because those are the investor docs say, and that's what they come on here and tell us. So we'll see how that all plays out. Another company on the move, big move higher this morning, Lyft, Brian Sozzi, double-digit percentage move here, pulling forward its profitability target by a full quarter.
Yeah, I suspect a lot of investors will wake up this morning and they're watching, wow, what in the world is going on with Lyft? They missed their active riders, 12.6 million active rides. The street was at about 13.3 million, so they missed there, and they lost a lot of money. I think this comes back down to optics. And I caught up with Lyft's co-founder and president John Zimmer last night after earnings. He said they're like a coiled spring, and he still views the company very much as a recovery trade. Now, they're not seeing this. Let's be clear. They're not seeing this happen yet. In January, rides were down 51%. That is a worsening rate than they saw in the fourth quarter. But I think where the street is really liking the Lyft story right now is they continue to be a very good manager of costs. They cut out over $300 million in costs in the fourth quarter. And my sense from listening to the call last night, they have more costs to go. And they did tease that they might be able to drive profits in the third quarter. They originally were looking for the fourth quarter, but they called out that could happen in the third quarter if rides start to recover. A lot of ifs there, but at least those are this is how the street's reading it right now.
Yeah, and also an interesting comment from the company's CEO on the call, talking about the view that he believes, and this is based on other people's work, but stating specifically that he expects the U.S. to reach what he called critical immunity levels earlier than expected. And we all sit here and wait for our turn to get a dose of the vaccine, and certainly hope that he ends up being right on that front. Another company on the move this morning with its latest results, Brian Salzy, Coca-Cola shares are up about 2% here, following what we can see here was a beat on the bottom line, but a little bit of a miss on the top line.
Yeah, this wasn't a good quarter. And I think but why you're not seeing the stock go up, really go down because of it, Coke is coming out and actually providing a 2021 outlook, and they see earnings per share up high single digits to low double digits. And you're seeing now the effects of really Coca-Cola dropping the hammer at their corporate headquarters and many other parts of the division, sacking a lot of people. And when you sack really well-paid executives, you're going to get an earnings per share boost. And that flow through, as the street likes to call it, that is starting to happen now. Important, I think perhaps more important, though, than those cost cuts is what they called out for February, guys. Cardboard cutouts in sports stadiums don't buy soda. And to that end, they're still seeing volumes down in February, global volumes down mid-single digits. So it remains a very challenging time for them because they still operate not only in the sports stadiums with the fountains, also the restaurants.
And just one more thing to mention for Coke that we have to watch going forward. There's a tax dispute that it has with the IRS, and it has said its liability tied to that could be as much as $12 billion, although at the same time it says it's confident it's not going to have to pay that full liability as this dispute is ongoing. I believe they've already had to pay just under $3.5 billion tied to this dispute as their tax rate might be going up. So that's just a more minor, non-sort of fundamental item to keep an eye on for Coke investors.
Yeah, and certainly I think an interesting business given a lot of the health trends. That was a pre-pandemic story with Coke, is how they remake that portfolio away from obviously the company or the product that bears the company's name, and certainly where they go from there on that side of the business. All right, another stock on the move this morning following its results out last night. That is Twitter. Stock is up almost 9% in pre-market trading here with the company coming out last night. Slight miss on the monthly daily active user number that saw the stock down a little bit in the initial reaction last night. But we see here a beat on the top and the bottom line. Stock is higher here as we get today's session underway. Joining us now to talk more about Twitter's latest quarter is Jason Helfstein. He's a managing director and an analyst over at Oppenheimer covering the internet sector. Jason, thanks so much for joining us this morning. I'd love to just start with your thoughts on Twitter's quarter and sort of where you see or how you see momentum building within the business, one that I think investors for a long time have been waiting for, maybe some quarters like this to get strung together.
Sure. Thanks for having me. So, it's well known that the digital ad market is recovering, right? This is kind of the last of the bigger platforms to report. So the fact that they saw an acceleration in business from 28% to 28% from 14% in the third quarter for revenue growth. I don't think that was surprising. I think really the tone here is that a lot of the product changes that they last quarter threw cold water on, particularly their map ad targeting product, they've now said is fixed and ready to go, and they formally relaunched that on February 8th, so just a few days ago. And they said that even in the fourth quarter when they wasn't fully going, that map product was at 50% year over year. So I think investors, while they were so negative on kind of product delays and kind of why can't you just, kind of move the ship forward, or are now much more upbeat on what the company can do from a product standpoint from here?
Outside of the fundamental business, sorry to take a bit of a left turn here, Jason, but on the call, Dorsey was asked about Bitcoin, which I think a lot of companies, particularly tech companies, are going to get questions about following Tesla's move, and also because Dorsey has talked about Bitcoin in the past. And he said, it's something that we would look at, right? Do you think Twitter should buy Bitcoin?
I don't think it was that. I think it was talking about like blockchain and the idea of centralized versus decentralized, right? So the idea of, part of the social media platforms have gotten to a point where the discussion of like, who should decide what the conversation is? Are social media platforms editors, or are they just distribution platforms? And that's the whole Section 230, which is probably a whole other interview. But the idea of how can you decentralize information so that the users are the ones deciding whether my post is appropriate, and as opposed to some editor sitting in Twitter's office or in Facebook's office, right? Or the algorithm, because somebody does have to write the algorithm. So I think it's just that was the gist of the question. I mean, obviously Dorsey runs Square. They're probably the Bitcoin questions are much more for them. But I think it's just the idea of like, where are we going from here on who is the editor of the conversation? And I think, Dorsey would like to empower the masses to find a way to, using technology, to effectively edit themselves.
Jason, just switching gears slightly. So they talked a little bit on the call last night about their subscription product. To me, it didn't sound like it's going to be a large type of product, or they're not going to put the whole site behind a paywall, and that might come, some form of subscription product might come next year. Are you disappointed by what they had to say on that, and how big do you think that business could be for them?
They do have an analyst day coming up, and I think they're purposely saving details on that for the analyst call. So, look, I think a lot of us, especially you all in the media business, we're all trying to figure out what is the future of digital media, digital journalism, and I think there's this building idea of like the freemium model, right? Which is, you get the first paragraph for free, but if you want, the meat of the story of the article, you have to pay. Okay, and a lot of different models have emerged that way. And Twitter is in such a great place to help be a distribution monetization platforms like that, because while Twitter is, much smaller than the other social media platforms, the users of Twitter tend to be much more engaged on a news side, right? People are going to Twitter for news, whereas I'd really argue like people are not going for Instagram for news. They're not going to Snapchat for news. They might consume news while they're there, but that's not the main reason. So, look, I think they're really well positioned. I think they purposely didn't really want to, steal the thunder for their upcoming analyst day. So I think it was kind of just their way to say we'll talk about it later. But I do think you will get some formal product announcement. I think they use this call much more to talk about what's going on with fleets and stories and some of the other things that are driving engagement. Because really, if you look at this company, right, in the U.S., they have 37 million, MDAUs. Snapchat has 92 and Facebook is 195. So, and that's just the U.S., right? So this company, from a product standpoint, has a long way to go, to the extent that most people should care about content on Twitter.
And, Jason, related to that question about, and you brought up that Analyst Day is an event they haven't had in 7 years. The product cadence has certainly picked up with fleets. Spaces is getting rolled out. They acquired Review. I guess that was 1 or 2 weeks ago. How much is that, in your view, Elliott's involvement here, and how encouraged do you think some investors are by having an activist in the company that is forcing them to maybe change some of the malaise I think some folks thought had maybe set in there over the last couple of years?
Yeah, it's very hard to know, right? I mean, it probably, I don't think you could say it has no impact. Is it the entire driver? I mean, look, at the end of the day, the people of this company, you'd imagine, want to succeed and be their best. And, look, they bought back $250 million of shares in the quarter out of a $2 billion authorization. Relatively small, but moving in the right direction. Again, they're having the analyst day. Maybe maybe they wouldn't have had an analyst day. Maybe all these products would happen, and Dorsey would kind of just let them come out as they come out, as opposed to in an analyst day you have a lot of pressure to kind of preview the future, right? And some companies don't like doing that. What if the product isn't ready on time, right? You don't want to rush out product that's not ready. I mean, we've seen that happen probably at Twitter sometimes and other tech companies. So it's very hard to say, but it probably has had some positive impact. And also, look, I mean, Dorsey did agree to kind of this annual review, of him, and I don't think that he would have agreed to that if it wasn't for the activists.
Jason, real quick before we let you go, thinking about the other companies in your coverage area, you cover Uber, Amazon, Netflix, among others. Is there any company that's quite like Twitter where it's modestly sized, but everyone has a take on it. Everyone is on it all the time. Everyone's obsessed with the company. And yet I think its relative import in the market is probably maybe a little bit less than how much you and I certainly talk about it or think about it, spend time on it, and so forth.
Yeah, I mean, I think you go back to the numbers. So I think because you're in the media, you think everybody's on it. The reality is there's only 37 million people who are kind of captured in that active daily. Those are logged in active daily users. So again, versus Snapchat's 92, which only has historically like younger people, and Facebook's 195. So I think the whole point is that while those of us who are in finance or media, sports people tend to be aggressive users of Twitter, the mainstream population does not use Twitter on a regular basis with a logged in account. And that is the opportunity for this company by improving the product and making it easier to use.
Yeah, I'm not sure we all do our part in making it a fun place to hang out, but it is certainly one that we have not managed to quit at this point. All right, Jason Helfstein, Managing Director over at Oppenheimer. Jason, really appreciate you taking some time to talk with us this morning.
Thank you.
All right, we're off for a short break. On the other side, Brian Chung joins us for a quick talk about where Jay Powell is at, latest comments expected from the Fed chair, and where we stand on the economic recovery. We're back with that in just 2 minutes.
There is a big debate among economists and market participants right now about whether inflation is happening and is going to happen as we recover from the pandemic. Those who say it's not going to happen got some evidence to support that assertion this morning, with the consumer price index coming in unchanged at the core level in January. Our Brian Chung tracks this kind of data for us. So looks like for now, still pretty tame.
Yeah, still pretty tame. At least that's what the consumer price index from the Bureau of Labor Statistics is showing. We saw that the increase was just 0.3% in January. That's a year over year change of 1.4%. You could see the chart in front of you. This means that the year over year changes in the CPI index have been falling quite below the Federal Reserve's 2% inflation target. This is what you're looking at here, of total headline CPI, but even when you strip out the food and kind of more volatile energy components of this index, it's still just 1.4%. And obviously, within the context of what the Fed is trying to do, they want to overshoot 2%, but not even on the CPI. Keep in mind that their preferred measure of inflation is core personal consumption expenditures. Core CPI already tends to overstate their preferred measurement. So if you really kind of subtract the usual let's say 0.3% that differentiates the two measures, this is still very, very substantially below the Federal Reserve's target. Now, this doesn't mean that there won't be inflation going forward. There could be inflationary expectations when you look at things like semiconductors and other supply chain squeezes, but at least for right now, it looks like there's no inflation, at least in this economy at the moment.
Now, Brian, on Earth 2, you're getting ready to, you're wearing a suit and tie. You're getting ready to head uptown to go to the Economic Club in New York for Jay Powell's latest comments. Of course, they'll be done as a webinar, 2 p.m. Eastern later today. First time we've heard from Powell since the last Fed meeting. Any expectations on what he might say? I guess at this point, he's been pretty consistent in his messaging now for, what would you call it, 4 or 5 months. Is there any reason to expect him to change how he talks about the economy, the recovery, fiscal policy, and so on? And what might constitute that change? Because, again, I don't really think anything's happened in the last 2 weeks that would sort of make him say anything different.
No, and you can kind of feel the tenor of all of this, and just in terms of it seemed like everyone was dialed into every word that the Fed chairman was saying in the depths of the crisis last year. But it seems like people don't even recognize that there is a speech coming from the Federal Reserve chairman today. And I think that's because, in large view, it's really the fiscal stimulus that a lot of economists are watching. Now, of course, this is all coming during a time of great inequality for Americans. When you look at some of the data that comes from the New York Fed showing that high-wage workers, those above making more than $85,000 a year, the red line in the chart ahead of you, actually gained employment relative to pre-pandemic levels in February of 2020. Compare that to low-wage workers, which is the purple line on this chart, those making less than $30,000 a year. Check this out. Remaining 14% below pre-pandemic levels, with employment actually trending down again as of late. Not a trend you want to see. And obviously those low-wage workers concentrated in the restaurant industry and other high-contact retail jobs, that's a big concern for the Federal Reserve. Now, of course, the question is, how can the Fed target that demographic? Their monetary policy instruments are quite blunt. They don't have specific interest rates that can better target low-wage workers versus high-wage workers. But the Fed is hoping that the longer that they keep the pedal to the metal on easy monetary policy, low rates, aggressive quantitative easing, the faster they can start to pull back some of those low-wage workers, as they saw in the last crisis. I think that's going to be something that you're going to hear from the Fed chairman at the Economic Club today.
And certainly also something that those who are debating fiscal stimulus in Washington are paying a lot of attention to also. Brian, thanks so much for that preview of that speech this afternoon. Appreciate it. All right, we're going to take a quick break. When we come back, we will talk more about what's going on in markets here and how market participants are thinking about inflation as well. We'll be right back.
All right, welcome back to Yahoo Finance Live. We are less than 5 minutes away from the opening bell on this Wednesday morning. Futures pointing to a higher open. Let's talk a bit more about everything going on in markets these days. Joining us now for this conversation is Mark Howard. He's a senior multi-asset specialist over at BNP Paribas. Mark, great to talk with you this morning. Let's start with the B word, which you bring up in your note to us, bubbles. Everyone wants to talk about them. And I wrote a bit about it this morning for Yahoo Finance. If you look at earnings, and where outperformance is in the market right now, it's very much typical early cycle. Why is everyone so quick to move from where the beginning ages of a recovery to, oh, now it's a bubble? I mean, what is driving that psychology, do you think?
Well, I think the whole experience with GameStop and Robinhood 2 weeks ago contributed to that. The run up in Bitcoin has always gets people's attention and makes people wonder about bubbles. And then the recent announcement by Tesla and a few others that they're investing in it, I think just creates a bit of a mindset that maybe we've come too far too fast. But it's not just those extremes. It's also other core markets, such as the high yield market, and within high yield, the triple C segment of the high yield market, which is trading at a very full valuation level now. The yield on the U.S. high yield market is the lowest it's ever been, below 4%. So there are a number of indicators that make people wonder about bubbles, but I don't personally think we're there yet.
Mark, you're a numbers guy, and I'm looking at the Warren Buffett indicator. It's one thing that I watch very closely here. That's the Wilshire 5000 divided by the annual U.S. GDP, and that is 30 percentage points above where it was in the internet, just before the internet stock bubble. How concerned should investors be about a metric like that right now?
Well, unfortunately, I'm not as smart as Warren Buffett, so I don't look at the same metric. But I think anything that's looking at GDP is a really tricky metric right now. Certainly, the numerator there is a very valid one, but GDP is bouncing all over, and as was just previously mentioned in the prior segment, the outlook for stimulus and continued monetary accommodation are central to the expectation of much better growth, not so much in Q1, but in Q2 and beyond, especially here in the U.S. So I think, if you discounted that using forward GDP expectations, most people are looking at 6, 7, 8% growth this year. Then it doesn't get quite as rich. The other piece of that with the Wilshire is that you got a run up in a lot of small caps and mid caps on the expectation of the rollout of the vaccine and improvement in the virus. And so that's another factor driving that.
So put it all together for us, Mark. Are stocks going to keep going up given all that you're talking about?
So, Julia, it's a great question, and I would talk in two different time periods. I think in the short term, we feel pretty confident that we're at a point where volatility in the equity market is going to come down. That generally coincides with valuations moving up. And we're also going to see some rotation into the value sectors of the equity market, which some of them have rallied quite a bit, but others still have room to run, particularly as we continue to get favorable data on both the virus and the vaccine rollout in this country. On top of that, I think we're going to hear today from Chair Powell a continued focus on supporting growth from a monetary standpoint. And we expect to see, if not 1.9 trillion, at least in excess of 1 trillion of fiscal stimulus. So those three things, modest improvement on the virus, continued monetary support, and fiscal support are going to help stocks and other risk assets over the near term, call it 3 months. Looking further down the road, as was just mentioned, there are some inflation concerns. That could be a point of turbulence in the middle part of this year into third quarter. And we think that will be a buying opportunity, but we'll probably see a pullback around some sort of an inflation scare later this year.
All right, there you saw live pictures from the floor of the New York Stock Exchange. Save Them All, ringing the opening bell. That is a pet rescue charity. So not a SPAC. We've been tracking how many SPACs ring the bell, and it feels like it's at least a couple days a week. Mark, another area that you call out in your note is emerging markets. We've talked about this with a couple of guests of late. A trade that comes up from time to time. What do you guys like about the setup for EMs right now? Is it really about the dollar, or is it about something else in the economic cycle?
It's not just a currency-driven trade, and obviously emerging markets. It's hard to lump them into one because there are many different ones. Some are coping with the vaccine quite well, or the virus quite well. Others are struggling to get their hands on the vaccine and still suffering in a major way, which will affect economic activity. So we don't think it's fair to paint a broad brush. But in general, the driver, in addition to some currency tailwinds, is asset allocation shifts. Just as we've seen over the last period of time, people de-emphasizing higher quality fixed income and moving into lower quality, such as high yield and leveraged loans most recently. Same thing in emerging markets, both in equities and in fixed income. And we think that trend's going to continue because institutional investors, the big behemoths, the pensions, the foundations, pensions, they need yield, they need return. And if you can own a diversified portfolio of emerging markets at a time of improving U.S. economic growth and improving Chinese growth, rising commodity prices, that's a good combo for emerging market total return. So we think we're going to continue to see incremental allocations because of those drivers.
All right, Mark Howard, Senior Multi-Asset Specialist over at BNP Paribas. Mark, great to get your thoughts this morning. Thanks for spending some time with us.
Thank you. Have a great day.
All right, let's take a look here at the market. Stocks opening at record highs. Jared Blickery joins us now for all of the early superlatives. Jared.
Yeah, we've seen this before, and not bad. We have record highs in the Dow, S&P 500, NASDAQ, and the Russell 2000. You can see here the Russell 2000 is an outperformer along with the NASDAQ once again. Russell 2000, the story of the year. I seem to say that every day, but keep getting those record highs. So let's take a look at the NASDAQ 100 heat map, and we can see a lot of green here. Tesla, a notable standout, that's down 1%, but we're seeing Microsoft up nearly 0.5%, Alphabet a little bit more, and Facebook up the most of that group, up over 1%. And just looking at some of the biggest winners and losers, China stocks in the green heavily. Baidu up 6%, so is Pinduoduo up over 3%. Then we have Match.com, that's up 5.6%, ahead of the Bumble IPO. Probably not related, but that's supposed to hit the tape perhaps as early as this Thursday. Cisco, after earnings, is the biggest underperformer. That is down 4%. Now, taking a look at the sector action for today, communication services is the biggest front runner, up over 1% at a record high. Energy also back in the green today after a little bit of a slump yesterday. Real estate, materials, healthcare, utilities, staples, all of those are outperforming. And I just want to go over some of the record highs in ETFs that I'm looking at just to illustrate how broad-based this is. So I'm going to read these off. We got XLC, XLK, so that's communication services, tech. We got KWeb, that's a Chinese internet ETF. IPO, we know what that is. iBuy, EEM, so that's emerging markets. Biotech, IBB, momentum, values, software, growth, you name it. All of these are at record highs. So lots to dissect here, but I think a lot of people are waiting for what Powell has to say. Some interesting remarks also by Bill Dudley in an op-ed in Bloomberg today. Guys?
Yes, he is on the side of saying inflation is coming. We're going to talk about that a little bit more later in the show. I want to ask you about inflation in cannabis stocks. I just saw an article this morning that perhaps Reddit has now turned its attention to this sector, and it's certainly been performing this year.
If they're only turning their attention to it now, might be a little bit late. Had been some chatter. I saw a couple names. We had Sundial, for instance. That was one stock that got a lot of attention. But now we're seeing everything blow up. These are today's figures, by the way. This isn't some year to date. Tilray up 47%. Sundial Growers, that's up 45%. Afria, 20%. And let's just make this a year to date comparison for fun. Tilray up 650%. Sundial up over 400%. So lots of hot money flowing into this space. And this is a good fundamental play as opposed to some of those shortstop names that we were looking at a couple weeks ago, guys.
Okay, we'll leave the fundamentals on crypto for another time. I think we could do with a whole segment on that one. All right, Jared Blickery, thanks for that overview of the markets. All right, we're off for a short break. On the other side, a lot more here on Yahoo Finance Live. Again, as Jared noted, stocks at a record high. Just about everything underneath the surface as well feels like it's at a record high as well. The rally rolls on in 2021.
Medical insurance company Centene reported its earnings yesterday morning. 46 cents a share was the earnings per share number. When you're talking about health insurers, you got to pay attention to something called the healthcare or medical care ratio. That's the percentage of premiums that get paid out to associated costs. And I want to talk about that number for Centene with Michael Neidorff, who is the chairman, president, and CEO of the company. Michael, it's good to see you. So your medical loss ratio was the same in the fourth quarter of last year as it was the prior quarter in the prior year. That is the fourth quarter of 2019. How are you going to work on getting that? I know there were some sort of pandemic effects that affected your costs.
Right.
What does that look like throughout the year, and how much control do you have over being able to get that down?
Well, I think there's two things. One, it's going to be choppy again. I mean, it's just the nature of the pandemic. And we're finding that when the pandemic costs are up, the standard utilization is down. So, we continue to work on it, influence it. I tell people we control our costs, influence medical expense. And we have a lot of systems and technology now we're applying to it that I think over time will start to continue to bring down the costs.
That's right. You've talked about, or I know you've made a lot of acquisitions on that point as well in terms of technology that we have talked about here in the past. And what about the balance of people not getting as many procedures right now with, on the one hand, with COVID costs, testing and the like, on the other hand? And also, how concerned are you about sort of a balloon effect or a delayed effect from people who did not get the care that they needed during the pandemic? Is that going to be an upward influence on your cost this year?
I think that's been mitigated. Most hospitals that I've talked to, their presidents, CEOs, and individuals, they now have really bifurcated their hospitals. We've done that with our own hospitals in England and in Spain, where you have the sections that's for COVID and you have a section that's for normal utilization. Individuals that have something they need, they have a cancer, they have an appendectomy, whatever they have, they're getting that care now. What we're seeing delayed are elective things. In the case of a colonoscopy and endoscopy, women with their mammograms, things of that nature. And so while that can have some effect long term, these aren't being delayed past more than one cycle. So I don't think we're going to have as much pent up as some people think. People are adapting to it. The system's adapting to it. The one area we're watching carefully is the outpatient services, the physicians, because they have been trying to restrict how many people are in their office at one time. But even that, I think, will pick up the second half of the year.
Michael, on the call, you guys, made a quick mention of sort of the ACA provision that's within the COVID relief package that is currently being proposed. And I'm curious, as you start to think about what the next couple of years of healthcare policy might look like, do you think it's going to be more moves like this where Congress, leverages the existing ACA to fill in the gaps rather than try to come in with some massive overhaul of the healthcare system?
I don't see any massive overhaul. People like the ACA. When you look at how people have stuck with us, they like it. And I think what we're seeing is a commitment to try and get the uninsured insured. And they're really doing it in a way that is making it affordable. So, and we're finding we're going to get more subsidies with the new act that will make a difference. It's going to allow people to keep our plan instead of searching for the cheapest plan. And those that have tried to come in on a price basis are going to find, with a narrow network, are going to find people gravitating to our plan, larger network, more comprehensive, and at no cost to them. So I think that it's really good. And I think it's going to allow us, we're going to contain costs, we're going to help them. And they're going to end up with higher quality. So I think we're headed the right direction. I believe the administration is committed to building on the ACA.
Michael, curious on your thoughts on the vaccine itself. Do you think this is something that we will have to get every single year? And if that's the case, does that have an impact on Centene's business?
Yeah, I think we will. The groups I've been talking with are saying you're going to get 2 injections a year. I mentioned it earlier to Julie. You're going to get your normal influenza, and you're going to get the COVID-related one. Now, what's important is, and what used to worry me is how are they going to get the testing? Well, normal influenza is done in the laboratory. They're not going through 3 phases of testing. We're going to see every year, they're going to try and determine which is the COVID, and we're going to see a vaccine develop very quickly, and we'll get 2 injections a year. And I don't think it's going to have no impact on us. There may be a COVID season here or there may be something, but it's going to be like influenza. You may have some elevated costs in a particular season, but I think the COVID people will be very serious about, more so than the influenza. What we're working on, and I'm concerned about historically now, is that mothers who develop concerns about vaccines move away from the normal measles and other things that they normally give children. And we're doing some public service announcements now developed so as to avoid that. So I think vaccines are here to stay.
Yeah, that's a great point about the sort of knock-on effects for other vaccines. Michael, what about vaccination of your workforce? Are you all, it has largely not been a private effort. It's largely been a state and federal effort,
Right.
But are you doing things to help your employees get vaccines?
Yes. What we're doing is we have asked our people to talk about, we are kind of the quasi-essential workers, and we do have nurses and people seeing people that, how do we do that, and how do we get it at the earliest possible stage? We're doing a lot of testing. We now have the ability to do rapid CPR testing in our clinic here in St. Louis and other locations. So we're doing that. We're creating a work environment they can come back to safely. But we're trying to determine, can we mandate you take the vaccine? Because right now they're still deeming it to be experimental. So there is a legal issue that's been raised there. But we're helping people understand that the vaccine protects you from needing oxygen and dying if you do get the flu. And that's what's so key. Even the J&J with 72% will protect you, keep you alive, and you won't probably go in the hospital. So just that movement alone should be enough, and we're educating employees to that fact.
Sticking with employment for a moment, I don't know if you saw the news this morning about Salesforce and its plans for bringing people back and not bringing people back, that they're going to offer a pretty wide options for people to work from home. What about you guys? You were telling me in the break, you have 70,000 employees working at home. What's the plan? Are you going to, and how long are they going to be working at home?
We've told them don't plan to come back before September. We have put these partitions, plexiglass partitions between every booth. We have the temperatures automatically checked when people come in. And there's all kinds of things of that nature. So when they do come back, we are scheduling them back, and we will do some modifications. You may come in for a 4-day work week. How you come in, you may come in 1 week, stay home 1 week. It's going to be a function of the job. We have to get people back in the office. We're an innovative company. We need to help people develop, and you're not innovative when everybody's working at home. So our plan is to, in the fourth quarter, God willing, and everything settles down with the COVID, we don't have a lot of new strains. We expect to start to bring the workforce back on a very planned, methodical basis.
And have all the technology in the world, there's no substitute for talking to people in person, is there, Michael, still? And hopefully, eventually, we'll see you in person as well. Michael Neidorff, the Centene CEO. Thank you. It's always great to see you.
Likewise. Look forward to it. Thank you for having me on.
Thank you. Well, coming up next, we're going to talk about a different angle of the healthcare industry with the CEO of Novo Nordisk. Stay with us.
despite the COVID-19 pandemic, the race to rid the world of some very major diseases has continued. One company leading in the race to defeat diabetes is insulin provider Novo Nordisk. Let's welcome in the company's CEO, Lars Jorgensen. Lars, good to see you this morning here. So despite the pandemic continuing to rage on, where are you in that race to fight diabetes?
Thanks, Brian, for having me this morning. So we are doing well. Obviously, diabetes is a major health issue, not least during a pandemic, because we know that people living with diabetes might have more difficult outcomes during a pandemic. We have a cycle now where we're launching a number of innovative medicines. So we have pressed on for close to 100 years as a leader in diabetes care, and we have a lot of innovative products being launched these years. So I think we're doing well, obviously working for the patients who are in need of these products.
Lars, what are some of those products?
We have a long history in developing insulins. Over the last couple of decades, we have seen the introduction of a new class of medicines based on what is called the GLP-1 molecule. So it's a molecule that works in a way where it lowers glucose level when the glucose level is high. So that's a very convenient way of managing diabetes. It also has a favorable weight profile. So patients lose weight, which is often an issue when you deal with type 2 diabetes. And we're launching two major products in the US right now, an injectable version, which have a very, very strong profile. And for the first time in history, it's been possible to get this large molecule into a tablet, so patients can avoid the injections when they actually get the benefit of the GLP-1 molecule. So that's quite exciting.
Lars, it's Miles here. You guys mentioned in your release that fewer patients were initiating treatment as a result of the pandemic. Are those trends continuing? How concerned are you by that dynamic? And we've talked to a number of folks across the medical space that all kinds of treatments, procedures, visits have been put off as a result of the pandemic. How concerned are you by these kinds of developments?
Well, the benefit for us as a company focused on chronic diseases is that patients still need medicine even during a lockdown. So there is a constant demand for insulin or other products to manage glucose level. But you're right, you have a point that when you're in a launch mode, you need medical reps in front of physicians to explain about the benefit of these new products. So we see that when the reps are out of the territory, we get less new scripts for the latest launched products, but then physicians use some of the well-known, more established products. So despite the pandemic, we actually grew sales by 7% last year, which was actually a notch higher than what we expected when we went into the year. So yes, there's an impact during lockdown, but we see that the uptake is resuming when we have reps back in the territory. So overall, I'm not concerned.
Lars, it's Julie here. One of the phenomenon I've been interested in during the COVID pandemic is the concerted effort around the globe to find treatments, to find vaccines. Coming out of this, how hopeful are you that that kind of really concerted and coordinated effort will be applied to some of the other persistent diseases of our time, like diabetes, which has only grown, it's really exploded, along with obesity around the world?
Yeah, you touched on a really, really good point that what we have seen from the pharmaceutical industry during the pandemic is an amazing speed whereby vaccines have been developed. And we've seen a much more open environment, sharing data, sharing learnings, which have helped speed this up. We've actually also seen in recent time that the pharmaceutical industry has come together and actually put money into a fund to help the antimicrobial resistance, actually pooling efforts to develop very important medicines. So I think it brings some hope that we in the industry can do a lot. And that has for sure been seen during the pandemic. So it's great to see that innovation is coming through, and there's a significant benefit for the world population, in not least when it's needed the most.
Lars, you had a very promising Alzheimer's drug enter phase 3 development in December. What's the latest on that?
Yeah, so we know from one of our diabetes products, one of these GLP-1 products, that there is a hypothesis that it actually also helps people living with Alzheimer's disease. Now, Alzheimer's disease is obviously a huge medical need, but it's also a very, very complex disease to develop medicines in. But we believe we should give it a try. So we are trying to take this semaglutide molecule into Alzheimer's, and now we started phase 3 development. I have to say that this is probably the highest risk project we have ever started, but we believe that if there is a chance that it works and helps people with Alzheimer's disease, we ought to test it out to prove that in a large-scale trial. So although it's low probability of success, we give it a serious shot and really hope for the best because there's a huge need for many Americans living with Alzheimer's disease.
Lars, real quickly, will you know one way or another if it works in the first half of this year?
We will not, because it takes a couple of years to study, how a medicine like semaglutide will work in this population. So we really have to look at patients for quite some time to demonstrate the profile of the product. So unfortunately, it'll take longer than the first half of this year.
All right, well, good luck on your work. Novo Nordisk CEO Lars Jorgensen, good to see you.
Thank you for having me.
All right, do stick around. We have much more ahead on Yahoo Finance Live. Very own Miles Udland will take a look at the markets coming up next. All right, welcome back to Yahoo Finance Live on this Wednesday morning. We're about 25 minutes into today's trading session. As you can see here, all three majors are trading in the green. We saw record highs as we opened the day off those best levels of the session just a little bit, but again, still hanging on to gains this morning. Let's take a look at some of the squeeze names that we have been following. Call them the meme stocks, however we want to be phrasing that trade now. I just want to check back in on some of our old friends. GameStop shares, they're off about 1.8% today. Yesterday they lost, or that stock lost about 16%. GameStop now kind of back to mid-January levels. So we're starting to see this trade calm down a little bit. We're getting past the most frenetic phase of this mania, whatever we want to call it. Obviously, stock is down some 85+% over the last handful of days. Last 5 days now, it's 46%. Obviously, this leaves out the
whatever it was, $350 some odd dollar highest close. Of course, it traded to 483 at one point. So all kinds of craziness here with GameStop. But I do think that there's something real in looking at this trade calming down, because we started to pick up on it last week and even the week before that. But there was a little bit of an inverse relationship between the overall market and what happened with shares of GameStop, even though it was a small company and one specific trade. On some of those crazy up days, we saw the market under a little bit of pressure, a lot of de-risking happening. It was very stressful for a number of different reasons, not the least of which was T+2 and all the things we all learned so much about. And I think as this trade has calmed down a bit, it has allowed the market to calm down and get back to what was driving the market, which was hopes of additional fiscal stimulus, a very strong earnings season that now looks like fourth quarter is going to be up year over year, an almost unthinkable result just a few months ago. And so all these trades fit together. And I know everyone said maybe you guys talk too much about GameStop, all this stuff, and maybe that was true for a little bit, but I do think there was a bigger story there that did impact and does impact the broader markets, and we're kind of seeing how that feeds through the system over the last couple of weeks. All right, we're off for a short 2-minute break. On the other side, a lot more here on Yahoo Finance Live. We're back with that right after this.
Just after 10 a.m. on this Wednesday, February 10th, this is Yahoo Finance Live. I'm Julie Hyman, along with Miles Udland and Brian Sazi. We've got a little bit of a rally going on in stocks today. We've been seeing a lot of records happening for the major averages, with the climb once again today and the strong week last week as well. Investors are also watching data on inflation. This morning we got the Consumer Price Index, which on a month-over-month core basis showed no change to inflation. Year-over-year inflation still well below the Fed's targets. We're going to discuss the inflation debate, whether it's coming, in a moment, as well as how it affects big fixed income investors with Ann Walsh, Chief Investment Officer at Fixed Income at Guggenheim Investments. That's coming up. Well, families are playing Monopoly and Magic the Gathering at home. That gave a boost to Hasbro's sales last quarter. CEO Brian Goldner will join us this hour. And shares of 1-800-Flowers, they're up about 28% this year. They also happen to be heavily shorted, by the way. CEO Chris McCann is going to talk to us about the stock action and, well, whether people are still buying roses for their at-home Valentine's Day dates. That is also coming up later this hour. But first of all, let's talk about that inflation debate and how it's affecting big fixed income investors. As I mentioned, we got that CPI data this morning, still showing inflation not happening. Jay Powell, the Fed chair, of course, is going to be speaking this afternoon and talking about employment, among other things. Let's talk about all of this. Ann Walsh is with us now. She's the CIO of Fixed Income at Guggenheim Investments. It's great to see you, Ann. Thank you very much for being with us. As you look ahead to 2021, I'm curious where you guys come down on this inflation debate, how hot it could potentially get, how the Fed is going to react, and then how you're customizing your portfolios accordingly.
Sure. Good morning, and thank you for having me on, Julie. It's interesting. So the general consensus is that inflation is just around the corner, and the reason that investors think so is because there's been so much monetary stimulation that's been produced by the Fed, and of course, along with fiscal stimulus that's coming from Washington. Interestingly enough, though, money has to find its way into productive capacity before we find real inflation. We are instead, however, finding monetary impacts in financial assets. And so that's really a significant difference between what we would call, inflation in the traditional sense as measured by the CPI. And as you've already reported, CPI really hasn't started its progression upward. Most investors think about inflation as a monetary phenomenon because of all this stimulus that's been injected. And by the way, unprecedented levels of monetary stimulus occurred in 2020, moving up the money supply as measured by M2 by almost 30%. That's tremendous amount of monetary stimulus happening. And so as a result, if you believe the words of Milton Friedman, who was basically the founder of monetary policy, inflation is always and forever a monetary phenomenon. However, he also said subject to long and variable lags. And so, you asked the question, where are we in 2021? We don't anticipate seeing inflation moving up significantly in the traditional sense. There's still a lot of disinflationary pressures out there. Technology is disinflationary. Debt is deflationary, but we do see all this money flowing into financial assets, and it's really giving a tailwind to the value of all sorts of assets, whether they be stocks, of course we're seeing that phenomenon, or also bonds. And as we talk further this morning, we can talk a bit more about what the difference is between the rates market as well as the difference between that and credit markets. So credit assets, we've got a huge tailwind behind them as a result of all of this.
Ann, let's talk a little bit more about the role that monetary policy has played and could play in the future, and particularly as we get essentially all of the financial crisis accommodation shot into the market in, a couple of weeks, felt like back in March, and you're outlining, we know it will matter, we just don't know when. What are maybe some early signs that you guys are focusing on or looking at as a sign that things have changed in the market and that investors are thinking differently about how the market is likely to absorb some of these impacts going forward?
Sure. So, if you ask about monetary policy, the Fed has very clearly signaled that they are on hold until at least 2023. And we take them at their word. And by hold, we mean they're going to continue monetary accommodation until at least then. And our view is likely longer. Chairman Powell was quoted as saying that they have continuously underpredicted inflation for years, in fact, if not years, decades. And so as a result, what's different this time? And it's likely that we were going to continue to see this benign inflation number, again, as measured by the traditional measures of CPI and PPI for quite some time. The Fed has also signaled that they're willing to overshoot their target of 2%. And let's remember what their dual mandate is, which is stable prices and stable employment. Well, we're not at full employment right now, and we have a long way to go until we get there. And certainly coming into this, coronavirus-driven cycle, we were at 3.5% unemployment. So we have a long way to go to get back to that. And additionally, as long as we remain below 2% on the inflation target, the Fed has the ability and will continue to be very accommodative. And so we also have Janet Yellen as our new Treasury Secretary, and she has also historically been very dovish, and the combination should lend itself to, again, continued monetary and fiscal support for the markets. The amount of stimulus coming in from the Fed can be sort of discussed in two ways. One, certainly they are continuing to be significant purchasers of treasuries, as well as agency mortgage securities. In fact, they're the largest purchaser of treasuries right now. But also international investors are finding a good market here in the US. As around the globe, there's about $18 trillion of bonds trading at negative yields. If you consider that on an inflation adjusted basis to be about real yields, that closes in on $30 trillion. So investors all over the globe are looking for yield, and they're still finding it in the US markets. So notwithstanding all of this accommodation, there's plenty of investment opportunity and drive and demand for investments, which is again also keeping yields low and the opportunity strong for investors in fixed income.
And I know in particular, Anne, that Guggenheim's view is that risk assets continue to be attractive. Now, you work with a lot of big insurance companies, which during different points in history have had a little more risk appetite, sometimes to our detriment if you think about the financial crisis. But I'm curious what their risk appetite is now. We talk a lot here on Yahoo about retail investors having a lot of risk appetite right now. About with your insurance clients?
So, insurance clients as well as other members of what we might call the savings institutions, whether they be pension plans or long-term savers, are all still all together in the same place. They need to put money to work, and this is true in the U.S. as well as internationally. We have a number of clients in the U.S. as well as in Europe, for example, and in Asia. That are all part of the savings institutions industry. And there's a huge drive to invest and the need to invest to meet their liabilities. This is especially true of life insurance companies. And the big elephant in the room for them is this continuing grind lower in yields, which makes their jobs harder to continue to meet those requirements and the spread requirements against their liabilities. But they are finding value, and we're working with them, of course, to find that value amongst the various different investment choices that are available in the broad world of fixed income in particular. And those opportunities are in what we refer to as the spread products, structured credit, corporate credit, and other assets away from what we would traditionally think of as the rates market. As you just showed a slide that demonstrates that, right around 1.1 is where the 10-year Treasury is. And it's likely that the 10-year Treasury will retrace its steps down a little bit further. At the same time, we're seeing spread price compression in credit sectors. So these investors are being challenged to continue to find yield in this particular time and in these markets. But they're certainly not alone. As I said, this is a worldwide situation that these institutions are finding themselves in.
And we've really seen investors of late plow into the junk bond market. Just given where corporate credit or corporate health is right now during the pandemic, do you like that move? Does that make sense to you? Is that the correct move?
Well, so there's a really good question. For the first time, we've seen the high yield index, the Barclays U.S. High Yield Index, go below 4% in yield. This is a huge move in yields that has occurred over the last year. And the CCC part of the index, which of course is the riskiest part of the high yield market, is trading right around a 6% yield. One could argue that CCCs aren't really compensating investors for risk. But what's interesting, if you think back to when Chairman Greenspan said that the markets exhibited irrational exuberance, these periods of heady price and activity, as we're seeing right now, and these fund flows into the markets can continue for extended periods of time. So while it may appear that you're not getting compensated on a nominal basis, the expectation is that these yields are going to continue to decline, and the spread compression is going to occur again for the next, and really foreseeable future, next couple of years. In periods past, when we've looked at this on a historical basis, credit spreads have been this tight on a relative basis as a percentile of treasuries a handful of times in the past. Looked at in the late 90s, thousands leading up to the financial crisis as examples of when spreads can compress to these levels and on an extended basis. So again, our view is that while it may on a nominal basis appear very challenging to investors, we believe that these markets continue to have a tailwind and will continue to perform very well.
Very interesting stuff. So it looks like we're here for the foreseeable future. Ann Walsh, great to see you. Thank you so much for being here, CIO of Fixed Income at Guggenheim Investments. Be well, Ann. Thank you.
Thank you.
All right, we are going to take a look at what's going on in the markets right now as we see this rally, albeit a pretty modest one right now. Our Jared Blickery is with us here with an update. So what's going on in the market today, Jared?
Well, a modest rally it is, but we'll take those gains. It looks like the Dow, S&P 500, and Nasdaq, and the Russell 2000 each up around 1/3 of 1%, a little bit less than that. So the outperformance by both tech and the small caps continues. Both of those going up in line together. Taking a look at the Nasdaq 100 heat map here, we see Tesla as a standout. That's down about 3%. Amazon, Apple, both slightly in the red, but Facebook, Alphabet, and Microsoft solidly in the green here. But I want to get to our heavily shorted board because some interesting things going on. GameStop has been in the green for most of the day. Well, it looks like it's expressed. Let's get back to GameStop. Up 5% now, been up as much as 15%, but you can see on this 5-day chart that the volatility has really tamped down, and maybe 45 is a level here of support. We'll have to see going forward, but the standout in this group, which we were talking about before in a different context, is Sundial Growers. That cannabis play up 44% today, up 97% over the last 5 days. And now off to crypto land, where we have Bitcoin and Ether taking a little bit of a breather after coming off of those record highs. But guess what? XRP is up 6%. And we also have Dogecoin in focus here. That is still down about 1%. And this is despite Elon Musk tweeting about it. And we have that tweet coming up here. Bought some Dogecoin for little X so he can be a toddler hodler. And yeah, more Dogecoin news. So there you go, guys.
Such as it is. All right. Thanks so much, Jared. Appreciate it. Coming up next, we're not playing around. We've got the CEO of Hasbro. Sorry. We'll be right back.
All right, the toy industry is coming off a pretty good 2020 as people stayed home during the pandemic and played a whole lot of new board games. That industry growth is expected to continue this year, though perhaps at a little bit of a slower pace. We better chat all things toys than Hasbro's chairman and CEO, Brian Goldner. Brian, always good to speak with you here. So your fourth quarter out this week, U.S. and Canada, sales up 16%. Good. People are still home buying a lot of games. Has that momentum continued?
It really has. We saw for the full year 2020 that our total games category was up 27%, and for the full year was up 15%. As we enter 2021, our POS thus far have been up nearly 30%. Games are really running ahead. The Nerf business is performing quite well. Our Play-Doh business. People are still very much into making connections, playing together. And in fact, what we've seen through research is a lot of new families have come into the category that had not really been involved in game playing up until this past year. So in many ways, the headwinds that we'd seen in supply chain and store closures will become a tailwind as the consumers really adopted a lot of these behaviors.
Brian, last year was the year of board games. What will this year be?
So there's several fold. We think our games and toy business will grow mid-single digits ahead of the industry. As you know, E1 was up in the fourth quarter. We're back into production on television and film. And we believe E1 can go back and achieve the kinds of revenues we saw in 2019, which would mean nearly 30% growth in that business for 2021. And then our Wizards of the Coast business, as you know, with Magic the Gathering and Dungeons and Dragons, both having best ever years this past year, we expect double-digit growth as well there as they continue to move toward doubling the size of that business overall by 2023. So if you blend that all together, we expect double-digit revenue growth at Hasbro and a real opportunity to maintain our margins with that growth this year, 2021. And there are a few costs that come into the business as a result of a lot of the digital games we're doing for Wizards. But the fact is, very strong growth, mid-teens operating profit margin, very strong cash generation. You saw at the end of the year, we had $1.45 billion in cash. We had prepaid some of the debt, and we expect to get back to our debt to EBITDA of 2 to 2.5 times.
Brian, it's Julie here. I have a couple of Magic the Gathering fans in my household, I must say. However, they're also, and I would argue even more, Roblox fans, especially these days as the kids are home a lot. So how are you thinking about that digital competition? You mentioned you do have some digital offerings that are linked to your existing games, but is that your biggest competition right now, that online migration?
Well, actually, it's very complementary. Many people had said, when we launched Magic Arena, which is an online version of Magic the Gathering with the card game being played face-to-face, that would be cannibalistic. But instead, it's really driven the card game. It's really built-in marketing. We're getting more of the 24/7 day parts where our consumers are playing nearly 9 hours a week online. And then we're offering great digital games across an array of brands that are more consistent with like a Roblox demographic. Remember, Magic the Gathering, D&D are played with teenagers and older. But, we've got a great Yahtzee with Buddies game from Scopely that's a third-party license. We have Scrabble Go. We have a number of My Little Pony games and Transformers games, increasingly G.I. Joe. So, yeah, we want to participate in digital games as well as face-to-face gaming, and we have a roadmap to get there.
Brian, I'm curious about the demographic mix you may have seen in 2020. I mean, I think about myself and my peer group. All we could do was stay home. And my wife and I bought a couple of board games and kind of played them. And I don't know, just went back to watching Netflix. But does that change the way you are thinking about potential addressable markets where people, maybe rediscovered Magic after having put it down after college, as an example? And are you thinking about trying to pull some of those levers?
It's exactly right. Well, Hasbro has enjoyed for years broader demographics and broader portfolio than a lot of our competitors. We have, toys and games that play at Play-Doh and Chutes and Ladders for the youngest children. And then you have Magic the Gathering and Dungeons and Dragons and Axis and Allies and Risk that play for that older audience. And so it's been our responsibility to contemporize those games, bring new versions to these audiences, and people have really responded. You see a games category that's grown by nearly 30% in the fourth quarter and 15% last year. The momentum has continued. The new products that we're bringing out around D&D and digital and in Magic Arena, which has only been available on PC thus far, is moving to Android right now in open access, and will move to iOS this year. So we're going to get to the heart of that mobile gaming player through Magic the Gathering, and that's millions of new players that would never play on PC would play more casually. We're also launching a casual Magic the Gathering game called Spell Slingers. We're launching a Dungeons and Dragons game called Dark Alliance. And so you're going to see an array of games that really reflect the demographics of Hasbro, running from the youngest audiences all the way through adults.
Brian, the E1 pipeline is pretty impressive. You called out 150 projects, and you also have 30 Hasbro IP in terms of products. What movies, what content will be coming from you this year? And do you think that will drive more revenues this year from E1 than you originally thought when you bought the business?
Yeah, we've actually had more success in developing Hasbro IP during a period where people were working virtually together. So while TV and film wasn't in production, we had the teams together. There was more integration. As you know, we talked about our cost synergies. We've achieved beyond the cost synergies we thought we'd get in year one. And we've now stood up a number of creative projects. We have an investor meeting coming up on February 25th, and the team is going to outline any number of major Hasbro IP that will be on stream television, in motion picture, but I'll give you a couple. Dungeons and Dragons movie is progressing. You're going to hear more about D&D in television. Our Transformers business, we're clearly working toward another film, but we also have other Transformers new content coming. We have great creative stewards working on a brand new take for Power Rangers in a young adult space, as well as a future feature film. So you're going to see that we've made a lot of progress to put Hasbro IP in the market. And of course, now we have a profitable entertainment engine versus our marketing expense that we used to take to drive consumer products and gaming. And then the flywheel is, of course, it will attract our toy and game business to be developed, and then the consumer products licensing, as well as digital games and the games and brands at Wizards of the Coast.
Brian, I was going to ask you a different question, but this one just came in from our very big toy fan and our producer, Nick Monti. I mean, this guy loves toys. He wants to know about the rise in oil prices. Oil prices have really spiked over the past month or so. Have you started to see that impact how you produce your toys, and are you looking at price increases?
Yeah, no, we're not really looking at substantial price increases on our products. Luckily, the way the oil prices work, that the resin prices sort of move in arrears, and we sign contracts with a lot of our third-party manufacturers for more than 12 to 18 months. So what we might see oil prices creep up, and then over a period of time behind that might go resin prices, but we haven't seen major spikes yet. We are seeing a bit of pressure in domestic shipments. We talked a little about that on our call with investors, and that's something we think we can mitigate over time, but have seen that as a result of the surge of demand domestically and the increases that we're seeing, a nearly 50% increase in e-com and omnichannel. And of course, that requires a lot of domestic shipments and just-in-time inventories.
All right, we'll leave it there. Hasbro Chairman and CEO Brian Goldner, always good to speak with you. Stay safe, and hope to talk to you around your Investor Day soon.
All right, great. Take care, Brian.
Thanks. All right, do stick around. Much more ahead coming up on Yahoo Finance Live.
All right, welcome back to Yahoo Finance Live on this Wednesday morning. An hour into today's trading session, when we came on the air, we saw stocks trading at record highs. Now we see all three majors have moved lower. The Nasdaq leading the way down off some 0.5%. Again, all four majors, including the Russell 2000, have been trading at record highs earlier on in today's session. Well, as we all continue to grind it out, working at home, doing the show from home, figuring out whatever the future of work looks like, Salesforce has come out and said that they think they know what the future of their workforce looks like. All employees will have the option to be fully remote. They can go with a hybrid model, or they can be fully in office. Now, about 2/3 of Salesforce employees said that they will choose to be hybrid. So they'll be in the office 1 to 3 days per week. The company is calling it a flex option. I think this is kind of, if there's any consensus at this point, guys, and obviously we are less than a year into everyone going work from home, very long way to go with the pandemic, with getting the vaccine rolled out, with figuring out what we all want to do on the other side of this. But if there is a consensus, Julie, I would argue that hybrid seems to be where a lot of companies are landing. But the other side of this is Salesforce says, well, now we're going to reduce our footprint, and that's going to have knock-on effects. And maybe they want to be the first to say we're going to reduce our footprint before some of the other companies they share buildings with try to do the same, and landlords start really cracking down.
Yeah, there definitely will be knock-on effects, not just for that, but also what that office of the future is going to look like. Now, I did read one take on this morning that said in Salesforce's sort of illustrated mock-up of this, people aren't wearing masks, they're socializing. So does that then also assume a sort of vaccinated, non-socially distanced office when people do go back? But then on the flip side, when we talked to Michael Neidorff, Centene CEO earlier, he said that there will be some retrofitting involved with those offices with, things like plexiglass dividers, for example. So in addition to the lower footprint, one could imagine that the footprint that is there is going to be a changed one, and that will then have a different kind of economy, right, for all of those sort of health and safety retrofitting providers and the work that they're going to have to do within those office buildings. And Neidorff also brought up the other sort of thorny issue here, which is, can you require your employees to get vaccinated? There are legal issues involved with that. Can Salesforce do that? Can it ask them for proof of vaccination, even if it doesn't require the vaccination? So I think that a lot of companies, even as they try to figure out the back to work stuff, in some ways that's the easier part of it. And then the other stuff that then follows might be the more complicated stuff.
Well, I would say this, at least Salesforce has some form of plan. I talked to a lot of these executives, and to me, they're not articulating really any plan on how they're going to get their workforces back. So, all right, Salesforce, it's good that you put this in the ground. But this brings up the second point, and I wouldn't be surprised, Miles, you probably have a take on this, if we don't see a productivity boom in 2022. The only reason we had the 9-to-5 workforce because we had to get up in the morning and travel to the office and be there at 9, punch our clock, sit our rear ends in the desk. And then we had to pack up and start leaving at 4:30 to catch a train at 5 o'clock. Well, now there's no more boundaries. And essentially, and nobody likes to talk about this is the third rail, we are going to continue to be working around the clock. And as revenue comes back, that is more revenue per employee and eventually higher profits.
Well, Sazi, I think that's an interesting point. And I heard, there was an argument, I think it was in the New York Times a couple months ago, that we're not working from home, we're working at home. A lot of people always did work from home, had been, the world had been going more remote before this. We were all forced to work at home. I didn't plan to be sitting in my living room with this tiny rickety desk doing the show this way. This isn't the best way to do this program. It's the way that we have to do this program. But maybe if we had time to think about what we wanted, what was available, what we were capable of, then things would be different. And I think to that point, Sazi, where so many leaders seem to have no real vision on this, they haven't yet spent the time necessary to decide what they want versus what they must do. And, that productivity, there have literally been books written about productivity. Famously, we're not very good at measuring productivity. You could define that a lot of different ways, though I don't think any of the three of us would disagree with the fact that there is more of our time available to give to Yahoo Finance because we are not spending time coming to and from the office. Whether we give the company that time, whether the company takes that time, we could have that conversation maybe offline, but we know that there is more time in our days available to be taken from us by our employer. And this is true kind of across the white collar workforce. And so I think that's the hard conversation that individuals in concert with their employers need to have is, what do I want? What is feasible? How should it look? Because whatever this looks like is not, this is not good. I don't really think, unless you were already prepared for this.
No, Miles, I mean, that's not really, those are some great points. But I would just anecdotally, I know I'm getting messages at 8 p.m., 9 p.m., 1 in the morning. These are messages that I know I would not have gotten 1 year ago. And that just goes to the productivity boom. And I see it in my own work, not that I wasn't productive before, but I've seen things increase 2 to 3 times because now I am getting these messages, whether it's good or not. Maybe it's impacted my mental health. I'm not sure, but I know I've been able to produce more work over the past year. And this is the third rail. Nobody wants to talk about this, but that's why I think you could see this productivity boom.
Man, this is depressing.
Well, it's
not to get all deep on you.
Certainly depressing.
Not to get all deep on you.
You know, look, Sazi, I know your annual review is coming up next week. That's well timed. You are certainly cranking out the content, and I know that some people that care about that are certainly listening to the program. So great of you to work that in. All right, we're off for a short break here on Yahoo Finance Live. We're back in just 2 minutes.
Get a quick check on oil prices, and that's because we just had the weekly inventories numbers from the Energy Information Administration, and we had crude inventories falling 6.6 million barrels last week. That's a much larger drop than estimated. At the same time, though, gasoline inventories went up about 4.3 million barrels, but we have been seeing oil move higher in the wake of these numbers, and oil, of course, has been moving higher recently. $58 a barrel. We're above that threshold right now. Let's talk about Washington as well, and the latest on the stimulus back and forth. Markup on the latest bill was scheduled to begin at 10 a.m. What does that mean? How will the bill change as a result? Our Jessica Smith is here to explain for us. Jess?
Yeah, Julie, now House committees are working on their portions of the COVID relief bill. So 4 different committees are working on their sections of the bill today. The House Ways and Means Committee got started at 10 o'clock this morning. That group is working on some key provisions like stimulus checks, enhanced unemployment benefits, and the expanded child tax credit. We heard from the top Republican and top Democrat on that committee offering very different views of this legislation. The top Democrat saying that you can't go too small, or you can't go too big, excuse me, you can only go too small. And then we've heard from the top Republican saying that this is not targeted, that it will not create jobs, really bashing that minimum wage hike that Democrats are trying to include in the bill. The House Labor and Education Committee did work through the night on their portion of the bill. They voted to advance the minimum wage hike, raising the minimum wage to $15 by 2025. There was a lot of debate over that section, but ultimately Democrats won and it did advance. The bill also includes nearly $130 billion to reopen schools, nearly $40 billion for higher education, another $40 billion for child care providers, and strengthened worker protections. So that bill now goes to the Budget Committee, which will wrap all of these different sections into one before it can go to the House floor. And remember, they are trying to get all of this done both on the House and Senate side before mid-March, when those enhanced unemployment benefits are set to expire.
You know, Jess, since President Biden was sworn in about 3 weeks ago, we spent a lot of time on this show talking about, lawmaking, sort of benign things that happen when government works. But yesterday we were all invited back to 2020 and times before, where we saw the spectacle of the Trump impeachment trial. What's the status there? I will admit I didn't follow it that closely, but being on Twitter, I couldn't help but get the sense things were not going great with the president's defense lawyer, at least.
Right. So yesterday they started the debate over whether or not this trial is even constitutional. So each side had a few hours to make that case, and then the Senate voted. They decided it was constitutional. That vote was 56-44. So 6 Republicans voted with Democrats that it was constitutional to move forward. There was one surprise there, Senator Bill Cassidy. We weren't expecting him to necessarily vote saying that it was constitutional, but he did, saying that the president's lawyers did a terrible job. So that's why he voted with Democrats. Today, the real section of this trial, which is focused on making the case against former President Trump, will get started in earnest. We expect to have more video evidence today. Yesterday, the managers played a 13-minute video of President Trump at that Stop the Steal rally on January 6th, followed by all of these images from those deadly riots on January 6th. And then they had more of President Trump's words scattered throughout. We expect more of that today. We will see if these impeachment managers are able to convince any of the Republicans who voted that this trial was unconstitutional, if they are able to convince them to vote to convict. At this point, that looks unlikely. 11 would have to switch their vote in order to convict former President Trump.
Right, unlikely, even though by most accounts I saw, the lawyers for the former president didn't do such a great job yesterday. We'll see if that changes. All right, Jessica Smith in Washington, thank you very much. When we come back, we'll be talking to the head of 1-800-Flowers ahead of this Valentine's Day and following the company's earnings. Stay with us.
All right, welcome back to Yahoo Finance Live here on this Wednesday morning. Let's just take a quick look at the market here because, again, we're losing some steam as we get into today's trading session. The Nasdaq is now off more than 1%. We saw all four major averages, if we include the Russell 2000, trade at record highs just after the open. So, Julie just called out those oil inventory numbers that some folks are pointing to as pressuring the market. Certainly would be surprising to many to see a 1% move in the market on oil inventory numbers. But, maybe it's just the joke is on me for saying that things have leveled out after the GameStop saga had calmed down. Certainly volatility, still alive in this market, and we're seeing it in spades today. But let's turn our attention now to another industry that saw a huge 2020, perhaps one that flew a bit underneath the radar, and that is the gifts and flower business. Joining us now to talk more about it, coming off a blockbuster quarter, is Chris McCann. He's the president and CEO over at 1-800-Flowers.com. Chris, great to speak with you once again. I'd love to just start by maybe taking us through what you guys saw in the holiday quarter and how your business evolved through 2020. I think we spoke around Mother's Day and still kind of COVID period, weren't really sure how to get the shops open, how to keep the supply going. But, looking at these results, clearly things were firing on all cylinders in the end of the year.
Sure, Miles, and it's great to be back. Thank you. As we really looked at our business this past year, it's been a challenging year for all of us, right? And it's been a challenging year for the consumer as well. But we look at the momentum that we had going in from really accelerating our revenue starting in 2018 through 19 and into 20, accelerated further by the pandemic. And we've been very fortunate as a company that consumers are turning to us for what they need most, to connect with each other, to express themselves to the important people in their lives. And we, as a company, we're so well positioned for that. As you referenced, the last quarter was a record quarter for us in terms of revenue growth and profit. In record history in our company. So just tremendous opportunity for us. We grew our e-commerce business 60% last quarter. And those trends just continue. And here we are at Valentine's Day and looking forward to a really strong Valentine's Day season as well.
Hi, Chris, it's Julie here. We have been talking a lot about, as you probably would guess, the whole short squeeze phenomenon that we've been watching in the market. 1-800-Flowers shares are pretty heavily shorted. Last check, it was about 20% of the float was shorted. And you guys have moved up a lot this year, more than 25% the last time I checked. How do you think about that when something like that happens to your stock, or when it looks like something like that is happening to your stock? I did see there were some insider sales that were revealed in filings, but do you take the opportunity to sell shares, for example?
Well, I think as we look at the stock price, we're up significantly in the last 12 months. I think over 100% in the last 12 months. And what you see with shorts generally is companies that have that kind of rise, people start to place some bets one way or the other. Well, we look at the stock price and whether it's being shorted by people, whether it's being bought long by certain funds, which in most of the time is the case. We disassociate ourselves from the stock price and keep our head down and focus on building this business for the long term. As you know, Julie, we've been in this business. My brother and I created this business. We've been in this business a long time, plan on being in it for a long time. So fortunately, we're able to put that kind of volatility aside and focus on what's best for our customers day in and day out.
Chris, given that focus on the fundamentals, how tough is it right now to find new employees?
It's challenging. The employment market has been challenging. As we went into the holiday season, we said one of the headwinds we were facing was both labor rates and labor availability. Surprisingly, with such a high unemployment rate, it's been difficult to get the seasonal labor that we needed to get. Fortunately, we have a great operations team in place, a great HR team, and we were able to manage through that very successfully, as evidenced by the results of the quarter. 45% overall growth, 48% growth in our EBITDA, so showing some leverage there. But we've been able to overcome those challenges, but it's surprising to many. That is a challenge in the marketplace today.
Chris, I'd love to talk about the mix you guys are seeing in terms of what people are buying either for themselves or as gifts between, the flower business, certainly the food business, a big part of what you guys are doing, and maybe how that changed throughout the year.
Yeah, I think really what we've seen is this pandemic really start to hit. We as a company pivoted a bit and leaned into the product categories that we saw our customers buying. So from the flower side of our business, plants have just taken off. They were hot to begin with, but have just accelerated tremendously. You mentioned our gourmet food category, led by Harry and David brand, has been doing tremendous. But people are buying the gourmet food prepared meals from Harry and David, more so than not just our fruit products, what we're known for. And that's so we've leaned into that and really expanding that category. And then we also saw the trend prior to the pandemic, again, accelerated during the pandemic, of personalized products. And we leaned so heavily into that that we made the largest acquisition in our company's history in the midst of this pandemic, buying Personalization Mall, which has just been a great addition to our platform. And that's really what we've built here as a company, this platform for growth. We're a leader in floral, we're a leader in gourmet food gifting, now we're a leader in the expressions business with Personalization Mall. So we're just so well positioned for the future. We feel extremely confident as we move forward.
You know, Chris, I got about 30 seconds left. We are 4 days out from Valentine's Day. How late is too late for people out there?
It's never too late to express your love, so don't worry about that. We're here to help our customers every single day of the year, and we're looking at this Valentine's Day. We'll be able to take orders in many locations Sunday morning, but don't wait until Sunday morning to place your Valentine order. It's a great opportunity to celebrate your romance all weekend long this year, and that's what we're trying to do. There are no limits on love this year. We've been limited enough.
There we go. I like that. No limits on love. We'll take that one to the bank beyond this weekend. Chris McCann, President and CEO, 1-800-Flowers.com. Chris, always great to get your thoughts. Thanks so much for spending some time with us this morning.
Thank you all. It's good to be here.
All right. Stocks under pressure here as we get through today's trading session. We're back with more on that in just 2 minutes. Well, stocks may be lower right now, but I want to focus in on a couple of individual movers. One of them is Under Armour. That company reported this morning and had an unexpected profit last quarter. Did say its revenue declined 2.6%, but that was a smaller drop than had been estimated. So the stock get a good pop today. It's up about 9%. Brian, I know this is a company you watch pretty closely here, and Under Armour, to say the least, has had its ups and downs. You know, it's still seeing declining sales, but still better than expected. What do you think? What stands out to you here?
The two things I would boil down to why the stock is up, and it is surprising. You know, wholesale revenue, that's where an Under Armour would sell, let's say, to a Macy's. Wholesale sales down 12%. That continues the theme. We've seen a lot of these suppliers, like a Levi's, sales in department stores, even off-price stores, remain absolutely dreadful. Their North America sales down 6%, but the gross margin is up 210 basis points. I think that's what the street is trading the stock off. Also, too, they put out an outlook for this year, revenues potentially up high single digits. Well, let's take a step back. Julie, you and I, we've watched Under Armour really the past 7 to 10 years. I mean, this hot growth brand, and to see it now with a market cap of under $10 billion and signaling out more restructuring charges this year. I mean, it's a completely different company. I mean, they announced a restructuring plan last year to save $500 to $600 million. That is a lot of bloat that has to come out of Under Armour's business, and they're still working through it. It's not the same company at all.
Yeah, I think a fascinating move they've made is to get rid of a lot of those endorsements, whether it's with individual athletes or with colleges, professional leagues, things like that. It's always interesting just to see a major sports brand move away from actual professional athletes. I don't really know where this goes for them, but it's been an odd pivot the last couple of years.
Yeah, it's also interesting. Footwear revenues down 7%, a far cry from their huge sort of Nike-killing aspirations of yesteryear. Just finally, as we leave, you want to take a look at what's going on with Uber shares. That company reports after the close of trading today. Remember, Lyft reported, made some promising comments about its profitability. That boosted its shares. Uber shares also rising into that earnings report, which I'm sure we will be talking about tomorrow morning following those numbers. All right, that does it for this segment of Yahoo Finance Live. On behalf of myself, Miles, and Brian, thanks for watching. Keep it tuned right here for Akiko and Zach taking you through the next 2 hours.
Welcome to Yahoo Finance Live. I'm Akiko Fujita along with Zach Guzman. And 90 minutes into the trading day, we are seeing all three majors reversing course a bit after hitting a new high in the session early on. We are seeing the Dow trading pretty flat right now. The Nasdaq and the S&P 500 both in the red. Strong earnings helping fuel some of those early gains in this session. Twitter and Under Armour among the biggest movers in the S&P 500, while Cisco is sliding on concerns around its infrastructure platforms business. The House moving a step closer to passing President Biden's $1.9 trillion COVID relief package, even as House impeachment managers begin their oral arguments in former President Trump's second impeachment trial. And corporate investments fueling Bitcoin's boom. Galaxy Digital's Mike Novogratz joins us this hour to discuss all things crypto and why he thinks the price of Bitcoin is headed to $100,000. But we do begin this hour with a number of those earnings coming out because they are driving the market in a significant way. And Zach, let's start with Twitter. This is one of those stocks we were talking about yesterday, reporting after the bell, and it is up big, getting a big pop in this session, up about 7% or so. The company adding 5 million daily active users. That's a 27% growth year on year, climbing to 192 million in all. Revenue rising 28% year on year to $1.2 billion on revenue for the current quarter. Twitter now expecting $940 million to $1 billion. And Zach, this is significant in part because there was a lot of concern about the pushback, the blowback Twitter would experience as a result of banning now former President Trump from the platform in the aftermath of the insurrection. But Jack Dorsey yesterday on the call making it very clear, he's saying we are a platform that is much larger than any one topic or any one account. So addressing that very issue. In terms of what to look for in this current quarter, there's a number of headwinds that we heard Jack Dorsey as well as the CFO highlight in their earnings call. User growth potentially slowing as we see business resume or go back to normal as the vaccine distribution accelerates. Remember, they've seen a huge growth period over the last year because of so many people staying at home. Also, Apple's privacy policy, something we've heard from other social media companies. Twitter says that that's likely to only have a modest impact on the ad business, but that's certainly something to be looking for as well because Apple's new iOS certainly tightening its privacy policy, which would prevent a lot of these social media companies from really targeting ads in the way they're used to doing.
Yeah, and it was an exciting, earnings story to follow. And as you mentioned, Jack Dorsey kind of highlighting the fact that it's bigger than just Trump's account. And the drama around that obviously kind of hurt them heading into this, but clearly showing the numbers that it does back that up. It is a bigger platform than just something to focus in on the political front. Also, Akiko, I'd also highlight the updates we got from Cisco. Certainly less exciting than what we saw from Twitter. But those shares are down more than 4% here to start today's session. The company reported fiscal second quarter net income of $2.55 billion or 60 cents a share, close to that. I mean, on an adjusted basis, you're going to see a different number there on your screen. When we talk about it, though, it's one of those companies that might be less sexy than some of the other spots in tech we've been discussing, particularly around kind of this work from home environment. But surprisingly, we saw updated guidance that was in line with what analysts were expecting. I say kind of a boring earnings update because it was exactly kind of where analysts had pegged Cisco to come in at. And it's one of those things where it's perhaps maybe less exhilarating than the Twitter discussions, the advertising discussions we've been having as more people work from home and spend time online. But it's one of those names here when we talk about tech. It's one of those traditional players that we have to highlight on the show and down here close to about 5% in today's session. But it's not the only earnings story we're continuing to track.
Yeah, and we should highlight with Cisco, we are seeing the pullback in that stock largely because there's concern about the infrastructure platforms business, which is the biggest business for Cisco. So to your point, while Cisco isn't as talked about in terms of companies like an Apple or an Alphabet, certainly really a bellwether in many ways to be watching to see where the investments are for enterprise side in this space. GM, the other stock that we're watching right now, Q4 earnings beat expectations pretty handily. But the company warning here that global chip shortage is threatening to cut its earnings for this year by $1.5 to $2 billion. And Zach, this is a consistent theme that we have heard throughout the earnings season from a lot of car makers who've really had to alter some of their production schedules because of the global shortage we're seeing right now. The shortage has already prompted GM to at least temporarily halt some of its production in the plants in Kansas. They've also seen some changes in places like Mexico and Canada. CEO Mary Barra is saying that the production schedules will not be affected as of now, but GM potentially having to scramble to maybe sort of build out part of their cars and then having to wait for supply to come in to be able to complete the entire assembly. So that's going to be an interesting story to watch here because it's not just about GM. One more thing to highlight here, Another consistent theme we've heard from these automakers is the big investment in EVs. And Mary Barra saying the growth opportunity in EVs, she's certainly highlighting that. $7 billion of the $9 to $10 billion the company is setting aside for CapEx will be focused on EVs. So certainly something to be watching very closely there as GM, along with so many other car makers, really doubles down on the EV space. Another stock we're watching today, Lyft. Getting a big pop in this session, hitting a new high today. The company beat Wall Street estimates on both the top and bottom lines, posting revenue of $570 million in the fourth quarter. That was down, though, 44% from the same period last year. Net loss in the quarter also widening compared to the same period last year at $458 million. Let's bring in Tom White. He is D.A. Davidson's analyst. And Tom, I guess we're seeing the stock move on the fact that it feels like the worst is behind the company, that, we have heard some commentary from the executives there about specifically how they are starting to see things maybe pick up, saying that growth inflection is likely to begin in the second quarter, with things strengthening in the second half of the year. What stood out to you in the numbers we got yesterday?
Yeah, good morning. Thanks for having me. So, look, I think what two things stood out. First off, that on the revenue side of things, these guys executed very well in a tough environment. Over the course of the fourth quarter, rideshare volume trends actually deteriorated each month. So November was worse than October, December was worse than November. But despite that, Lyft was still able to hit the revenue number, and they did that by focusing on the highest margin, highest revenue, highest value rides. And I think that's just a reflection of a management team that's executing really well, is really kind of zoned in. The other thing that stood out is just how much progress they've made kind of rationalizing their cost base. They've taken out, $360 million in fixed costs on an annualized basis, with maybe some room still to go. They're razor focused on variable expense efficiencies, and the result of that is that they were able to say last night that not only are they going to be able to hit their EBITDA profit target of the fourth quarter of this year, which they laid out, in October of 2019, so pre-pandemic, but there's a decent chance that they might be able to do it in the third quarter. So that was, I think, a real boost of confidence for investors. And again, I feel like execution is an overused word when you're talking about management teams, but these guys really have done a very, very strong job.
Yeah, you affirmed your buy rating on Lyft, raising your price target to $66 from $58 a share. I wonder how much importance should be stressed about that profitability goal and target being achieved here, because you talk about cost-cutting measures that they did in the latest quarter. Impressive to see that loss coming in $150 million, better than consensus estimates at $190. What are the long-run implications of that, though? Is it easy for a company like Lyft to just turn the switch back on when things are getting better, or is there a dent in the growth prospect moving forward?
Yeah, it's a good question. I think it's something that investors are debating for a lot of different technology companies who've also cut costs over the course of the pandemic. In Lyft's case, so far it seems as though a lot of the costs that they've taken out probably don't need to come back and probably won't come back. Now, marketing spend will certainly kind of increase as revenues scale, and you're going to see some promotional spend kind of pick up as again revenues pick up and economic activity opens up. But a lot of the fixed cost stuff, this was a company that was private for a long time. It was flush with VC money before it was public. I think there were a lot of instances where in the past maybe they just kind of threw people at problems, and this kind of pandemic has enabled them to reset. The CFO last night talked about kind of taking the cost structure down to the studs. And I think a lot of the the cost savings that we're seeing now will prove kind of durable, is maybe a good word to describe it, and that sets up, I think, an interesting opportunity for the stock, presuming that the revenue kind of picks up when the economy reopens up.
Yeah, the company pointing to $360 million in cost savings last year as a result of some of the moves they made during the pandemic. Lyft has for long resisted this pressure to get into other channels of revenue, particularly in the delivery business. We've got Uber reporting after the bell today. That's one company that has, at least for now, appears to be really doubling down in the eat space. Does it make sense for Lyft to at least seriously consider that as another potential arm of the business? Or do they stick to the narrative that they have had since the very beginning of the company, which is about solving transportation solutions?
Yeah, so I think the last night it was pretty clear that the original sort of vision of the leaders and the founders of this company around disrupting personal car ownership, transforming transportation, making transportation more of a service than people buying these sort of inefficient and clunky vehicles. That really, I think, is they're sticking to their knitting, I guess is what I'm trying to say. There was a lot of talk about that last night, about the future of autonomous, how that's going to play in. I think that they do see an opportunity to have an interesting role to play in online delivery. They're still being very cagey and vague about the details. It is not going to be a Uber Eats clone business or a Grubhub clone. You are not going to be scrolling through menus in your Lyft app and ordering food. But I think what they see is an opportunity to partner with local businesses and not just restaurants, and maybe not even initially restaurants, but local businesses, local retail businesses, and help them with basically e-commerce logistics outside of these high commission online delivery platforms like the Grubhubs of the world, the Uber Eats of the world. So an interesting kind of potentially sort of B2B play, I think, is sort of emerging for Lyft.
Yeah.
But I think the core knitting is still retro.
Yeah, Lyft a little more cautious on that front, potentially just sort of dipping its toes in the water, so to speak, by just seeking out those partnerships you pointed to. Tom White, it's good to talk to you today, analyst at D.A. Davidson. Let's turn our attention back to the markets right now with Marco Papic. She is Clock Tower Group Chief Strategist. And Marco, let's stick with the earnings theme here because we've been sort of dissecting a number of these companies reporting. Sort of a thread that we're seeing more and more companies guiding now, talking about sort of this optimism coming along with the acceleration of the vaccine distribution. What kind of narratives have you been watching in the companies that have reported so far?
Well, I think the main narrative is that there is both the opening of the economy, but also the fact that there is a massive fiscal stimulus that's still coming down the pipeline. Even though from the previous stimulative efforts in 2020, we have about $1 trillion worth of cash that hasn't been distributed by the government. So if you think about that, there's $3 trillion potentially that's going to come down the pipeline. And I think that's what's really important, and that I think the market is not really considering, is the fact that this stimulative package will pass through a reconciliation procedure, which in the past has been used for profligate stimulative efforts, but mostly tax cuts. So this is really the first time that the government is going to use reconciliation procedure to pass through a stimulative effort that's mainly just spending. And I think that once policymakers get a taste of this, there'll be more coming down the pipeline, which will almost ensure that we close the output gap and that the growth surprises to the upside. So I wouldn't be surprised if we see nominal growth in double digits in 2021.
On the monetary side, though, there's still a lot of concerns out there on the inflation front, and what could happen there. We've seen commodities catch quite the rally, the dollar weakening here. You say oil prices could surge to $80 a barrel by the end of the year. Talk to me about what you're seeing on that front and what investors should keep in mind when it comes to inflation.
I think the most important thing is how is the Fed going to react to what's clearly going to be an inflationary spike in Q2. I mean, clearly. It's a rate of change thing. It's a mathematical certainty that we get it because of what happened last year. And they already have an excuse. We already know they're going to claim it's transitory. I think that the sequence that we should be thinking about from a macro perspective is this. Inflation is going to surprise in Q2. The Fed is going to say it's transitory. Inflation expectations, however, which are measured by economic agents responding to higher inflation, are going to respond because I don't think the CEOs or households think that it's going to be transitory. And then in Q3, I think we're going to have some indigestion in the market as the Fed has to start signaling at least a modest turn away from extreme dovishness. Now, I don't think they're going to get hawkish. I'm not saying they're going to start talking about raising rates. I'm just saying in Q3, there should be some indigestion. But then Q4 and then Q1 of next year, the market's going to reset higher. We're in a bull market.
Marco, when you talk about a surprise coming, we're looking at core inflation at 1.4% right now. How significant do you see that spiking?
I think core inflation by Q3 could be between 2 to 3% easily, and then in terms of headline, 5 to 6% even. Look, the Fed's going to have to respond to that, and that's going to cause some indigestion at some point, probably Q3. But I would still think that eventually, how are they going to resolve any market turbulence? They'll err on the side of dovishness, at least until 2023, and that means we're in a bull market. But for investors, what it means is that it might be a shorter cycle than the last one. So waiting for corrections or waiting for momentum and technicals to get healthier, I think will mean missing out on chunks of performance.
Yeah, I mean, obviously, it's an interesting time when it comes to inflation expectations, and obviously going to be a tough spot that the Fed might find themselves in later on this year as well. But Marko Papic, Clock Tower Group Chief Strategist, appreciate you coming on here to chat. Be well. I want to shift our attention back over to a stock on the move here. We've been watching the moves in Canopy Growth as well as the larger cannabis space in general. We're showing here the U.S. operators that strangely have not necessarily caught in the same boost that their Canadian peers have, particularly Canopy Growth. We were discussing that with the CEO of Canopy, David Klein, yesterday. But take a look at some of these moves on the Canadian side. Tilray up another 30% today. That stock is up more than 400% year to date. Incredible moves when you consider the fact that some of these Canadian companies really might not stand to benefit immediately from changes in the U.S. on a regulatory front. But just one of those things to keep an eye on. We've been seeing reports that some of these names have been getting mentioned in Reddit's Wall Street Bets, of course, the forum that drove GameStop stock higher, along with AMC. So interesting to see maybe some retail investors catching in on that, but perhaps misplaced guidance around those names versus the U.S. operator, something we'll be discussing later on in the show. And on the Canopy front, of note, Cowen analyst Vivian Azer, who we've had on the show, doubling her price target yesterday after hours, after we got that earnings update from Canopy Growth. We're going to take a quick break here on Yahoo Finance Live, but when we return, breaking down the updates on the COVID front, why variants have the medical community increasingly worried. We'll chat that. Stay with us. Welcome back to Yahoo Finance Live. A bit of a pro-con situation on the coronavirus pandemic front. As we've been highlighting, cases in the U.S. continue to fall in terms of their daily average count relative to where we were back in January, but still more alarms being raised in the medical community around those new variants. We're hearing now from the CEO of Johnson & Johnson raising exactly the same outlook that we heard from the CEO of Moderna here on this show, that this pandemic could be with us, the coronavirus could be with us for years to come, requiring booster shots for several years. Here to break down where we sit in this pandemic fight, I want to bring on our next guest. Dr. Neda Fadol joins us right now, Associate Professor of Infectious Diseases at the University of Nebraska Medical Center. And Dr. Fadol, I mean, obviously, we're still learning a lot about these variants and increasingly hearing about cases in the U.S., but what do you make of what we know about these and really how it's a lot of the same things we had in place to fight this, just make sure that you're masking and social distancing? What do you make of it?
Well, thank you for having me. I think the important point to recognize is that while the cases decline, and while we're seeing the biggest decline we've seen in the trajectory of COVID-19 so far, the cases still remain higher than what we've seen during wave one, during the surge that we saw during the first wave. And we're still seeing a lot of death from this virus. So even though we're seeing a decline, I think it's a little too early to celebrate and say we're making victory. It's a little too early for states to relax their control measures because we might end up losing a lot of the gains that we made against this virus, because the truth with this virus is that the more it spreads, the more it mutates, and mutations lead to viruses which are more contagious and can spread much easier in the community. So that's what I mean by losing these gains. The other danger of mutations is that we might end up with a virus that is resistant to some of the vaccines that we have right now and some of the therapeutics that we have right now. And that's really going to be alarming. So it's going to take a lot for the science to keep up with the mutations of these viruses, because RNA viruses are known to mutate very rapidly. So we really need to be careful. We need to control the spread of this virus in the community.
Well, I mean, even with some of those cautionary, tales that you've mentioned, we are in fact seeing states as well as cities relax some of those rules. To your point, here in New York City, indoor dining set to begin on Valentine's Day. What's likely to come out of something like that as we see sort of this tension we've seen throughout the pandemic, which is on the one hand, health experts warning, caution, and on the other hand, just this frustration of sort of being restricted for such a long time, whether that is at restaurants or just being asked to stay at home?
Yeah, I mean, this has been really challenging for us, to be honest, as infectious disease doctors and public health specialists, because we feel like that we're the Debbie Downers. We're the ones who are constantly telling people to stay home, to be careful, but we're saying that for a reason, because we really want to go back to normal, and we want to go back to a good normal. We don't want to go back to a normal where we lost a lot of family members and friends along this journey. So that's why we're saying, I know people are tired. I know we want to go back to normal. I know Valentine is coming and we want to have fun, but let's do it carefully. Let's do it very cautiously. It's really hard to tell people to stop everything right now, but we can still enjoy our lives, but do it with a lot of caution and a lot of care to minimize the spread of this virus while we're enjoying it.
And doctors certainly have the right to be Debbie Downers as the ones who are dealing with, this on the front lines. But when we look at what would be, I hear your point on this being a critical time period, because it seems like, you get those vaccines out while they're effective, you reduce the amount of cases and you protect and save lives at the same time. But when it comes to the progress on that front, considering now that we are watching these variants, how important does it become to really throw everything you can in terms of effort in getting those doses out into the arms of Americans right now?
Yes, it's absolutely critical. It's very critical that we get vaccines to people who need them. And it's very critical that we have equitable access to vaccines for those people who are outside of the healthcare system, who don't have access to internet, to computers where they can go to the state website and sign up. We need to get the vaccine to them rather than wait for them to come to get the vaccine. So access and equity in distribution is very important right now, especially considering that minority communities suffered the most from this virus. So we need to do everything possible to make sure the vaccine gets to them and not wait for them to get to the vaccine. And also dispelling a lot of the myth around vaccination in these communities and using the right resources to help get them the right information so they can make informed decisions.
Yeah, education certainly still a big part of trying to get more and more people vaccinated. Doctor, you mentioned in the commercial break that this is the new flu when we're talking about the virus itself. What exactly do you mean by that? And how do you think people should be looking at the coronavirus in the long term, even if we get past the peak, the most difficult stage? Is this virus going to stay with us for a very long time?
I think it's going to stay with us. I think we're going to see these hopefully very small peaks and valleys of the virus. We're not going to see what we're seeing right now, but I think we need to be prepared that this virus is here to stay. We're hoping at some point it's not going to be as lethal, it's not going to be as contagious, but we need to be prepared to be dealing with it for a few years down the line and maybe for the rest of our lives.
Very sobering message there. Dr. Neda Fadol, Associate Professor of Infectious Diseases at the University of Nebraska Medical Center. It's good to talk to you today. Coming up, Microsoft doubles down on the future of remote work. Microsoft 365's corporate vice president joins us after the break to discuss the company's new Viva platform and how it plans to scale the business. We'll be right back. The shift to work from home has led to huge boosts for Microsoft. No surprise there. The company has seen growth accelerate in everything from its cloud business to communication software. And now it's doubling down on the remote workspace with a new platform. Let's bring in Jared Spataro. He is Microsoft 365 Corporate Vice President. We've also got our tech reporter, Dan Halley, joining in on the conversation. Jared, it's good to talk to you. It certainly seems like a timely discussion. Yesterday, another company, Salesforce, coming forward saying that they will now allow their workforce to work from home permanently. Microsoft has been on this track for a while, but walk me through sort of the bigger trajectory you see in this and why Microsoft is doubling down in the remote workspace.
Yeah, sure thing. What a time. We see this as kind of the second big wave of digital transformation that's sweeping over business. The first one, we believe, started with the PC. It included everything from tablets to what we did on smartphones. What's happened during the pandemic, however, is that we've seen that kind of the physical space, the connection that people have has been removed. And companies still need to get work done. They still need to create an experience that binds people together, helps them to team. We have a great set of tools, including what we call Microsoft Teams, that provide kind of an organizing layer for that work to get done. But as we've been working with our customers, what we've seen is those tools alone just aren't enough. They need a way to kind of foster trust, to build corporate culture, to ensure that everybody is connected in a way that they have never been able to do previously with digital tools. And that's what this new platform, it's called Viva, is meant to do. It builds right on top of Teams, provides new experiences so that people can connect and get their work done.
Jared, so, I guess going through Viva, we also have our own internal portal here at Yahoo Finance. And, I may or may not look at it very infrequently, but I guess, is this meant to kind of replace that and provide people with a means to kind of get an easier access to their corporate portal without having to go to a different website or without having to, jump out of the work they're already doing?
Yeah, Dan, that's one aspect of what we're seeing here. So if you take it from the portal perspective, one of the biggest problems we've seen with portals, just as you indicated historically, has been getting people there. I think over time, people have published a lot of really great things in their company portals. The question was, did anybody see it? And so what we're trying to do with Viva is build directly within Teams. As we announced a couple of months ago, we have over 115 million daily active users in Teams. So again, that organizing layer is collaboration, communication, all together in one place. We want to meet those end users where they are, and then inject in essentially that communication that helps them to stay in touch, both with the organization and with other people that matter, other groups that matter. So yes, one aspect of it, as you indicate, in some ways could be thought of as almost like the modernization of the company portal. But beyond that, we also look at well-being. We're also providing things like insights. We're helping people to understand how they work and helping them to increase their performance. So it's much more than just the modernization of a portal.
On that front, you've got a lot of clarity on spending of a lot of your enterprise customers. Certainly, a lot of that has been accelerated over the last year. But I wonder what you're seeing on that front in terms of the investment some of your clients are willing to put forward to really accelerate this remote work environment. And given that Microsoft has a number of the pieces in the stack, do you think that puts you at an advantage?
Well, we certainly think there's an opportunity here. If we take a step back for a second and look at the market, we see that companies already are spending over $300 billion a year on employee experience. So thinking about just kind of how they help their employees get their work done. What we think will be durable post-pandemic in this second wave of digital transformation really is that idea that a lot of the employee experience is going to need to move digital. And the big question is, what's the platform? How do you do that? How do you do that on an ongoing basis? So we look at that $300 billion worth of spend. We think we can help make that more efficient. We can help people create kind of this new layer that will bridge between someone working at home, someone working at the office, and everything in between. That's what Viva is meant to do. So yes, we certainly see an opportunity here. What's most important to us is really getting in the trenches with our customers, understanding what their pain points are, and helping them build up solutions.
Jared, if I'm a regular employee and I'm using Viva, is there kind of a way that I can know what my office can see, what I'm doing? Does my office have greater insight into what I'm doing? In other words, am I kind of being spied on at any point, or is it just different than that?
Boy, that's one of the first questions that comes up, particularly as it relates to what we call insights. So again, Viva has a module that's called Viva Insights. The idea here is that we provide two things through Insights. One is almost like a Fitbit for the individual at work. This allows them to kind of see how they're performing and how they could improve their performance. So as an example, it might say to me, hey, it looks like your calendar's pretty full with meetings. Do you have enough focus time to actually get your work done? It kind of just prompts those types of things, almost like a digital assistant that really is focused in on what I'm doing every day. The second part, as you indicate, is that we take those signals, things that are happening across the organization, and we aggregate them up and allow managers and leaders to see the different trends that are happening in the organization. One simple example there is we can see if people are starting to work more after hours than they have against a previous baseline. Now, the good news is, privacy is very important to us. We believe those data-driven insights will be key to improving performance over the long term. But we also believe that privacy is just a fundamental human right. And so the way that we're protecting it within Viva is we always make sure that the insights are aggregated and de-identified when they're seen by someone around or above you. And we don't aggregate or de-identify until we have at least 10 different sources, so 10 different individuals that we're aggregating together. And that idea of aggregation, de-identification helps us to ensure that we are able to protect people's privacy.
Jerry, last question from me here. In terms of this work from home environment, obviously a bit of a pro con. You can work from wherever, a lot of flexibility, a lot of upside. The con would be, by the same token, you never really leave the office. You got Teams, you got Slack everywhere you go. Your own surveys points to burnout in the pandemic. And if I was any more burnt out, I would be in an urn. So I feel the frustration here. But what does Viva do to maybe protect people on the burnout front?
Yeah, just picking up on that theme, over 30% of people say that they have an increased sense of burnout after the pandemic started. So we definitely see that. If I look at what Viva does here, the well-being insights are really meant to help you with burnout. And in particular, we have some really interesting features that are being introduced. One is a virtual commute, as an example. You may think that you don't miss your commute at all. It turns out that the research shows us that a commute is a really good way to kind of ramp up into your workday and a ramp up out of your workday to kind of have a buffer there and make sure it doesn't bleed into the rest of your life. And so a virtual commute provided by Viva just allows you to take that time to really get your head set. I'm about ready to start work. What do I need to accomplish? What is in front of me? And then when you're ready to stop, to say, hey, I'm going to put a boundary here. What am I going to do the next day, tomorrow? So as funny as it may sound, some of the things, the kind of patterns that we see previously, we still want to help you do so that you can maintain your own well-being and not burn out.
Very interesting stuff. Jared Spataro, Microsoft 365 Corporate Vice President. Appreciate you coming on here alongside Yahoo Finance's Dan Howley. Thanks to you both, and be well. We're going to take a quick break here on Yahoo Finance Live, but when we return, breaking down the moves in Bitcoin, where our next guest, Mike Novogratz, says we could see 100,000 a coin. We'll chat that. Stay with us. Welcome back to Yahoo Finance Live. As we see all three major indices in the red, interesting to see Bitcoin holding their gains this week, of course, sparked by Tesla's $1.5 billion investment into Bitcoin. And our next guest says companies joining in on that move could spark another doubling for the crypto, in prices jumping up to potentially $100,000 a coin. Very happy to welcome back to the show Mike Novogratz, a man who gave up his cushy life running a family office to found and become the CEO of Galaxy Digital. He joins us right now. Mike, thanks again for coming on, man. I know we've talked a lot about Bitcoin being digital gold, and a company like Tesla putting it on its balance sheet is an interesting hedge away from cash, but you also talk about it being quite a big marketing boost. So what are you hearing from execs maybe looking to follow Musk in doing the same thing to say, look, we believe in the potential of Bitcoin?
Well, listen, I think you now have Jack Dorsey, Michael Saylor from MicroStrategy, Elon Musk have all put Bitcoin on their corporate balance sheet. We did it 3 years ago when we went public up in Canada. And so, 3 becomes a movement in general, right? And so Michael Saylor actually hosted a conference with like 2,000 corporate CFOs and CEOs last Thursday, where he laid out exactly what MicroStrategy did on how they thought about and went long Bitcoin on one day. And then the second day, he had guys like me come and talk about what our companies could do for these guys. And, you put 2,000 people, at times there were 10,000 people on the line. Somebody is going to say, hey, that seems like a good idea. And so I think you're going to see a movement around corporate treasury for 2 main reasons. One is the dollar continues to be debased, right? Asset prices are going higher. And so you're protecting the value of your corporate treasury. Now, in general, corporate treasuries are shorter term duration. And so you wouldn't be advocating to put all your money into Bitcoin. But I think you'll see CFOs put some of corporate treasury in Bitcoin. What I also talked about was listening to your customers, right? Bitcoin and cryptocurrencies are the currencies of choice for Gen Z, for millennials, for younger people in this country. And so if you're almost tone deaf to say it doesn't matter, right? It matters to them, right? Now, 30% of Americans own some piece of a crypto. And so it's becoming almost a negative if you don't do it. You're going to see more and more companies, like Tesla said, we're going to allow you to buy Teslas in different cryptocurrencies. Like, it will be insane if you're McDonald's or Bojangles or all these other companies and you don't move the same way. And so I think you're going to see this big movement of corporates, and that just adds to the fuel in Bitcoin.
And, Mike, I guess the follow-up to that would be, for a while, there was a debate about what exactly Bitcoin is, whether it was a store of value or it was actually a currency that could be used for payments. And it feels like we've sort of moved away from the payment side until we got that announcement from Tesla. Do you think that ups the case for that? Or ultimately, is it really just a digital asset that you don't see sort of being transactional on an everyday basis?
I don't see Bitcoin being transactional. I see it being a digital store of wealth, right? A digital asset. I think there are other cryptos that will fight and win in the payment system, right? Bitcoin is going to come out with Diem, which is a US dollar-backed stable coin, and they're going to try to dominate payments, right? There's USDC. There's all these coins that look and feel just like dollars because they're basically dollars wrapped in tokens. That are going to come and participate in that. What's unique and why that's positive for Bitcoin is it's the same wallet, right? We're going to move from a world where your money's held in a bank account to where it's held on a wallet on your phone, and not just your Bitcoin, your stock certificates will be there, your tickets to concerts will be there, and your money will be there that you used to transact in, and you'll be able to flip, seamlessly between them all. That's coming. That's where the big battle is going to be. That's why PayPal got involved, right, with their 330 million users. And so one of the most interesting things to watch over the next 3 years will be that fight over payments.
Well, I want to get into, the decentralized finance space too, and particularly payments a little bit later on in our interview. But I also want to go back to kind of that idea, because Bitcoin, as you've talked about so often, the social construct around it has really been what people have bought into, the idea that this is a stable thing. If you want to go with the digital gold route, which I would agree, payments necessarily haven't played out the way that some people had talked about earlier on. But with Bitcoin, how does that maybe drive the whole space in general once you become comfortable with, the idea of putting dollars into Bitcoin that way, what it does to drive adoption in the rest of the crypto space? As myself, as someone who received Bitcoin first back in 2014 as a gift, it kind of triggers this understanding in the general space. So how do you see it spilling over if we do see Bitcoin 100,000?
We're seeing that same journey happening, and it's happening faster and faster. So the journey is somebody convinces you to buy Bitcoin, and it's very confusing. You put some Bitcoin in, it starts going up, you get excited, it goes down, you get nervous. And after you make a little bit of money in it, you're like, well, what else is there to look at? And then you start looking at Ethereum. And Ethereum has got a different use case than Bitcoin. It's right, building this global decentralized supercomputer that processes information on this big blockchain, right? Processes and verifies information. And so you're like, wait a minute, the world's going to be built on this. And so then people put some money to Ethereum. And then the final step is what's going to be built on top of it? Oh, all these projects. We're going to have driverless banks. We're going to have driverless insurance companies. We're going to have, if you think about what DeFi is, it's the driverless bank. And so, there's a little more risk on each step of the way because we're a little bit more less mature, right? Bitcoin's got a mature macro asset now. It's in macro portfolios all over the world. There's no changes to the Bitcoin protocol that are going to be happening anytime soon, right? So you know what you get. Where Ethereum is still being built on the fly. It's being built at a rapidly accelerating pace as more and more people participate in it. And the DeFi stuff is really kind of venture sandbox stuff, right? This will be the future in 3, 5, 6, 10 years, but it's not the future today. And so you move across that spectrum and you move higher up the risk spectrum.
Mike, going back to your comments there on Ether, I wonder, with CME futures launching, how far do you think that goes in sort of growing Ether to being accepted, if that's the right word, in a bigger way? I mean, how significant is that move, you think? And ultimately, does that accelerate the adoption?
I think it certainly accelerates people getting excited about it and price going higher. What will accelerate Ether's adoption, and Ether in the long run will be valued, just like Facebook got valued as a network. So the more people that build on it, the more people that transact on it, the more people that are part of the Ether community will drive that price up. And so you can look at that chart and you can look at adoption of Ether, and they should be really correlated. I'd be lying to say there's not some store of value in Ether, right? Some people look at it as silver to Bitcoin's gold. I think it's the wrong way to look at it, but who am I to tell people how to look at things? And so, we're in such an early stage of this revolution. You'll have people buying it just because they have no idea how to value it, and they're going to hold it here. It will be an unbelievable, valuable piece of architecture if it fulfills its promise of being this global decentralized trust level.
Yeah, we've heard a few people call for 10,000 already on Ether. That was from Fundstrat. When you look at it too, just real quick, and we want to squeeze in a break, but real quick on Ether, around the futures that Akiko's talking about, we saw a big bust with Bitcoin after futures became tradable. And now that Ether has those too, I'd be curious to get your take on maybe where Ether's price goes.
Yeah, so listen, when Bitcoin future came out, it was literally the peak of the mania in 2017. And it was one of the most poorly timed events. I think there was a lot more of the coincidence than causality in the crypto market, collapsing there. It was regulation showing up. It was also, there was no real understanding what was going on in the space. And so every coin was the next Bitcoin. And you just had this giant supply response to the excitement, and then it collapsed. We're in a very different place right now. We had 0 institutions participating in 2017, literally 0. And today we've got institutions from insurance companies to hedge funds to high net worth and asset management all participating. And, so I think the adoption of the ETH future on CME will happen 10 times faster than the Bitcoin future. And I think it'll be a positive for the price, not a negative for the price, given that listen, it's a little frenzied in the last week or two. And so you could have a correction, but we're not in the bubble. We're living in a revolution now, and we're in early innings of a revolution. Where I in 2017 said this was a speculative mania, it was a bubble. I don't think it is this time. I think we're really seeing real capital, real human capital. And I can tell you, at my own company, we are hiring some of the most talented people I've ever worked with almost daily. We will have hired 40 people probably in the first 5 months of the year. That's not because we're crazy; it's because we're seeing all kinds of business come in.
Yeah, no question. You're seeing significant growth there. Mike, we've got much more to get into here. We're going to take a quick break and pick up the conversation on the other side. We'll be right back. Welcome back to Yahoo Finance Live. We are back with Mike Novogratz, Galaxy Digital founder and CEO. We've also got Jared Blickery now joining in on the conversation. Mike, before we went to break, we were talking a lot about your investments in actual cryptocurrencies, but of course, Galaxy Digital invested in the infrastructure side as well. You've got investments in about 80 countries globally. What's catching your eye right now, and what's the real focus in terms of where you determine your money or where to put your money?
Listen, we've been investing, a long time. And so we've invested in exchanges and custody and all kinds of parts of the ecosystem. What's nice is now a lot of those investments are, they're up in value, they're paying off. There's a consolidation going on in the space, right? Coinbase is getting ready to IPO or not IPO, but to direct list. And, with SPAC mania, lots of the portfolio companies are being, sought out by SPACs. And so that's a hardy part of the business. Where do you put your money today is a different conversation, because a lot of the valuations there have gotten pretty rich. And so what we like to do is look for the best young developers building new programs, new projects. And so it's really mostly in the DeFi space, not only, but mostly in the DeFi space, trying to put startup capital and seed capital into the best projects we can. And so we've got a team that, tirelessly looks through, business plans and meets founders and tries to convince them. And it's interesting. It's not the capital that matters. You've got to convince them that you're going to bring value to their company, because there's lots of capital chasing projects. And so that's really where the new investment dollars go. Listen, there's a big growing credit business at Galaxy. And so having, capital to lend to creditworthy lenders, both in the mining space, in the trading space, is important. When you have this much activity going on, there's just opportunity everywhere you look. And so I think for our longer term investing dollars, it's the smaller groups of really smart men and women that are building projects. But for the broader firm, we're all over the place.
Well, it's interesting to hear you talk about that too, because you said you founded Galaxy, as a bridge between institutions and the crypto community. And I liked your joke that you said eventually decentralized finance might put you out of business as we see more projects like this, attract attention. It was interesting to see you throw 25 million, Galaxy throwing 25 million into Terra Protocol, one of those interesting DeFi payments projects right now. Is that the hottest space when it comes to DeFi? I mean, there's a lot of different things going on with yield harvesting. You got Terra here. What has you most excited about maybe that next project that's easy to understand, that's going to get attention?
What was interesting to me about, Terra, and the Luna token and the Terra project was that Korea, that's where they're based and where they started, is always an early adopter, right? They had internet access before anyone else did on a high speed level, and so you're an early adopter there. And I always say the DeFi space is a sandbox. This was like one of the first guppies that became a frog. It jumped out of the sandbox and actually is being used in real world payments, right? The Chai payment system, they jump started it, and now it's starting to, gain market share. And so it's really interesting. It's one of the first, protocols that you're seeing have an impact in what we call real world, right? Because I really believe in 5 years' time, most people aren't going to care if it's a blockchain-based system. They're going to look at the user interface. Is it cheaper? Is it faster? Is it more transparent? Is it more fair? You're going to win customers over by building a better product. All the blockchain stuff is going to be the back of the TV. Like when you watch TV, you don't know who cares how the TV's made? It looks good, right? And so for us, geeks and crypto people, it's a big deal. But really for this revolution to work, the consumer's not even going to know they're playing on a blockchain-based system. Right. And so I think Terra is a really cool example of one that's making that jump.
Hi, Mike. I wanted to get your take on the regulatory side, kind of circling around, albeit the boring side. But we got Gary Gensler at the SEC. FinCEN had some regulations coming out at the end of the year, caused some consternation. We got the Ripple suit. How does all of this portend for the coming year or 2 years in blockchain-based and crypto-based currencies, especially considering that we've been on pins and needles here for years waiting for a Bitcoin ETF in the US?
Listen, I think it's an exciting time for the space. I am thrilled that Gary is the head of the SEC. Full disclosure, we worked together at Goldman Sachs back in 1997, 98. It tells you how old I am and how old he is. So he's got more hair than I do. Not much. Listen, Gary taught a class on blockchain at MIT and on crypto. He understands it cold. He is progressive, right? And progressives broadly are going to go after, you would think, go after the rent takers. Crypto is not a rent taker, right? Crypto is trying to disrupt the rent takers. So I think philosophically he should be biased positive, but he's also, tough. And so when he's going to, look at, the Ripple XRP thing, he's already kind of commented when he was at MIT on what he thought about it. And it wasn't, friendly. He said, smells like a duck, quacks like a duck, looks like a duck, it's probably a duck. And he was, referencing if it looked like a security. And so I don't think he's going to be a pushover for our space at all. I think he's to be fair. My guess is we get a ETF this year, right? Right now, the next best thing is the Grayscale Trust. It's a giant, $20, $30 billion ecosystem now where retail investors buy at a 20 to 25, 15% premium and pay high fees. Mm-hmm. That's, if the SEC's job is protecting the little guy, that in no way is protecting the little guy. Like they wouldn't let an ETF in this space, but they'd let that in this space where hedge funds arbitrage retail. Again, if I'm Gary Gensler, I'm like, well, who thought of that was a good idea? And so my guess is the ETF comes out pretty quick. The FinCEN comments were also fascinating because they had a 14-day comment period, which is not normal. It's usually 40-day. They were so overwhelmed with comments and quality comments and well thought out comments. Every single crypto business I know, put a comment into the space, but people we don't know, thousands of them did, that they had to say, whoa, wait a minute. And I think there's something really unique in this shifting right now. Crypto is becoming a political story, right? Mm-hmm. Imagine you're a politician and you say, screw Bitcoin. Well, there are a lot of single voter issues, right? 30 million Americans own Bitcoin. And when you look at Gen Z and millennials, a lot more as a percentage, 60% have some access to crypto. And so I think politicians are going to be much more careful about how they talk about crypto, what they say about crypto, how they regulate crypto, because they don't want to have their voters turn on like the swarm. FinCEN got hit with the swarm,
And I think, as you said, in your discussions with Gary Gensler, it sounds like he's kind of in that same boat in your discussions with him back during those lectures on crypto at MIT. But I appreciate you coming on here, man. I love having you. One of the greatest voices in the space, Mike Novogratz, Galaxy Digital founder and CEO. Thanks again for coming on. Hope you come back soon. All right, we're going to take another quick break here on Yahoo Finance Live, but when we return, we'll have all the big other market moves outside of the crypto space for you right after this. Stay with us. Welcome back to Yahoo Finance Live. Some interesting action in the broader indices today. Pretty big 200-point swings to discuss here, at least on the Dow. For more on that, I want to bring on Yahoo Finance's Ines Ferre, as we see all three now in the red. Ines?
Yeah, that's right, Zach. Earlier on, we had record highs for the major averages. Now we've got the Dow that is hugging the flat line. You've got the Nasdaq that's down about 0.5%. The Russell 2000, which has really been the outperformer this past week, down about 0.2%. Looking at one of our trending tickers, General Motors, down more than 3% after its quarterly results. The automaker warning a semiconductor shortage could cut into its earnings. And then if we just take a look at the NASDAQ 100, seeing some of the action there. Tesla down more than 4%. We haven't seen that for a while. Also taking a look at Cisco, that stock is down after some concerns over the company's infrastructure platforms business. On the sector action, we've got energy and real estate, which are out for performing, and consumer discretionary down. You've got Amazon that's down more than 1%. Zach?
All right, Ines Ferre, appreciate that. We're going to take another quick break here on the show, but when we return, breaking down the update in the streaming space as we await Disney's earnings tomorrow. We'll chat that with the co-founder of Netflix, joining us once again right after this. Stay with us. Welcome back to Yahoo Finance Live. I'm Zach Guzman alongside Akiko Fujita, as we are seeing all three major indices here in the red in today's session. A bit of a day of perhaps profit taking here, and some of those big gainers, including Tesla, moving to the downside. Also want to spotlight that we are, of course, waiting Disney earnings tomorrow. A big update coming there in the streaming wars. We'll be chatting that in just a second with the co-founder of Netflix. Also want to highlight an interview coming up in the back half of today's show with Tenable, the CEO of Tenable, announcing a pretty big investment in the cybersecurity space, as we've seen hacks there across the country, raising new issues on the cyber front. We'll dig into that in a little bit later on the show. But as I said, kicking things off here in the noon hour, discussing the updates around Disney's progress as they continue to add an impressive amount of subscribers in this pandemic. For more on that, I want to bring on our guest here today with us, the co-founder of Netflix, Mark Randolph, joins us now. Once again, welcome back to the show alongside Yahoo Finance's Alexander Canal. And Mark, I mean, we've talked about this a lot. The story's not going anywhere. But when you look at maybe where we're at now in this inning of the streaming wars, what do you make of what you're seeing in the tit for tat between Netflix, Disney, and all the other entrants now coming into the space?
Well, Zach, we certainly have been seeing a lot of things going on in the last few months. And probably the closest analogy I can think of is it feels to me like a presidential primary debate where we have 40 people on the stage. Everyone's fighting to be heard. You have the big contenders mixed in with the who knows who the hell these people are. But what I think has been happening in the last few months, which is actually interesting, is I think we have our front runners. It's pretty clear, at least to me, that of course Netflix is going to be one of those, but I think Disney has really fought its way up into a really, really strong position. We have the dark horse, we have HBO Max, which everyone's wondering, are they going to be able to pull it up and go neck and neck with the leaders, or are they going to drop back? And then you, of course, have the candidates who haven't even announced yet, like Paramount Plus coming out. But what I really think is happening is we're kind of seeing the new rules of the game developing. This is not just announcing. This is not just having a promotion. What you have to demonstrate is that you've got the content. And not just a few things. You've got to have a continual slate of tentpoles. You've got to have a continual slate of new things coming out. It's really saying this is a war of people who are prepared to make the content.
Mark, you said it sort of feels like a presidential election or sort of this race or not. I mean, I was thinking to all these launches that have happened, and it starts to feel like we're going back to the days of cable, except we're just paying for individual channels because there's so many different options out there. You talk about diversity and content being key, and I wonder how much, when you look at something like a Netflix that has tended to do not just movies, series, but also more documentaries, whether that's sort of the strength of the platform, or something like Disney, which has pretty much been on brand in the content they pushed out. How do you think they win over some of these viewers out there who are still sort of only dabbling in one or two streaming services?
Well, I think what's going to happen, of course, is there is going to be a consolidation. I don't necessarily mean industry-wide, but certainly consumers are going to settle down on the 3 or 4 or maybe 5 streaming services that are their primary outlets. And I think you're correct. Netflix has a big leg up in terms of its diversity. And it's not just diversity of genre. It's also their geographical diversity and the tremendous slate of content which is non-U.S. originated. But, listen, Netflix, I think, is announcing 70 movies for the next year. I mean, that's more than Disney and Warner combined. The people who are going to have a problem are the ones who are trying to fit into a niche. I mean, you look at Discovery Plus, which I think was the number 2 downloaded app in the last month or so. I mean, they're really trying not to own the blockbuster tentpole stuff. I think they're going for treadmill TV. I got to write these down. They have Amy Schumer Learns to Cook Uncensored and Judi Dench's Wild Borneo Adventure. I mean, how does that compete with The Mandalorian? Yeah, I don't know. I guess it correlates to Peloton sales.
And to that point, Mark, I want to bring up Apple TV Plus because it seems like they are just falling way behind because they came around right around when Disney Plus launched and they just haven't seemed to do much of anything. In fact, right now they seem to have a bit of a freeloader problem because if you go to an Apple store, get an iPhone or an iPad, you automatically get a free year of Apple TV Plus. But reports say that they're having trouble converting those users into paid subscribers. So what can they do better here?
It is such a mystery to me. I think if Apple spent 1/4 as much time on content as they do on giveaways, they really could play. And they really have no excuse. I mean, listen, they have a $2 trillion market cap. They have $200 billion in cash, but they are still not in it with both feet. They have really got to do the entrepreneurial thing, and they've got to walk up to the edge of the cliff, and they've got to jump. Right now, they have the highest churn rate. You can't keep replacing people. You've got to give them a reason to stay. This is absolutely a game of what have you done for me lately? And Mandalorian is not going to hold people forever.
Well, what's interesting is that in our earlier discussions on this, you've raised that Netflix had a secret weapon in this, right? And that it was that they were squarely focused on streaming. And we raised that when we were talking about what Disney could do. If there was one area that maybe they've proven a lot of people wrong is that apparently they can focus on streaming, especially maybe it's because their parks are closed, but they have really focused in on it. They've delivered some pretty serious results. To Ali's point on the Apple side, maybe there is some truth to that point where, if the attention isn't there, it's not going to work to take on a Netflix. What's your take on that?
No, I completely have the deepest respect right now for Disney, because when we began speaking about this, which was almost prior to the Disney launch, I said that Netflix's advantage was that they were focused on streaming, whereas Disney was distracted by theme parks and cruise ships. But they have really demonstrated their in. I mean, if you look at their investor day from a few months ago, they have really said from now on, content is going to be targeted first and foremost towards streaming. They've restructured their company to focus it on streaming. They've said they're going to defer dividends to be able to focus more on streaming. But, you know, this is really in my opinion, a pretty clever move, because what they're in some ways doing is emulating the Netflix playbook. We have the earnings announcement, of course, tomorrow. And I think what's wonderful for Disney is people aren't necessarily going to hammer them on what their earnings are this quarter, because Disney has said very much that they are just basically trying to put themselves in a position to ride this build out of the streaming business. They're saying that we're going to be in this recurring revenue business. And both of those are very strong statements. I mean, Disney has said that they're going to be at what, 300 plus million by 2024 when you take all of their services combined. I mean, those are pretty significant numbers.
And Mark, how strong do you think the pricing power is at Disney Plus? We've seen more premium VOD options like Mulan and Soul come to the platform for that $30 fee, but is that sustainable in the long run?
You know, I'm really not sure. I think eventually you're going to have to fall in line and have a standard monthly fee, which is in line with what you're seeing from Netflix and the other services. You're going to have some sort of bundle, pardon that term, where it does bring it all together. I'm really not sure how this excess fee for their big tentpole content is going to play out. It seems like a strange thing, but hey, that's what makes this fun, the opacity of it all.
Mark, let's talk about your latest podcast here, launch. This Will Never Work. I mean, this is a really crowded space increasingly. It feels like, I mean, I consume a lot of podcasts, but it feels like we've sort of reached a saturation point here. Where do you think this is all going at a time where you've got sort of the conversational podcast, the news podcast, and then you've got the scripted podcast that seem to really be gaining momentum? How do you see this industry as a whole and its potential to grow even beyond where it is right now?
Well, the first thing I have to say is I'm the first person who is saying, why on earth does the world need another podcast? And certainly, why do they need one from me? But what's happened is I've been doing what I've been doing for 15, 20 years, which is mentoring early stage entrepreneurs, helping them get their business off the ground, turn their side hustle into a real gig, turn their real gig into a sustainable company. And I do this with phone calls. I do this with Skype sessions. I do it on Zoom. And what's different is about a year ago, I began recording those calls. And I realized that not only am I helping these people, I'm actually creating something interesting. And what I wanted to do is have something that people could listen in as to how a small entrepreneur can make progress. These aren't interviews with people who have tamed the world. I'm talking to everyday people. I'm talking to people who have their feet on the ground starting out. And I think, as far as I can tell, there's not a lot of that. And certainly, based on the response I've gotten so far, I think I have tapped into something which is pretty interesting. I'm not looking to be the number 1 or 2 podcast in the world. I just want to create something which actually helps some people. And I think what I've done is going to work.
As I said in the past, I love the book too. We see it in the background by the same name, That Will Never Work. And it's, along the same lines of a lot of good tips in there for entrepreneurs. I'd be curious to get your take too on, as a man who turned down, right, in the Netflix buyout opportunity or investment from Amazon, Jeff Bezos, kind of your take on maybe your advice to entrepreneurs who are maybe weighing the SPAC route. We've seen a bunch of those here to start the year over IPOs. What would maybe be your advice to people weighing that decision? Because there are some legitimacy questions around going the SPAC route versus the IPO. What's your take?
I think a lot of people are going into these big liquidity events, and whether it's an IPO or a SPAC, it's the same. You really have to know what you want, and you have to be doing it extremely consciously. Just last night, I was advising an entrepreneur who was trying to judge that, and I said, if you have a very, very concrete reason for doing this, if you really need the currency, if you really need the capital, and those are the only ways to do it, and you can't get out with an IPO, then sure, an SPAC does give you some advantages in terms of being able to get the liquidity you're looking for. But quite frankly, going public, being a public company restricts your ability to be versatile. It restricts your ability to take a few quarters to figure things out. It changes your ability to do what Netflix did multiple times in its past, which is walk away from a current business because you knew that was not the future in order to bet on something else. And I think that is the advice I'd give is be careful what you wish for. These are dangerous things to buy into. When someone gives you money, they're not doing it because they like you. They're doing it because they want that money back, and ideally times 100.
And Mark, keeping up with the theme of you being told that will never work, once you've actually started a business, what is the worst advice that you've ever received?
Stay the course. One of the things people get stuck on is I've got to keep going on the hammer on this idea until I make it work. And certainly what I've learned over and over and over again is that there's no such thing as a good idea. And that if you take that first swing at it, if you try something and it doesn't work, you have to try something else. And it's all about falling in love with the problem, not falling in love with your idea. And over, certainly the people that I advise on the podcast, so much of it is, number one, get started. Figure out a way to take your idea and get it out colliding with the real world. But then the second one is, as soon as you learn something about why your idea is bad, move on.
Well, Mark, I'm going to take that advice to heart, go listen to your podcast, and then potentially think about launching my own podcast, right? Because the space is not saturated enough. Mark Randolph, the co-founder of Netflix. It's always good to talk to you. Thanks so much for your time today.
A pleasure being with you. Thanks a lot.
Coming up, House impeachment managers begin their oral arguments in former President Trump's second impeachment trial. We've got a live report from Washington, plus the impact of President Biden's relief package on the business community overall. Boston Consulting Group CEO Rich Lesser will join us. That's after the break. It is day two of former President Trump's impeachment trial. Oral arguments kicking off just a short time ago. Jessica Smith has the very latest for us from Washington. Jessica.
Yeah, the House impeachment managers today are presenting their case, explaining why they believe former President Trump incited that deadly riot on January 6th at the Capitol. You're seeing lead impeachment manager Jamie Raskin speaking now. And in the past few minutes, he has said that former President Trump assembled and inflamed his supporters and directed them to go to the Capitol to stop the certification of the Electoral College votes. He says he also abdicated his duty to stop the violence. He says that they are going to prove over the course of their arguments over the next few days that President Trump was warned of possible violence. He was not an innocent bystander. And again, the main point of all of this, that he incited this attack that left several people dead. Now, each side has 16 hours to present their cases. It doesn't look like they're each going to use all of that time, but this could stretch into next week. At this point, it does look unlikely that 17 Republicans are going to vote to convict the president. That's how many would need to join Democrats in order to convict him. Just 6 yesterday voted that the impeachment trial was constitutional. So we'll see if their votes on that issue differ when it comes to acquitting or convicting the former president. The impeachment managers are expected today to show never before seen video of the attack. So we'll keep an eye on that and what else they have to say throughout the day before President Trump's lawyers are able to make their defense.
Yeah, Jess, the other issue we're watching play out here at the same time this is going on is the stimulus discussions we've been tracking, and what maybe is the related effects of this back and forth between Republicans and Democrats, because we know Democrats have been pushing that reconciliation pathway. So how is it looking on the stimulus front now?
Right. House committees this week are all focused on COVID relief. They are starting to craft their section by section of this relief bill. So each of these committees are working on the provisions that fall under their jurisdiction. Today, 4 different committees are holding markups on these issues, including the House Ways and Means Committee. That is going to deal with several really important provisions like stimulus checks, unemployment benefits, and the expanded child tax credit. We did hear from the top Republican and top Democrat on that committee today. The top Republican, ranking member Kevin Brady, bashed the plan, focusing in on the minimum wage hike, stimulus checks, and boosted unemployment benefits. Let's watch.
Why should anyone get paid more by taxpayers to stay home than to get back to work? There is a third round of stimulus checks that many experts admit are probably more a political stimulus than an economic one, costing nearly $500 billion. These checks do little to help Main Street businesses survive or get people back to work.
Anyone who thinks we'll recover without intervention isn't paying attention. Unfortunately, too many Americans have been left behind in this haphazard, every state for itself response to the crisis at hand.
Now, early this morning, the House Labor and Education Committee did pass their portion of the bill, which includes the $15 minimum wage hike that would be in effect by year 2025. It also had billions of dollars to reopen schools, billions for college, and several other labor and education provisions. These provisions, these bills, once they get out of this committee, will go over to the Budget Committee before it can make it to the House floor. The goal is to get all of this done before mid-March. Akiko.
Okay, Jessica Smith bringing us the very latest there from Washington. Certainly a very busy day there. Let's bring in Rich Lesser. He is the CEO of Boston Consulting Group. And Rich, Jessica, they're laying out a number of priorities that has been laid out here in that $1.9 trillion stimulus package. What's the knock-on impact that you've been talking to your clients about if this relief package survives in its current form?
Well, I think there's still a long way to go to know exactly what the relief package will be. I'll just start with the thing that is the most important now. Everything we can do to get beyond the pandemic as fast as possible, anything that will accelerate distribution of the vaccines, uptake of the vaccines, is not only going to save lives, first and foremost, it's going to accelerate the rebound in the economy and put Americans back to work, and just create the foundation for the future. So for me, everything in the stimulus related to helping us get beyond the pandemic is job one and urgent. There's certainly a lot of Americans suffering, a lot of American businesses that are struggling, and we need to also go out of our way to help them. I think most businesses believe additional stimulus is appropriate. The levels you'll get a wide range of views on. To be honest, our view is that the economy, we're optimistic about the economy in general as we get to the latter half of the year, and certainly stimulus should help accelerate that.
Yeah, and Rich, you've been pretty outspoken about the role of businesses in these discussions, particularly when it comes to climate change, but also on the stimulus front here. When you look at, those relationships, we obviously saw President Biden talking with business leaders, including Jamie Dimon, about that earlier this week. So, I mean, what maybe would be what's the worth of the political capital and really pushing on this versus some of the other issues? And maybe it's not a zero-sum game.
Well, yeah, it's for sure not a zero-sum game. We have a wide range of issues we need to tackle in this country, and it's not you either do one or you do the other. I think stimulus is the issue right now because we're living in the midst of a pandemic. It's hurting a lot of people in health and in livelihoods. But as soon as we get beyond this, I hope our attention's going to turn to some critical longer-term issues, whether it's around climate, whether it's around infrastructure, whether it's around education, the digital divide. I mean, we are not short of issues that we need to tackle where I think business can play an extremely constructive role to try to look for solutions that are practical, that can work, and that can maybe help bridge some of the intense divide that we see in Congress right now.
On the climate issue, I know you've been a key advisor to the CEO of Climate Leaders, or the Alliance of CEO Climate Leaders, and you recently pushed out a letter calling for more aggressive moves to reach net zero emissions. When you think about the conversation around this issue, how do you think the calculation for a lot of these firms has changed, given not just the climate warming, but also given that this administration has made it pretty clear they plan to go after businesses if they don't treat the issue more seriously or come up with more mitigation plans?
So I think you have three things coming together at once, and you see it not just in the US, but around the world. First, I think the urgency of climate change continues to get more and more attention. And I think that companies are realizing in a world where they are talking about purpose or talking about supporting multiple stakeholders, you can't even start on that agenda unless climate is a big part of it. I think second, companies are realizing from the standpoint of their own business models, their own ability to thrive in the medium and long term, incorporating climate into their strategies and plans, whether it's Mary Barra's announcement for GM or whether you see many other companies, is critical. And third, I think the political equation has changed, and it's changing around the world. It's changing in the EU, it's changing in China, and now we see it changing in the US. And if you put those three elements together, multi-stakeholder orientation, your business strategy and need to thrive in the long term, and the political calculation, I think many companies realize now is the moment you need to step up more, and we're hearing that and seeing that.
Yeah, especially in a time where we've been so divided. Interesting to see all these other interests coming together around that issue. But the CEO of Boston Consulting Group, Rich Lesser, always love having you on. Appreciate you stopping by. Be well. We're going to take a quick break here on the show, but when we return, breaking down today's market action and what it could mean for the months ahead. Volatility playing out today in today's session. We'll break that down on the other side. Stay with us. Welcome back to Yahoo Finance Live. As we continue in today's trading session, we still have all three major indices currently in the red. As we were discussing earlier on in the show, obviously inflation going to be playing a larger role and potentially putting the Fed in a tough spot as we see policy actions play out here in 2021 and inflation expectations rise and the hopes or potentially the possibilities, I should say, of rate hikes pull forward. For more on that, I want to bring on our next guest, Michael Aroney is Chief Investment Strategist, U.S. Spider Business at State Street Global Advisors. He joins us now. Michael, thanks for taking the time to chat here. I mean, in your note, you kind of highlight the Fed could make one of two policy mistakes, perhaps more possibly going to see them maybe repeat maybe the issues we saw back in the taper tantrum. So, I mean, it sounds difficult, but where do you see this playing out, especially as volatility is expected ahead?
Well, if you think about it, the Fed could make a policy mistake in two ways. One, they could tighten prematurely. I think that that's not likely at all. So that leaves the other path for a policy mistake. And that could be they could let things run too hot from that standpoint, kind of continue to inflate perhaps a bubble in asset prices and really cause a potential risk for markets down the line. Now, this morning, CPI came in kind of below, well, came in line with expectations, but year over year numbers were just 1.4%. So continues to suggest a very benign inflationary environment. Yet what's interesting, Zach, is that break-even rates are creeping up higher and higher, north of 2%. All this suggests is that investors are expecting 2% or more inflation per year for the next 10 years. We're not even close to that. And the Fed has suggested they're going to let the economy and inflation run hot. So you could see that another kind of asset bubble begin to form. And really, the ride up is fun. It's exhilarating. But when it pops, when it bursts, it can be problematic.
Michael, we had a guest on earlier who said that just the opposite, which is that his concern is that inflation is coming fast, much faster than you anticipate. But to your point, we're still at 1.4%. We've seen this really healthy debate that's come through on the issue of how inflationary President Biden's stimulus package is likely to be. Which side do you stand on? And what are those who are saying inflation is the big risk? What are they getting wrong?
There's still a lot to kind of consider in terms of the stimulus, and the jury's still out in a lot of ways. Maybe it's a little funny I use jury as we're doing the impeachment trial, but I think at least in the near term, there's cyclical parts of inflation measures that remain fairly benign. So rents are certainly not picking up speed. The labor market continues to be challenged. So, unemployment, jobless claims remain elevated. So you're not seeing that flow through on wages per se. Things like the output gap remain wide. So things like capacity utilization still are low. Those all need to improve dramatically in order to see inflation. And then you see that there's structural kind of longer term challenges to inflation. Rising debt, wider deficits as a result of that growing debt, aging demographics, which limits consumption or puts a weight on it, and the disinflationary forces of technology. So I think both the cyclical and secular make it hard to make the case that inflation is going to run too hot anytime soon. And just quickly, the Fed, if you look at their summary of economic projections, they don't anticipate the inflation rising above 2% over the long term. So the stimulus is a question mark. Will it finally unleash that pent-up demand? I'm not so sure.
Yeah, Michael, the other thing too, we talked a lot about froth, and people throw the bubble word around. We'll say froth in some areas of the market, whether you look at IPO names, SPACs, or even the cannabis side of the market, which we've been discussing here. For investors out there looking to play this, I mean, is it smarter to maybe play those names that have been beaten down? I know you highlight maybe the aerospace and defense opportunities here. Boeing still down by about 40% when you look back a year. Talk to me about if that makes more sense, if there is kind of risks of froth, maybe you just play those beaten down names. What's your take?
So one of the things that's interesting is if you buy into this idea that interest rates and inflation are going to rise as the economy and earnings rebound, and we can put the pandemic behind us. So under that scenario, you have interest rates rising. That poses three risks to asset allocation, to portfolios. One, it impacts your valuations, particularly on your growth names. The second thing it does is it weighs on your bonds, your fixed income investments. And third is the correlation, the way these things move in tandem has shifted due to all these central bank distortions. And so what's interesting here is in order to combat that, one of the things to do is invest in things that are not correlated, kind of your anti-bonds. And Zach, what's interesting here is that is your cyclical value sectors and industries. It's your dividend payers, it's your financials, it's value, it's energy companies. And those are the things that are catching a bid. So I do anticipate over the next 12 to 18 months, as the economy and earnings recover and the pandemic gets pushed behind us, that some of these reflationary trades will maintain market leadership.
But when you look at a company like Boeing, you certainly make the case that, sure, when activity starts to pick up, their business could pick up too. And yet we saw yesterday that their cancellations are still outpacing sales. So what is the case to get into Boeing at this price point now? Is it a purely valuation play, or do you see more upside that maybe has not surfaced yet?
Right. So, Kiko, the note is around this idea of surprises. And I think kind of as you're underscoring, it'd be a real surprise if Boeing could finally put the 737 MAX, some of the other challenges it faces behind it. It's really struggled to do that. So the whole kind of outlook in terms of aerospace and defense is this idea that they are unloved, creating a compelling valuation opportunity, that they've underperformed. So not only as Boeing, but the category has underperformed markets pretty notably over the last 12 months. Funds that track aerospace and defense indexes have seen outflows. So again, signaling that they're unloved. So my view is that you don't need much of a catalyst to get it going. So if the economy does rebound, we get some of this unleashed demand from the pandemic leaving us, you could just see some modest increases. And that alone could do well. What's really interesting is in his first year of his first term, Obama was certainly focused on the global financial crisis and other domestic priorities. And yet the aerospace and defense index, which includes Boeing, obviously, outperformed the market by more than 4% that year. So I'm just taking a similar leap of faith that this unloved, compelling value could surprise on the upside as the economy rebounds.
Okay, well, we'll have to check in with you a little later down the line in the year to see whether those surprises materialize. Michael Roney, Chief Investment Strategist, U.S. Fighter Business at State Street Global Advisors. It's good to talk to you today. Coming up, cybersecurity firm Tenable announcing a big acquisition in the space. We're going to be joined by CEO Amit Yoran after the break. We'll be right back. Welcome back to Yahoo Finance Live. Cybersecurity firm Tenable announcing it is acquiring Paris-based startup Alcid for $98 million today. The firm saying the acquisition will help customers find and fix security weaknesses in Microsoft's Active Directory in real time. Let's bring in Amit Yoran. He is the CEO of Tenable. Amit, it's good to talk to you today. Walk me through this acquisition. How is something like the SolarWinds hack that we have seen play out more recently strengthen the case to really beef up some of your security assets?
Well, I think SolarWinds is a great example of the types of cybersecurity challenges that are facing corporate America today and organizations around the world. So there are so many ways to enter a network, so many vulnerable systems out there, and ways to compromise and gain access. And so organizations really need to be agile, identify where they have exposures, tighten those up, and be able to respond to incidents as they unfold.
And when we talk about the opportunity here, obviously cybersecurity names had seen quite the pop in 2020, whether you look at a CrowdStrike or a Zscaler or Okta. When you're looking to kind of address these issues, what is Tenable doing different to maybe focus in on the enterprise opportunity here with an acquisition like this?
Well, Tenable is foundationally about answering this question: how secure am I, how at risk am I, and how can I most efficiently reduce risk? So we help customers do that in their enterprise environments. We help them do it in the cloud. With the acquisition of Alcid, we have the ability to, or the technology has the ability to look at directory services. So all of the accounts across your enterprises, directory services store all of those accounts and all of the passwords. And Alcid evaluates how securely or how weakly that Active Directory has been configured. In many cases, in many instances, there's lots of vulnerabilities there, and the configuration needs to be tightened down. As part of the attack lifecycle, when an adversary gains access to systems, they will attempt to raise their privilege level to be able to move laterally across the environment to gain access to the information they want. And they will create new accounts to establish persistence so that if you shut them down, they'll have these backdoors to get back into your environment. So we think Active Directory plays an absolutely critical role in corporate cybersecurity and is part of Tenable's overall strategy to help assess and understand and address cyber risk.
No question. The concerns around cybersecurity have been heightened as so many of these companies have really migrated a lot of their operations online. We've talked a lot about the digital acceleration. We had a guest on from Microsoft earlier who was talking about being able to connect everything in the cloud in terms of the work environment. From your vantage point, how have the threats evolved as a result of this acceleration into the cloud that we've seen over the last year?
Well, there's a great question, and there's two things that have happened in the last year that have a profound impact on cybersecurity. One is this migration to work from home. All of the employees which were coming into an office and accessing networks and information from offices are now working from home. In that work from home world, you have fewer control points. You have less control of the environment. And one of those few and critical control points is the user's account, the account itself, their identity. The same is true as you migrate to cloud-based infrastructures. Again, you don't have the same type of control of the overall environment. One of those few remaining control points is the actual accounts. So again, we feel like Active Directory and tightly configuring and securing your Active Directory is an absolutely critical component to cloud security and security in a work from home environment. And again, it's one of the key reasons why this acquisition with Alcid makes tremendous sense for us.
It would also, I suppose, maybe hinge on a want and a need for companies to really be investing on making sure they're checking the boxes to secure their operations here. We've been talking a lot about maybe more companies moving in the direction of Tesla to put Bitcoin or other cryptocurrencies on their balance sheet. I imagine that makes it even more important to make sure security stopgaps are filled in here. Talk to me about maybe some of the catalysts here, because SolarWinds is obviously one, but each time we hear about these hacks and increasingly maybe even the nation state actors here, how has that maybe led to the overall sector as a whole growing, and how do you see that changing moving forward?
Well, I think all of these hacks highlight, and SolarWinds is just the latest of a long litany of examples that we hear about almost every week in, week out. The examples continue. What we're seeing, and I think the most profound trend occurring in cybersecurity, is the engagement of senior executives. And understanding that the board of directors, the CEO, the audit and risk committee have an incredibly important role to play to assess the cybersecurity of the enterprise and ensure that you're adequately measuring and protecting against that cyber risk. We're seeing it at a corporate level, and I think that's leading to an increased level of spend and growth for the cybersecurity market. And we're also now seeing it at a national level. We saw it with President Biden's recent attachment of cybersecurity dollars to the cyber relief budget. We saw it in his initial engagements with Putin. The cybersecurity issue has come up, so it is achieving a level of awareness and attention at senior levels of corporate and national security communities.
Yeah, and nobody wants to be caught dealing with that situation too in those executive level positions. But Amit Yoran, Tenable CEO, appreciate you coming on here to chat all of that. Be well. Going to take another quick break here on Yahoo Finance Live, but when we return, continuing that discussion, the Trump administration passing off kind of this problem around TikTok and the sale there of their U.S. operations, the update out of Washington, D.C. on that. We'll chat that right after this. Welcome back to Yahoo Finance Live. We have markets trading near break even here. Earlier in the session, we saw the Dow swing by about 200 points. The VIX spiked 10%. For more on the moves we're seeing play out today, I want to bring on Yahoo Finance's Jared Blickery to break that down. Jared?
Yeah, Zach, and let's get straight to the charts. And I'm glad you mentioned the VIX because it was pretty interesting. On the open, the VIX dipped below 20. And this was before we had that sell-off because we were sitting on some nice pops on the open. But then we saw some more volatility. And you can see here, the Dow just barely holding on to gains. Russell 2000 is the worst off, down about 38 basis points. So not any big moves here, but it is notable because it was a pretty steep sell-off on no particular news. So we want to keep an eye on these things when they happen. We are still near record highs, and guess what? You take a look at the 2-month chart on the Russell 2000, still up almost 20% there. So let's take a look at the NASDAQ 100 heat map, and we can see it is now a red picture for most of the mega caps. Tesla, the worst off, that is down 4%. Well, it's time now for our Yahoo Finance premium investment idea of the day, and that is in Electronic Arts after it just reported its earnings. And this is a fundamental report by Argus Research. And let's just read what they have to say about it. So first, they have a long-term target of $161, maintaining that with a buy after their fiscal third quarter results. And the reasoning is, while the pandemic has negatively impacted many businesses in 2020, it has been a boon for EA, driving strong, broad-based engagement with their games and live services. We are lowering our full year 21 EPS estimate to $5.52 from $5.61, raising their forecast. They're saying that our estimates imply average EPS growth of 13% over the next 2 years, just above that of their 5-year earnings growth rate forecast of 12%. So here's what this stock has done over the last 3 months, up 22%. And in fact, we had a call on this way back last year. I believe this was in November. Similar call, 161 price target. And so they are simply maintaining this. And so far, so good, guys.
All right, Jared Blickery, appreciate that. Kiko, meantime, we were talking about security just a moment ago. It's interesting to see kind of that stay an issue across the Trump administration and now the Biden administration when it comes to the sale of TikTok and ByteDance's U.S. operations here, something that was pressured under President Trump, and we're hearing more about it today.
Yeah, I mean, this is something that we haven't talked about for a while, but those talks are still ongoing, at least according to the Wall Street Journal. Right now, the deal there in terms of spinning off TikTok's U.S. operations, that sale to Oracle and Walmart being put on hold. The Journal reporting discussions have continued between ByteDance and U.S. national security officials in the meantime. Now, we did get some comments from White House Press Secretary Jen Psaki a short time ago on this very issue, saying, in her words, it's not accurate to suggest that there is a new proactive step by the Biden White House in terms of the review of this. And she says the CFIUS review is ongoing and is separate process from the court. There's no timetable for a decision. Now, just to sort of rehash what has been playing out here, because this is a story we've been following since last summer. It came down with the 2 executive orders from the president initially calling for a ban for TikTok. And the concern was around its data sharing agreements. Largely because TikTok is owned by ByteDance, which is a Chinese company. And the argument, like many Chinese apps, has been that there is, in fact, a backdoor that can be created if the Chinese government asks for that data. That prompted sort of this push to spin off the U.S. assets. And at this point, with the new administration here, there's still questions about how, in fact, a Biden administration plans to proceed. As of now, that CFIUS review still ongoing. We've also got this February 18th deadline that is coming up here, which would require the U.S. government to essentially respond to TikTok's push to basically put this divestiture or overhaul this divestiture altogether. And Zach, it's interesting that this conversation is happening because another company we haven't talked about for a while, Huawei, just more recently filed a lawsuit in the U.S. Court of Appeals disputing the FCC's designation that it's a national security threat. So you've got some of these Chinese companies who were really the target of the Trump administration, seeing that a new administration is in town now, trying to find ways to negotiate here because there was a real hardline stance coming from the previous administration. Now, having said that, everything we've heard from the Biden administration has been pretty clear that they plan to remain tough on China. They have even gone as far to say they agreed with the stance former President Trump took. They just didn't necessarily believe the tactics around it. So it's going to be an interesting story to watch.
Yeah, still early days for them to, I guess, differentiate their tactics in negotiating with China, but still the security issues front and center when it comes to TikTok. I've been watching another piece of the incoming administration, I would just say the Biden administration already income, but what they're working on now when it comes to cannabis. We were discussing that yesterday with the CEO of Canopy Growth, David Klein, in the afternoon show. Of course, they received billions in investment from Constellation Brands, the alcohol maker there, but as they prepare for legalization, as they say, at a federal level coming this year, I had to ask him about how that might change investment plans in the U.S. And of course, they've already shown some pretty impressive results in their earnings report we got yesterday, 3 straight quarters of narrowing adjusted EBITDA losses under CEO David Klein as he cuts costs. But I asked him how that might change the M&A outlook if we do get federal permissibility here in the U.S. and what that could do to Canopy's growth and expansion plans here. Take a listen to what he had to say.
The other use of the funds was to have a bit of a war chest to be able to fill out white spaces in Canopy's portfolio, whether it be in the US or in Canada or in Germany. And so, we'll continue to think about our business that way. And we're one of the reasons why we want to get to the place where we're no longer posting that EBITDA loss is we want to conserve our capital so that we can use it to fill out gaps in our portfolio. And, we'll be as aggressive as we can, either through acreage or some other format as we get to a permissibility event in the US.
I'll just point out here, I mean, we keep seeing shares in these Canadian companies like Canopy catching a boost here. That ETF, the marijuana ETF there, Alternative Harvest doubling already to start the year, but the US Operators ETF, MSOS, up by less than half of that. So important to keep in mind, generally Canadian companies trying to come to the US, they're going to be buying the other way. That'll do it for us here on our hours. For Akiko, myself, stay tuned. We got much more coming your way on Yahoo Finance Live right after this.
Happy Wednesday. Welcome into the 1 p.m. hour here on Yahoo Finance Live. Taking a look at market action right now, we have the Dow in the green, however, fairly flat, up about 5 points right now, as we are seeing markets taking a bit of a breather after we saw them head to record highs earlier in the trading session. On a sector basis right now, we have energy, the leader on the day, up over 1.5%, followed by healthcare, that sector up about 0.25 percentage point. We have consumer discretionary and tech, the laggards today. Tech right now down about 0.3 percentage point. Now, today's market moves is coming as we head into day 2 of the impeachment trial of former President Donald Trump. Taking a look over at some stocks right now, let's start with Twitter. Twitter getting a nice pop today. They are saying that they're seeing continued strong user growth. As you can see there, Twitter up about 8% right now. The platform says that it's going to decide whether it's going to actually purchase Bitcoin, taking a page out of Elon Musk and Tesla's book there. Twitter also said that it will continue to ban former President Trump, even if he runs in a couple of years. We'll be chatting that a little bit later in the show. Want to take a look now over at Lyft. Lyft beating on both top and bottom lines. They say they're on track to become profitable by the fourth quarter. So you can see there, Lyft up over 5% right now. CFO Brian Roberts did say, however, on the earnings call, that profitability could happen by the third quarter. Investors happy by that news, up over 5% right now. I want to take a look over at some stocks that we heard Zach Guzman talking about over in the last hour, and that's some cannabis stocks. They're all in the green. Tilray up over 31%. Canopy right now up about 4%. Canopy actually has boosted its profitability outlook, says revenue is expected to grow by as much as 50% over the next 2 years. And of course, for all of these companies, there is optimism over decriminalization of marijuana from the Biden administration. But I want to start with what's happening on the Hill. So I want to bring in Yahoo Finance's chief political correspondent, Jessica Smith, for all the latest that is happening on the Hill. Jess, why don't we start with the impeachment trial that has had everyone riveted over the last 24 hours, the Senate obviously moving forward with that trial.
Yeah, today the House impeachment managers are presenting their case for why they believe President Trump incited that deadly riot on January 6th. Throughout the day so far, they have been using quotes and clips of President Trump, how he spread the lie that the election was stolen. And then they said after he laid the groundwork by spreading that lie, he incited and riled up his supporters and then assembled them and directed them to the Capitol to stop the certification of the votes. They say that he could have stopped it and he did not. They say he betrayed his oath by not stopping it. They said that he saw this coming and did nothing. He is not an innocent bystander. Now, at this point, it is unlikely that 17 Republican senators are going to vote to convict the former president. Just 6 yesterday voted that this trial was even constitutional. We'll see if they flip their votes at this point, but it does not look likely based on what we're hearing from Republican senators around this trial. Each side has 16 hours to present their case. We don't expect them to use all of that time at this point, but we'll keep you updated on how things play out throughout the week.
Now, Jess, that's not the only thing that's been happening on the Hill, but I want to go and take a quick break right now before we get some more updates out of Washington. Welcome back to Yahoo Finance Live. Let's continue our conversation with Yahoo Finance's chief political correspondent, Jessica Smith. She just gave us some updates on that impeachment trial, but now we also have some additional news on stimulus. Hey, Jess.
Yeah, Kristen, today House committees are working on their different provisions as part of the $1.9 trillion stimulus plan that President Biden has put forward. 4 different committees are holding markups today, so working on the sections of the bill that fall under their jurisdiction. The House Ways and Means Committee is meeting now. We heard from the top Republican and Democrat on that committee. They're working on those enhanced unemployment benefits, stimulus checks, in the expanded child tax credit. The top Republican, ranking member Kevin Brady, really bashed the plan. He particularly noted his opposition to those enhanced unemployment benefits and stimulus checks. Let's listen.
Why should anyone get paid more by taxpayers to stay home than to get back to work? There is a third round of stimulus checks that many experts admit are probably more a political stimulus than an economic one, costing nearly $500 billion. These checks do little to help Main Street businesses survive or get people back to work.
Anyone who thinks we'll recover without intervention isn't paying attention. Unfortunately, too many Americans have been left behind in this haphazard, every state for itself response to the crisis at hand.
Now, early this morning, the House Education and Labor Committee passed their portion of the bill. They worked through the night to get this done, and that portion did include the measure to increase the federal minimum wage to $15 by 2025. There was a lot of debate on that issue, but ultimately, Democrats did pass it. The bill also included nearly $130 billion to safely reopen schools, another $40 billion for higher education, $40 billion for childcare, and then strengthened worker protection. That bill is now going to the Budget Committee. The Budget Committee will put together all of these different bills that the committees are working on and wrap it up into one before it can go to the House floor. Kristen?
All right, Yahoo Finance's chief political correspondent, Jessica Smith, thank you so much for bringing us, as always, all of those updates out of Washington, D.C. And I want to head over now to the state of Washington. One lawmaker there is hoping to change the tax code to make sure that the state's wealthiest residents pay their fair share. We're joined now by Noel Frame, Washington State Representative, representing the 36th District. So, Rep, I'm wondering, this tax code that you have, it would impact about 100 residents, I was reading, inside the state of Washington, taxing money earned and also some intangible assets over $1 billion. And now that seems pretty targeted for such a small group. What do you say to those that think that the wealthy inside your state are being singled out?
Thank you so much for the opportunity to be with you today. And what I would say is, this proposal really isn't about Washington's wealthiest residents. It's about working Washingtonians, because Washington State, unfortunately, has the distinction of having the nation's most regressive tax code, meaning that we ask the lowest income households to pay 6 times more in taxes as a share of their income compared to our wealthiest residents, who are paying 3% or less. So it's not really targeted in that sense. It's really just asking our wealthiest residents to share equitably in the responsibility of funding community investments, particularly as we think about economic recovery.
So, as you mentioned, regressive tax that you have there in Washington State, and Washington does not have income tax. So how much would this tax, in terms of the incomes and the other assets, or the assets of the ultra wealthy inside the state, how much would that add to the state's coffers?
You got it. And to be clear, this really is a tax on assets, and specifically intangible financial property. It's a property tax. And so as designed, this bill would raise $2.5 billion per year. And as we've said in the legislation, we've pointed to ways that we could use those funds, including potentially funding our working families tax credit proposal, House Bill 1297 from my colleague Representative Neelan Tai, which is modeled after the earned income tax credit, and another proposal, House Bill 1494 by Representative Kirsten Harris-Talley, that would look at a reduction on the real property tax for primary residences. So this is really an issue about reform and bringing equity and parity to Washington State's tax code.
Why not create an income tax, a state income tax? You know, Bill Gates has advocated for that in the past, and it would make all residents have to pay a portion of their earnings. Why not take that route?
You got it. So I'm the chair of the House Finance Committee and also wear a different hat. I co-chair the tax structure work group and have thought a lot over the years about how we could restructure our code, and have looked at other states. And really what I have found is that even states that have an income tax are seeing their state revenues decouple from economic activities. And the reality is it is because of wealth concentration at the very, very top in this, in our state and in this nation. In our state, we just happen to have some of the wealthiest people in the world, so it's particularly profound. And so for us, as we think about how we restructure our code and how to make sure it is a match to our modern economy, we are looking at wealth because that is, in fact, how our economy is spread out right now.
So the money that's earned from this tax, where would it go? I was reading that there's no one place that these funds are going to be directed as yet. I'm curious to know why this tax, as you mentioned, the current tax code really disproportionately impacting your low-income workers the most. Why aren't the funds being funneled back to some of the poorest inside the state?
So we're really early in the conversation, but as I mentioned earlier, the bill really points to the idea that we could fund credits against tax paid. And I mentioned those specific proposals, the Working Families Tax Credit, House Bill 1297, and the anti-displacement property tax exemption for that property tax exemption on one's primary residence in House Bill 1494 from my two colleagues, Representatives Tai and Representative Harris-Talley, respectively, are good examples of how we could do that. The Working Families Tax Credit really tries to target that sales tax piece. Washington State's code is so regressive because we are about 45% of our state revenue is from sales and excise taxes. And you can imagine for a household making less than $24,000 a year, those daily expenses for their home and their family, it adds up really, really quick. Thankfully, we do not have sales tax on food, but we do have sales tax on about everything else. And that's how it quickly adds up to be about 18% of their income if they're a family less than $24,000 a year. But frankly, even our families that are more middle class, they're making closer to $70,000 a year. They're still paying 4 times more in taxes as a share of their income compared to those wealthiest and highest earning households.
So let's bring this back full circle to what we were chatting about right before we got into this conversation with Jessica Smith, which is actually on stimulus and what she was mentioning, raising that minimum wage to $15 an hour. Now, that's an initiative that we all know Seattle has done. However, the state has not yet done, although your state's minimum wage is still much, much higher than the federal minimum wage that we currently have. How welcome is an initiative like that, raising the minimum wage to $15? How welcome is that inside of the state of Washington?
So I have a bit of a correction. We did adopt a $15 minimum wage, and we are well on our way to getting it. It was done through a ballot measure here in Washington State. And I'm so glad that you connected these dots, because here's the thing about Washington State. We are a bold economic and social leader on a global stage. We always have been. $15 minimum wage is a great example. That started in the city of SeaTac, a small suburb of Seattle, and then in the city of Seattle, I think back in 2013. And now you see that being promoted at the national level. I think the wealth tax is another example that it is time that we step forward and start to right the wrongs of the tax code, first here in Washington State, but I hope in other states and nationally as well. So we are very supportive of the minimum wage. We passed it here in Washington State, and I hope people will see the connection and have Washington State really maintain its platform on a global stage of being that bold social and economic leader.
Now, Democrats have said that they're going to try to pass stimulus even if they do not have bipartisan support. And one of the sticking issues in the past in Congress has been aid to state and local governments when it comes to those stimulus packages. What else do Washingtonians, I believe it's Washingtonians, I'm not actually truthfully sure if the residents are called Washingtonians, but I'm going to say that. So what else do Washingtonians need from a stimulus package? How badly do the residents inside your state need economic relief?
They really do need it. And I will tell you that the example of the Working Families Tax Credit and getting at least $500 back into the pockets of working Washingtonians, we've got evidence that that's going to work in stimulating our economy and helping us recover, rebuild, and really reimagine our economy. As the chair of the House Finance Committee, we heard from the Economic and Revenue Forecast Council here in Washington State. And in a presentation in November, we were looking at how our revenue was starting to bounce back. And I asked our chief economist, hey, does that maybe have something to do with those federal stimulus checks? And he said, absolutely true. We know good economics is if you get money back into the hands of people who need it, not sit on it, but need it to cover household expenses, they will spend it immediately. That money goes right back into the community to support small businesses. So We really appreciated the dollars that came in from the federal packages last year. In Washington State, we are rapidly moving a $2.2 billion step one economic recovery package that really draws down on those federal dollars. We've done that immediately to get that relief to our constituents right away. And my moment and my message to my colleagues is we are lucky that the federal government was there to help really rescue us, because if we had been left to our own devices, the tools that we have that are so regressive, we should not be recovering on the backs of low-income people. The question is, who will pay for us to recover, rebuild, and reimagine our economy? And with Washington State having truly some of the wealthiest people in the world in our state, we are asking them to help us do that work of economic recovery and share equitably in the cost of doing that work.
I wanted to quickly ask you here, I have about 30 seconds left, but you mentioned how you want your state to really lead when it comes to the tax code. I'm curious to know what you hope to see on a federal or a national level in terms of changes in the tax code to make sure that some of the wealthiest residents, not just inside Washington State, but inside the entire nation, pay their fair share.
You know, we are really lucky here in Washington State that we have wealthy individuals who have been themselves bold leaders on social and economic change. And Bill Gates being one of them, and his father, Bill Gates Sr., who just passed away, but was a passionate advocate. It is time. And Washington State can and should go first, but we do hope that the nation will take a step in righting the wrongs of the tax code more broadly and help our working Americans really get back to work and have a more equitable economic recovery.
All right, Washington State Representative Noel Frame, thank you so much for joining us today to talk a bit about that legislation.
Thank you.
All right, I want to talk now about the coronavirus pandemic. Case counts and hospitalizations continue to fall, and new research is showing that double masking or wearing a surgical mask seriously reduces the odds of transmission. We're joined now by Dr. Heather Yo, Survivor Net Medical Advisor and Associate Professor of Surgery and Healthcare Policy and Research at Weill Cornell Medical College. Doctor, always great to have you with us. I want to start on that point of double masking. It seems like the hot new trend lately in this pandemic. I'm wondering if you think that everyone needs to be double masking all the time at this point.
I mean, I think that the CDC just recently recommended it because there's clear evidence that a mask that fits better is more likely to protect you. I think that if you have a good fitting N95, you don't necessarily need to double mask, but for many people, they don't have access to well-fitting or sized or fitted masks. And so double masking is a reasonable alternative.
Now, it used to be that we heard that, people shouldn't actually go out and buy these surgical masks because they should leave it out there on the market, for frontline workers, for essential workers. Should everyone really start purchasing those masks and say, hey, are you saying that, cloth masks, they're not good enough? Everyone needs to go out and try to purchase those N95s.
I think the recent study they did that said that double masking is about as effective as the N95 fitted masks. And so I think it's whatever's available. I mean, as a resource now at hospitals, we have reasonable access to N95s. And I think that if people use an N95, it's fine. It's just they need to be cautious of how they use them. N95s actually can last for a couple of days. And for many of us, when we were early in the pandemic and didn't have access to masks, many of us would have 3 N95s and rotate them in, as long as they would last us. So I think that we have definitely more resources now. So I think for individuals, whatever they can get their hands on is probably the best thing.
How quickly should folks be getting rid of their masks? How many times can you wear one?
I don't know that there's clear evidence. I think if the mask is soiled or dirty, if you know that you've been exposed to someone with active COVID, you should probably consider changing the mask. I think that a mask, realistically, as long as it's not soiled, can be used for at least a week.
All right, well, then I need to get rid of some of my masks, I'll be honest. And I know some of my friends do as well. As I mentioned, we see case counts falling, hospitalizations are falling. However, I was reading some of your notes and some of your thoughts before we had this chat, and you say that, ICUs are still full. Would you say that we are nowhere near close to out of the woods yet? Because it seems as if we're rounding a corner, so to speak.
I mean, as clinicians, we're very happy to see the numbers going down. But as you know, the numbers of cases, actually, the numbers of deaths and the numbers of hospitalization lags that a little bit. People get sick and then may not initially need to go to the hospital. And as those patients are in the hospital, our beds continue to fill up. And so in our ICUs, patients are often in the ICUs for weeks to months. And so even though we're discharging, or unfortunately some patients are passing away, we are still kind of constantly slowly building. And in New York, we're at numbers very similar to where we were in April in terms of hospitalizations. And so we're still being very cautious. We're having to hold off on some elective surgeries at this point.
You know, we had drug maker Eli Lilly receive emergency authorization for their antibody cocktail to treat coronavirus. Considering that we have this news and we have the vaccine, which it has been speeding up how many people we are vaccinating, do you think that we're going to, much more quickly beat this pandemic now?
I think that the most important thing is to be getting the vaccine out there in as many patients as we can. I'm excited about the availability now of the Eli Lilly antibody cocktail. There's a couple of caveats with that. Unfortunately, the use limitation is pretty small. I think we've talked about it in the past before. It's really not indicated for patients who are hospitalized, those on oxygen, or those who have baseline needs for oxygen. In studies, actually, so far, it hasn't been shown to have any improvement in that cohort, which is probably those that need some treatment the most. It has shown in recent studies that it has about a 70% decrease in need for hospitalization and in deaths for patients in the kind of mild to moderate stage who have high comorbidities. So those who have or obesity, or who have diabetes, some underlying conditions, and who are at high risk to progress. Those are our target patients, but has to be used early in the first 10 or so days of their diagnosis and before their symptoms get too bad.
As you're looking out, into the future, looking at March, April, May, into the summer months, what are some of your biggest concerns about this pandemic? We keep hearing fears about a potential resurgence or another spike.
I mean, my biggest fears are, and you see it around you, people are getting tired of isolation. People are getting tired of wearing masks. And my biggest fears are people are going to kind of think things are better so that they can be more lax. And I think, it's very easy when you're not in a hospital every day and you're not seeing the sick patients to say, oh, the numbers are going down, it's safer, it's better, I can start relaxing my restrictions. And that's really where, as physicians, we're worried that if that happens, then things can get worse again.
Dr. Heather Yo from Weill Cornell Medical College, thank you so much for joining us as always. All right, coming up, we will be talking about gender and race disparities in pay for social media influencers. We'll be chatting that next. Welcome back to Yahoo Finance Live. Checking market action right now. We have the Dow remaining in the green, the S&P 500 and the Nasdaq both in the red. The Nasdaq, the laggard, down over 0.1 percentage point right now. We still have tech in the red, down about 0.25 percentage point. Consumer discretionary continues to lag on a sector basis. So let's bring in Alex Shahidi, co-founder and managing partner of Advanced Research Investment Solutions. So Alex, we keep seeing record highs, and then the market's, starting to take a bit of a pause. I'm wondering what you think the next catalyst is going to be, really to allow the markets to stay on a run.
Well, it's a very fascinating time, obviously. We're in a global pandemic. It's remarkable how well the markets have done despite the headwinds that the pandemic has caused. And a lot of that is based on monetary and fiscal policy, which has been extraordinary. And it seems that as long as that continues, there's tremendous upside. But it's more complicated now, because it used to be that the Fed can just lower interest rates to stimulate the economy. Now there's required coordination between monetary and fiscal policy, because the Fed is printing money and giving it to Congress to spend. And so some political roadblocks could delay implementation of that stimulus, and that could be a catalyst for a downturn.
I'm wondering if you think that we're headed, as you mentioned, catalysts for a downturn. Do you think that we might be headed for correction territory anytime soon?
It's very possible. I mean, you've had this tremendous run from the lows back in March, almost a year ago, and the market just seems to have not taken a breath since then. So sometimes you just get a downturn without a catalyst, just because the market is taking a breather. In this case, it just seems that the pedal's to the metal. The Fed is keeping rates at zero. They're telling you they're going to keep them there for an extended period of time. There's a proposal to provide even more fiscal stimulus with multi-trillion-dollar packages. These are significant numbers, and so it seems like we're off to the races again. Of course, inflation, if that becomes a problem, that could be a catalyst in the other direction. But it's kind of open season right now.
We keep talking to a lot of folks who say that they see a little bit of the market, or at least sectors of the market, that seem a little bit or reminiscent of 1999. And then, of course, we also keep hearing more and more talks of bubbles forming. I'm wondering if you think, or if you see bubbles forming this year, what sectors and how badly do you think they're going to be hit if those bubbles burst?
Well, technology is at the top of the list, but what's remarkable about this year versus the late 90s is you had this tech bubble back in the late 90s, companies that had no earnings but just a promising story, and then you got the economic downturn, and technology led the way down. This time, you had a similar idea with these remarkable stories of the future. You get an economic downturn, and technology actually is the leader, so the gap has widened. And so that has led people to say there's a bubble in technology, certainly pockets of technology where you have companies that are trading at ridiculous valuations that haven't made money. But overall, it seems less bubble-like to me than back in the late 90s, just because there is, a lot of these companies are actually growing revenues during this economic downturn. So there is some difference there.
How do you think tech is going to perform in 2021, especially as there's been so much investor, not just enthusiasm, but also expectation in that sector, especially around some of those big tech names? Now, we saw 2020 pull forward a lot of growth for those companies, that some of the companies, for example, like Zoom, say they're just not going to be able to maintain after 2020, not going to be able to maintain it in 2021 and beyond. What do you think happens to some of those big tech names? And do you think some of these companies are going to be badly, not rewarded, but punished if they don't meet some of those high expectations?
Yeah, I think you hit the nail on the head, which is oftentimes what happens is you have favorable conditions for your company, and the market extrapolates those favorable conditions far into the future, which raises the bar, because to do well, you actually have to outperform those lofty expectations. And to me, it seems like a long shot that that'll happen just in general. because there's just so much optimism over these companies, which is reflected in their booming prices. And so I feel that if they underperform those, that high bar, which seems more likely than not, then there is some significant downside risk for a lot of those stocks.
So then what are you liking for 2021? If tech's not going to be the market leader, what is?
It's such a difficult year to try to predict what's going to do well, because you have this global pandemic, you have political uncertainty, you have the potential for rising inflation. The one area that I think looks relatively attractive is gold. And the reason I say that is because it's a very good diversifier to portfolios, obviously. But if you do start getting inflation pressures, it's a good inflation hedge. If it goes the other way, and you get a sudden downturn, either the virus lasts longer than expected, or fiscal authorities don't come through, and you get a downturn, gold can actually do well in that environment as well. We saw that in Q1 of 2020 when gold was up when the economy collapsed. So I feel that it's a very probably under-owned portion of most portfolios, and it's one of my favorite areas.
Gold right now up about 0.3 percentage point over $1,800. Alex Shahidi, co-founder and managing partner of Advanced Research Investment Solutions. Thanks so much for joining us today. And coming up next after the break, we will be chatting about that social media influencer equity report. Welcome back to Yahoo Finance Live. We have the second State of Influencer Equality report out from IZEA, and there remains gaps in pay between genders and races. We're joined now by Ted Murphy, IZEA founder and CEO, and social media influencer Erica Elaine. Thank you both for joining us for this conversation. Ted, I want to start with you on this report. We're seeing influencers of color getting paid more and an increase of non-white influencers being sponsored. I'm wondering what's driving that change.
I think that the events over the past year have really driven a lot of that change. There are a lot of brands that have really looked at what is happening in the political environment, what consumers are looking for in terms of the content that they're looking at on social media, and they're trying to find influencers from all different backgrounds to partner with in order to promote their brands.
Now, Erica, I want to turn to you. Your Instagram, Mama in Color, discusses racism and being anti-racist quite a bit. Are you finding that this content that really addresses these social justice issues are getting more popular and also more profitable?
I definitely think that it's getting more popular. More people are feeling more empowered and comfortable about speaking out. And I definitely think that there is a lot of room for growth for influencers of color to be able to have room in this market.
Now, Erica, looking at the report, and we have some of the graphs, there's still some gaps that remain, at least when it comes to how much is paid for influencers based on gender, men making much more than their female counterparts. I'm wondering why you think that is.
I think that that's kind of symptomatic of just the world as a whole, unfortunately. And there's definitely so much room for growth with that. And I'm really hoping some of the things that happened over the course of 2020 will help definitely close that gap.
And Ted, we're seeing that the average costs of the posts through the years is rising. Do you think that there's something changing about the way advertisers are approaching the content that they're trying to advertise, or who they want to see their content, that perhaps is driving these changes in price?
Yeah, I mean, it's really been remarkable to see what's happened since we first started in 2006. I mean, back then, influencers were getting paid $5 to $10 for a post, and $25 was seen as a real big home run. And now you're seeing that the average post in our platform is more like $1,600. And that, of course, spans very small influencers to very large influencers. But advertisers are really starting to see the value in sponsored content, and they're taking that content and they're repurposing it into their other advertising. So it's not just about the reach of the influencer anymore or how many likes or comments they have. They're actually taking that content and they're repurposing it on their own social handles, in their e-commerce experiences, on their websites, and even in television and print.
I'm sorry, did you say that the average Instagram post could make as much as $1,600? Because I'm starting to think that I perhaps am in the wrong profession and I need to just go out there and try to post as much as I can on Instagram, because that is absolutely incredible that we can see some influencers commanding that kind of money. Erica, given that the prices are increasing, are you seeing increased competition? Is it becoming harder really to keep up with, what the advertisers or what the sponsors want?
I really don't think so. There's a lot of talk about how the market is saturated and things like that. But my philosophy is there's room for everybody. And I think there's so much room for potential with influencer marketing that I think that there's something out there for everybody. So I feel like, the potential is really limitless with it.
Ted, I would love to hear your thoughts on that, what you're seeing as more folks get involved in the space, if you think that there is a saturation point when it comes to social media, influencer marketing.
We think that these are still very, very early days for influencer marketing. We're excited about the progress that's being made on the pricing because a lot of these influencers really put a lot of effort and time into the content that they're producing. The platform that we launched earlier last year, Shake, is actually focused around allowing these influencers to more easily market themselves, to be able to connect with advertisers, and to be able to set their own prices. So, we just talked about the average post being about $1,600, but we actually completed a $40,000 TikTok offering just a couple weeks ago. So there's a lot of money to be made. It's not easy being an influencer, as I think Erica would tell you, but if you put in the effort and you really take some time to build your brand and build your following, it can be a full-time job.
I'm going to throw this last question out to the both of you. Perhaps, Ted, you can go first. Erica, I'll give you the last word on this. You know, new social media platforms are coming out every single day. I watch TikTok. I have not even attempted to try to make one. It seems far too difficult. We have the new social media platform of Clubhouse out, which is an audio-only platform. How do you think that changes the game? Some of these new platforms in terms of content creation, but also for some of these creators to monetize what they're doing on these platforms.
I think what's so cool about social media is that the world is constantly changing. I mean, when I first started doing this, it was on MySpace and message boards. And I remember when we were doing Vines, you know, these platforms, they kind of come and go over time. Facebook has had some fantastic staying power, but I think what you're seeing now is that there's some real competition. And a lot of that has been driven by what people are interested in from a content perspective. So, you know, whether that's an audio chat on Clubhouse or creating real fun videos on TikTok, there's a lot of opportunity for people of all types.
Erica, your thoughts?
Definitely. I think, honestly, the more platforms, the better, just because, you know, what somebody else might relate to, someone else might not. So like it is like, if you want to go to Clubhouse to like learn more, grow more, different things like that, or you do like the fun TikToks, or you're interested in Instagram and things like that, I feel like there's so much room for both creators and for the people who do want to consume content. There's really kind of something for everybody.
All right. What I've mainly learned is that I really need to up my social media game, my Instagram game in the coming weeks, months, and years. Ted Murphy, IZEA founder and CEO, social media influencer Erica Lane, thank you both for joining us for this incredibly fascinating conversation.
Thank you.
Thank you.
And coming up, it's our Funding Our Future segment. Welcome back to Yahoo Finance Live. Time now for our Funding Our Future segment. And we're going to be chatting a new tax rule called the Look Back Rule. We're joined now by Timothy Flack, Commonwealth's Executive Director and co-founder. Timothy, great to have you with us because, as I was mentioning to you in the break, I always need some of these new tax rules and codes to be explained to me and broken down. So what is this new Look Back Rule?
Yeah, I'm super happy to have a chance to talk about it. Maybe just to set the context, you know, many of us think of tax time as a thing to avoid, we have to pay, But in fact, for tens of millions of Americans, it's a moment of a refund and a really, really important part of their financial year. But at the core of a lot of those refunds for working families are something called the Earned Income Tax Credit and sometimes the Child Tax Credit. And at the core of those credits is the requirement to have earned income. And of course, when we think about what happened to tens of millions of us last year, we really didn't have the chance to earn an income because the economy was shut down. So the concern that we saw coming into this tax season is that people who would normally be seeing very large refunds, by our calculations, could face 80% smaller refunds because they may not have had that earned income from last year. And so to your question, the look back is something that Congress included in the December 21st relief bill that says you can not just look at 2020's earned income, but also, if it's better for you, 2019's earned income. And so the effect is that as many as 20 million or more of us who rely on this earned income tax credit have a much better chance of having a credit at the level we're used to and refunds typical to what we're normally expecting this time of year.
So the main thing that concerned me when I heard about this is that in order to make use of this rule, it requires folks to make the correct steps in filing of their taxes. And as I've seen, for example, when the Tax Cuts and Jobs Act was passed, was that a lot of folks don't go in and change their taxes because sometimes they don't know that they're supposed to be doing these things. I'm wondering if there's a concern that perhaps folks might not even know about this rule and might not make use of this ability to look back at 2019 taxes or income, I should say.
Absolutely, absolutely, which is why we're really pleased to be able to talk about it. And in fact, we have a dedicated website, taxtimecrisis.org, that has the latest information on this look back. And to your point, if you get your taxes done by somebody professional or you use a professional software package, then the odds are good that that preparer or software package will guide you to the right answer. However, you need to bring the records from 2019 to be able to give that tax professional or that software package the right information. So it's really, really critical this year in particular to go find those 2019 tax records and take them with you to your tax appointment or use them when you sit down to do your tax, use the tax software. I know it can seem like a hassle. A lot of us have had a very disruptive 2020 and rummaging around in boxes to find tax records might not seem worth it. But for this year, there could be literally thousands of dollars at stake for some families. And the second thing we would say, oh, please go ahead.
No, go ahead. Go ahead, Timothy.
Just if you're preparing your own taxes, you're still one of those folks who go to the library and get the forms or otherwise, really do it old school all by yourself, then I just really want to emphasize to either go to taxtimecrisis.org or to the IRS website and look up this look back provision, look back rule, and make sure you find out if it applies to you, because no one will be there to suggest it to you.
I want to ask the hugely glaring question, which is that this pandemic is not yet over. There are still millions of folks who have not been able to find another job after losing it throughout this pandemic, which means that for me, this look back rule is great for tax time this year, but what happens at tax time next year? What is the more permanent solution or fix to this problem?
Yeah, I really appreciate that question. I think the first thing to say is that if you do visit the website I listed, we are looking for folks who would like to raise their hand and say, we want to make sure Congress takes care of this same issue for next year. So we need people to testify really to the impact that this look back rule has had for them this year. So our policymaker friends in Washington take the same action next year. Now, looking out longer term than that, I think we now realize after 2020 that a system that really relies on the tax code and the tax filing process to put a big portion of working families' income into their pockets wasn't really designed for an event like 2020 when the economy closes down. And so we're just at the early stages of thinking about what does that mean for the future of the tax code. And I think we're already seeing signs that policymakers are beginning to think about that in, for example, the proposed stimulus bill from the Biden administration. So we see a lot of work ahead to try and make sure we have a tax code and a tax system that works even through really difficult events like the pandemic.
All right, Timothy Flack, Executive Director and co-founder of Commonwealth. Thank you so much for breaking all of that down for us. Now, Funding Our Future is an alliance of organizations dedicated to making a secure retirement possible for all Americans. And coming up, we are going to be chatting Twitter and their continued Trump ban. Welcome back to Yahoo Finance Live. Let's talk about Twitter right now. That stock is soaring up over 8.5%. We have Yahoo Finance's Emily McCormick to break down all of the interesting news around Twitter. Hey, Emily.
Hi, Kristen. And I'll start off on those really strong fourth quarter results that we got out of Twitter yesterday after market close. We are seeing that stock rallying today, actually hitting as high as the highest level it had been since 2014 intraday today because of these results. And just taking a look here, we saw advertising revenue surge 31% to $1.15 billion during the fourth quarter. Massive growth here and accelerating from the 15% ad sales growth that we saw in the previous quarter. So again, a testament to the rebound that we're really seeing across the internet advertising space and for Twitter specifically with some of those ad product revamps that it's been rolling out over the course of the past year. Now, I do want to note that the company warned that user growth would likely slow this year due to tough comparisons over 2020 when the pandemic and stay-in-place orders had really spurred users to keep using their phones, using their desktop computers, and logging on to Twitter. They did see those daily active users grow 26% to 192 million in the fourth quarter, a little bit short of expectations. So again, that will be a metric to watch going forward. Now, we did see a number of Wall Street firms actually raise their price targets on shares of Twitter in the wake of these results. We saw JP Morgan, Cowen, as well as MKM Partners and UBS all raising those price targets. So Wall Street getting a bit more bullish in the wake of these results, Kristen.
All right, but that's not all that's been going on with Twitter, because I saw that their user growth actually jumped in the month of January, particularly after the riots in the Capitol, which leads me to my next question, which is what are they going to do about the former president?
Well, Kristen, former President Donald Trump will not be allowed to return to Twitter even if he runs for office again in 2024. Now, that is according to Twitter's chief financial officer, Ned Siegel, who spoke on CNBC earlier today. And specifically, he said, quote, he was removed when he was president, and there'd be no difference for anybody who was a public official once they've been removed from the service. So again, that Trump ban that we actually saw come into effect in January in the wake of those deadly Capitol riots is going to be a permanent one here. So don't expect to see him back on the platform, even if he does seek office again in the future, Kristen.
So no more Trump on Twitter, no matter what. So who knows how he's going to announce a run in 2024 if he does decide to run. Thank you so much. Yahoo Finance's Emily McCormick with all of those updates around Twitter. Again, Twitter up right now about 9%. We've got Alexis Christoforous picking up the 2 p.m. hour. Next, she'll be chatting with Charlotte St. Martin, Broadway League's president, on the prospects and challenges of Broadway reopening later this year.
Hi, everybody. Welcome to Yahoo Finance Live for this Wednesday, February 10th. I'm Alexis Christoforous, and it looks like stocks are pulling back from their earlier record highs that we saw this morning. Right now, we have a mixed picture with the Dow Jones Industrial Average in the green by 29, but the broader market giving back some of those recent gains. The S&P down 5. We've got the Nasdaq off about 35. Investors are betting that President Biden's $1.9 trillion stimulus plan will help boost the economy and that vaccinations will help reduce COVID-19 deaths. And we know that investor sentiment has also been boosted by companies' quarterly results that have largely proved to be a lot better than expected. Let's tick through a few of those for you here. We've got General Motors. The automaker had a strong fourth quarter, saying it expects earnings to climb this year despite a chip shortage and rising material prices. Still, GM coming under a little bit of pressure here. Lyft's stock, though, headed in the opposite direction. It is surging more than 5.5% after the company said it could be profitable as soon as the third quarter of this year, or a full quarter ahead of earlier estimates. And that's thanks in part to some aggressive cost-cutting measures at Lyft. And we've also got shares of Twitter on the rise today after the company's sales grew more than expected, profit beat estimates, though it did warn it will be difficult to maintain the momentum it's seen throughout the pandemic. That stock getting a nice bounce, up now nearly 9%. Also getting a nice bounce for, I guess it's the third day in a row now, pot stocks. Jared Blickery is along to tell us more about this. And it looks like the Reddit crowd now turning its attention to marijuana. Jared.
That's right. And to be fair, Sundial was already on their radar, but now the entire space is attracting a lot of attention and a lot of money. So let's take a look at the charts here. Tilray is the standout example because that stock is up 40% today alone. Over the last 5 days, up 125%. Most of that just coming this week. When you take a look at the performance, especially comparing it to longer term, and we'll go to a multi-year chart to see that, we haven't had a big swing in Tilray since that top. And so it's remarkable that we're seeing that same volatility. And it's also constructive because we're coming off of this base here. So really not a lot of fundamental news with respect to Tilray. They report earnings in early March, one of the first few days, but the sector still has some momentum from those canopy growth earnings yesterday. So let's just take a quick year-to-date look at the sector, and we can see some incredible gains there. This is a Canadian sector, MedMen Enterprises. You can see how high this stock was during that boom in late 2018. Well, it is up 906% year-to-date. Tilray up over 600%. Sundial up over 500%, Alexis.
Wow, those are incredible gains in a relatively short amount of time. Want to turn our attention now to TikTok because we know it was supposed to be sold, at least its U.S. division, sold to Oracle and Walmart, but it looks like President Biden's administration has different plans for this deal.
Yeah, and you can imagine why that would be. There was a lot going on with this company in the beginning, and that very abrupt order by President Trump in the late days of his presidency to order a sale. We got CFIUS involved, that's the Committee for Foreign Investments in the U.S., and there are several legal challenges to it still pending. Now, the Wall Street Journal had this exclusive out this morning going into details and saying that there's probably going to be a new stance with respect to this. Not surprising given the change in leadership. Also want to mention the latest here, Charlie Gasparino tweeting that there's concern over the role of former Treasury Secretary Mnuchin in the deal, so that they're probably going to wait until all the latest Treasury and DOJ appointments are made in the political arena. After that's done, they can revisit this deal, but you have to imagine there's going to be a different tack. Although I will say the Biden administration has said that they will continue to be tough on China here. And there were a couple of other developments. You know, Walmart has been actively pushing for this. They're still working with TikTok pretty closely, trying to monetize that app and help with deliveries. And Oracle itself. Now, this is a Larry Ellison play, and maybe that's not going to fly with the current administration. But you got to think that there's probably going to be something that happens with this, including a sale, just not to the extreme in some of the more bizarre aspects as we saw with the Trump administration.
All right, Jared, what else is on your radar here today for us? I think Facebook, right, looking at expanding into new ways of communications, wants to take on that popular app Clubhouse. Clubhouse.
Oh, my goodness. Could it be that Facebook is going to clone yet another popular app? Well, there are a lot of interesting details behind this. Clubhouse is a kind of voice message chatting app that's become very important to a lot of businesses and also has that social aspect to it. Now, Melody Hom, kind of behind the radar here, she was doing a story on Clubhouse, did a deep dive on it, and was actually in some of the rooms last week when Mark Zuckerberg himself appeared there. And it turns out that there was a lot of speculation that when he came on February 4th last week, that was a signal that Facebook would in fact be buying Clubhouse. Well, it seems that they've done the opposite. And just a couple of more notes from Melody on this. She said the night that Zuckerberg joined, two Facebook executives, this is Fiji Simo, he's head of the app, and also Andrew Bosworth, vice president of AR and BR, they were the advertised guests. And they also stayed on after Zuckerberg left the conversation. As soon as Zuckerberg left, the app got glitchy, and moderators lost control of the rooms, including the side rooms, getting kicked out of them at times. So lots of interesting things regarding this story, but you can bet that Mark Zuckerberg and Facebook are going to go ahead with this, and Clubhouse got to be a little bit maybe worried. I don't know.
But well, Zuckerberg with the deep pockets they have, over at Facebook, maybe they should be a little worried. But imagine that, right? Being Melody, just hanging out there in the Clubhouse app, and oh boy, Mark Zuckerberg just joined. Pretty incredible. Sometimes it's all about the timing. All right, thanks a lot, Jared. At this hour, we've got Federal Reserve Chair Jerome Powell addressing the Economic Club of New York, and our Fed correspondent Brian Chung I got a look at his prepared remarks. And I know we all want to know if he's going to talk about future moves on monetary policy. Is he going to talk about inflation and the health of the economy?
Yeah, well, all of those things were touched on in his prepared remarks, which were just released about a few minutes ago. He's beginning those remarks at the Economic Club of New York this afternoon. And some big headlines from those prepared remarks. He said that at present, we are a long way from such a labor market, referring to a labor market that could show signs of bringing in low and moderate income workers, as was the lesson out of the last financial crisis. The Fed chairman adding in a pretty clarified part of that speech that he said, quote, "This means that we will not tighten monetary policy solely in response to a strong labor market," end quote. Now, the title of this speech was Getting Back to a Stronger Economy, labor market in specific. And he was talking about the idea of how long the Federal Reserve could keep monetary policy accommodative to try to pull in some of those marginalized workers, which, as we know, have been so devastated by this crisis from the pandemic. Obviously, about 10 million Americans still on the sidelines as we approach the one-year anniversary of COVID-19 here in this country. The Fed chairman saying that the Federal Reserve will be patient with its monetary policy in the meantime. So not an ounce of hawkishness in this speech. It sounds like the Federal Reserve chairman, at least from his vantage point right now, sees the case for keeping monetary policy easy for quite some time. Alexis?
All right, thanks a lot for the update there. I want to stick with the markets now and bring in Kathy Jones. She's Chief Fixed Income Strategist at Charles Schwab. Kathy, always good to see you. So you just heard what Brian had to say, sort of recapping Powell's comments today. Nothing seems to be, in those comments, seems to be moving the markets at the moment. What do you make of his continued take on patience when it comes to policy and being very accommodative?
Yeah, it's true that he has not said anything that he hasn't said many times before. It's just when the Fed chair says it, it has more weight than perhaps other members of the Fed. But I think that we're really at an intriguing point right now in terms of monetary policy. You know, we have never, in our experience, had a Fed that actually was trying to lift inflation and is signaling that it's going to wait for inflation to move up before it even considers doing something about it. It's really a very unique moment for us. And obviously, they're looking back at the last recovery being so slow and inflation underperforming their expectations for a long time. But when you take what he's saying and you combine it with the potential for a really large fiscal stimulus package, you can say, well, maybe the next year or two, we probably won't get much inflation because there is all that slack in the economy. But what about 2, 3, 4 years down the road? Is this really setting us up for higher inflation? And I think that's what the market is keying on these days.
Do you think, though, well, how much of a risk do you think higher inflation is for the market if it's, 2 or 3 years down the road? Should the market be focusing on it? Should the market be pricing that eventuality in?
Well, yeah, that's what markets do. And so they're going to start doing it, as they have to some extent so far. But I think it's really a question of the magnitude of how much inflation do you price in. Will we actually get much above the 2 or 2.5% inflation rate down the road, or is that really the ceiling as it has been for so long and it comes back down? I think there's more chance of it moving above that level in the next couple of years than we've seen in many, many years, assuming we get the kind of fiscal stimulus that's expected and we have this shift in attitude by not only the central bank, but the fiscal authorities, that it's okay to run the economy somewhat hot. It's something we just haven't seen in the past. So you look at the size of the fiscal package. If our output gap is around 400 to 450 billion, and we're going to put $1.5 trillion or $2 trillion against it, we're going to get a lot of stimulus in the economy. And that's going to be an interesting dynamic for Fed policy and for inflation. I think at a minimum, we get more volatility in inflation going forward than we've had in a long time.
I want to talk about just the short term for a moment and the frothiness that we seem to be seeing in this market. Yes, we have strong earnings. Yes, we've got fiscal and monetary policy hopefully coming down the pike very soon. But with all the discounting we're seeing in the market, do you think we're primed for some consolidation here, at least in the short term?
Yeah, I think our view is that you have to be a little bit careful here because we've had we've had the frothiness, the meme stocks activity, which speaks to a lot of excess capital kind of sloshing around looking for a place to go. And I think that it is probably time to be a little bit cautious. I know that we are looking from a sector point of view to be overweight financials and healthcare and underweight utilities, trying to benefit from some of the big trends and avoiding some of the interest rate risk in the market.
Before we let you go, I know fixed income is your specialty. Yields are low all over the place. Where do you see money flowing into the bond market right now?
Well, because of the combination of very easy monetary policy and expansive fiscal policy, it's a great environment for credit and for risk taking. So we're seeing money still go into things like high yield bonds and emerging market bonds, which we favor. We like emerging market bonds as a global reflation play. We're also seeing it going into bank loans. And I don't see really that looks terribly attractive unless you think the Fed's going to hike rates. But EM is where we think that there's a case to be made that it could outperform this year.
All right. Kathy Jones, Chief Fixed Income Strategist at Charles Schwab. Good to see you.
Nice to see you.
All right, coming up, the CEO who played a role in convincing Elon Musk to go all in on Bitcoin. We're back right after this. Welcome back. Tesla's Elon Musk isn't the only high-profile name investing in Bitcoin. The business intelligence software firm MicroStrategy is actually the first publicly traded company to add cryptocurrency to its balance sheet. It currently holds about $3 billion of the digital currency. And CEO Michael Saylor tweeted at Musk back in December, urging him to get into Bitcoin, saying, quote, Elon Musk, if you want to do your shareholders a $100 billion favor, convert the Tesla balance sheet to Bitcoin. Joining us now is MicroStrategy CEO Michael Saylor. Welcome. Thanks for being here. So Elon Musk listened. He went all in, $1.5 billion worth. What does Musk going into Bitcoin mean for investors and for the future of the digital currency?
Well, I think in the current macroeconomic environment, most corporations are beginning to realize that their cash is going to be a depreciating asset, and they need to turn their balance sheet into an appreciating asset. So the obvious thing to do is to convert dollars that are being inflated at, expanded to 15% a year into a scarce digital asset. And that's what Bitcoin is. So Elon Musk is very progressive and Tesla is very progressive. I think this is part of a trend toward the digital transformation of balance sheets as people move from analog, traditional treasury assets like cash and bonds into Bitcoin.
I want to
Michael,
bring in finance Julia. Oh, I was just going to say hello to Julia, and there she is.
It's Julia LaRoche here. Let's double click on that. You're talking about a digital transformation of the balance sheets. And of course, we know, I guess historically, folks have been pretty conservative about the balance sheet. You did have a seminar last week. I want to kind of elaborate a bit more on the pitch that you're giving to executives on this, and what is kind of the hurdle that must be overcome for them to get comfortable with adding this digital asset to their balance sheets?
Well, I mean, the pitch is Bitcoin is digital gold, and it's sitting on the world's first digital monetary network. That network does the job of gold 1,000,000 times better than gold. You can move it at the speed of light. You can program it 1,000,000 times a second. And it's been appreciating versus the US dollar more than 200% a year on average for a decade. So I think at this point, Bitcoin has emerged as the institutional safe haven asset. If you're a corporation and you generate $1 billion in cash flow and you buy back your stock, you're $1 billion closer to insolvency. If you borrow $1 billion to buy back your stock, you're $2 billion closer to insolvency. If you want to run your company to the benefit of your shareholders, of your customers, of your employees, and of your local community over the long run, you can't decapitalize the company. And in the modern era, cash is becoming a liability because the money supply is expanding at 15%, and the purchasing power of the cash keeps degrading. Holding a 15% degrading asset for 8 years means you lose 75% of shareholder value. So the pitch is convert your balance sheet from a liability into an asset to the benefit of your stakeholders and use the world's first digital monetary network to do it. Bitcoin was engineered to do this.
I do want to kind of bring this topic up with you. Elon Musk, of course, has been tweeting a lot about cryptocurrencies, Doge in particular, also adding #Bitcoin to his Twitter profile. And if you look back a couple years ago, there were some issues around tweeting about Tesla, taking Tesla private. There's a whole SEC settlement involved there. So what do you think of regulations in this space? And when you see more publicly traded companies add it to their balance sheet and how they can kind of talk about it on social media, do you think we'll see regulations come in? And if so, what should those look like?
Well, I think there's been a great advance in regulatory clarity over the past few years. I think the IRS and the SEC have both designated Bitcoin as property, and I think that's been very good for the asset class. I think that we can expect a few more regulatory advances that'll provide more clarity. And as Bitcoin approaches regulatory parity with other types of assets like stocks and bonds and gold, I think it's going to remove the few remaining barriers that have given institutions pause. I think 1,000 institutions, 1,000 corporations started adopting Bitcoin as an asset for investment in the past 12 months. I think there'll be an avalanche of thousands more that'll be coming as they start to see that this is a very high quality Treasury Reserve asset on parity with other assets.
You know, it's one thing, Michael, to talk about companies investing in Bitcoin and seeing it take off on Wall Street, quite another to see it be adopted and go mainstream on Main Street. Today, we saw Twitter's CFO come out and say in an interview that they're thinking about playing in Bitcoin to the extent that they might actually pay vendors and employees in the cryptocurrency if they ask for it. What do you think some of the hurdles are to getting there? How do we get the consumers to buy in on the idea that Bitcoin could possibly take on the US dollar?
Well, you know, I don't think Bitcoin is going to take on the US dollar. I think that cryptocurrency is a misnomer. Bitcoin's digital gold. What Bitcoin is doing is rapidly replacing gold as a non-sovereign store of value. We've already got something on the order of 120 to 150 million people in the world using Bitcoin as digital gold. I think that number is going to rapidly march through 200 million, and we'll have 1 billion people that want to hold digital gold on a mobile device in the next 5 years. So when you think about it, I think the right way to think of it is I want to convert my long-term treasury reserves into something which is 1,000,000 times better than gold, that moves at the speed of light. And it doesn't matter if you're a company or you're an individual or an institutional investor. They all have the same problem, which is how do I preserve my monetary energy over long periods of time? Expenditures day to day that you would normally do in dollars, people will continue to do in dollars. The payment rails are going to be MasterCard and Visa and PayPal and Square Cash. The euro and the dollar are going to do just fine. I think that the people that ought to be really concerned are gold bugs. Anybody that's storing their money in gold is got a big bullseye on their forehead, and that's at risk.
Michael, I guess one last question before I let you go. I should point out that you are the longest serving publicly traded company, CEO of an enterprise software company. So you've obviously experienced a lot. You mentioned earlier digital transformation, now digital transformation of the balance sheet. And I kind of want to bring this up with you and tie it in here. How do you think about this kind of generational shift? I've seen surveys at least a couple of years ago, kind of how more millennials favor cryptocurrency, Bitcoin, things like that. But as you kind of go up in older generations, not so much. So how do you kind of think about it as also a generational play here for companies?
Well, I think the millennials, they discover things quickest. I mean, it was college students that found Facebook, but eventually everybody joined Facebook. I think it was 20-somethings that loved texting on mobile phones, but eventually Warren Buffett bought Apple stock. I think that millennials love Bitcoin because it's digital gold, and there's no way that 100 million people can buy a bar of gold through their mobile phone, but they are buying digital gold on Square Cash or PayPal or the like. But having said it all, they're just the vanguard. Eventually, the entire society is going to buy this. Institutions are coming into it. The Generation Xers are coming into it. And so it's an idea whose time has come. The millennials are leading the way.
All right. We're going to leave it there. To be continued for sure. Michael Saylor of MicroStrategy, thanks for being with us.
Thanks for having me.
Julia, I want to make a hard turn here and talk about a story that you covered earlier, and that is that PepsiCo's Quaker Oats changing the name officially of its Aunt Jemima maple syrup to Pearl Milling Company. And I think it took about a nanosecond for people to take to social media and start criticizing that name. So fill us in here.
Immediately, I feel like the internet's just buzzing about this story. But of course, Alexis, if you go back to the summer of 2020 and a lot of kind of the social unrest that was happening at the time, and a lot of companies having to really look at their brands, especially if they had racial stereotypes, and rethink their own brands. So of course, Pepsi, which owns Quaker, which owns Aunt Jemima's brand, they dropped the character image in the fourth quarter of last year and said that they would eventually come up with a name change. And now they have revealed that name change, and it is Pearl Milling Company, as you were just referencing. And they kind of gave a bit of context as to what that was. It was founded in 1888 in St. Joseph, Missouri, and it was the originator of what they say is the iconic self-rising pancake mix that would later become known as Aunt Jemima. So this rebrand will hit store shelves in June 2021. In the meantime, they will continue to sell through the remaining Aunt Jemima products that no longer have the character image. So this is something I know you have covered. A lot of brands having to rethink their names and also their images.
I'm sure we'll see those Aunt Jemima bottles going for big money on eBay. We'll see how consumers take to the name change. Thanks so much, Julia. Coming up here on Yahoo Finance Live, how Broadway theaters plan to reopen in a COVID world. Finally, some good news for live venues in New York today. Governor Cuomo announcing Barclays Center and other large arenas in the state can begin reopening at reduced capacity February 23rd. And this good news comes just days after the governor ordered hundreds of COVID-safe pop-up concerts featuring big names like Matthew Broderick and Hugh Jackman. Depending on how those go, it could be curtains up for Broadway. Joining me now is president of the Broadway League, Charlotte St. Martin. Charlotte, good to have you here. Certainly encouraging news. It's almost been a year since our Broadway theaters have gone dark. Just would love to get your take on the governor's plans for these pop-up concerts. What do you make of them?
Well, anything that gets the incredibly talented creatives of Broadway in the faces of their fans is great for us. Clearly, these are not going to be Broadway shows, but a lot of the entertainers are definitely people who are associated with Broadway. So I know the governor is trying to remind the world that New York City is the capital of arts and entertainment in our country, and I think these concerts will do just that.
And also so many jobs dependent on Broadway, not just the actors and stage crew, but people front of house, restaurants. I mean, there's sort of a cascading effect when it comes to the Broadway industry, about 100,000 jobs surrounding that industry. But when it comes to getting back into the theaters, the governor was talking about how COVID testing is going to be a part of that. Do you have any idea if the theaters are going to be doing that? If we're going to have to come with a negative test to the theater, sort of what will the logistics be of something like that? It's a huge undertaking.
Well, at this point, we're not looking at testing for the audience. We do believe that rapid testing will be done every day for the cast and crew of the theaters because they work in close confinement, can't wear masks. So it's important that they be tested daily. But it's probably 6 to 9 months before we're actually open. And who knows what we'll be doing then. I've been saying for months, I would love to see the theater goers come in, have a certificate or something that says I was tested and I'm COVID free, but don't know that that will be the case. We know that we won't open until we're assured that it's safe for theater goers, cast and crew.
What about, I'm sure theater owners, producers are thinking about this now, even though, as you say, reopening may not come for another 6 to 9 months. But how do you envision that Broadway experience being when it does happen? What will, buying concessions and merchandise look like? There's going to be fewer people sitting in the audience for sure, but what might the experience be like?
Well, we know that we will be opening with masks, unless there's some miracle we haven't heard of yet. And there'll probably be different ingress, regress, how you get into the theater. We're analyzing over 100 touch points from what the theater goer experiences, whether it's getting a playbill or taking their ticket or getting a soft drink from the concession stand. So we're looking at all of those things. And I think you will see a lot of contactless services throughout the theater. What else we see, we don't know just yet. I mean, there are new products and new findings virtually every other week, it seems. So we're working on it. We have 5 task forces working on just protocols alone, not to mention all of the other aspects of getting open. We do think that we will have more than socially distanced audiences. We're not able to operate in the long term with a socially distanced audience. So if the audience is socially distanced, it just means that we couldn't sell enough tickets. But we anticipate that with the incredible demand that's pent up, that theater will come back very soon.
Well, let's talk a little bit about that capacity and what theaters will be able to do. I mean, is it in the long run cheaper to have no show than to have a show that's half full when you think about all the overhead costs that the theater has to accumulate?
Well, and that is mostly true. I mean, there will certainly be exceptions. A 1-person show, a 2-person show, small orchestra, no orchestra, those could potentially be socially distanced, but the traditional Broadway show with the cast and crew that it takes to put that show on, it will not last in a socially distanced environment. The costs to produce and run a Broadway show are so high that it just is impossible. If we open to small audiences, you will probably see shows not stay open for very long.
You know, I saw, we all saw the success Hamilton had going to streaming. We had Ma Rainey's Black Bottom on Netflix do very well. I know that Come From Away and Diana are also going to be filmed shortly and released. Are the dynamics of the theater, of live theater, going to be changed forever? And might we see more shows do this? Maybe a two-pronged approach. Yes, they're on the stage, but yes, we can also stream them, you know, from our favorite streaming service.
Well, we certainly have been talking a lot about live streaming. Unfortunately, with the financial model that we have now, live streaming just won't work. Shows like Diana, like Hamilton, or actually movies. They were made as a movie and hopefully will receive the income that would offset what it costs to make that movie. But with the union contracts that we have, there's just really no way to live stream, because in a theater, you have 1,000 to 2,000 people see a show at night, and the contracts that are there for live streaming aren't actually able to pay those expenses, at least unless you're a big giant hit like a Hamilton.
Mm-hmm. Charlotte, before we let you go, one way that theater owners could try to recoup and producers recoup the losses is to charge higher prices. Broadway prices are already pretty steep. Do you see that happening? I mean, could Broadway ticket prices go up, and will the pent-up demand people say, okay, we'll pay it?
Well, I've never thought that they would go up more. The biggest change to Broadway in the last decade has been the increase in premium pricing. But 5% or less of the theater tickets are in the premium priced range. So you may have $800 tickets for Hamilton, but then you've got a lot of much lower price tickets. And that's traditionally the way the model on Broadway is now. But there's no question that the world is changing, and we really don't know what we'll come back to, but I don't think people need to think about coming back to higher price tickets.
Okay, well, that's good news. Charlotte St. Martin, president of the Broadway League, thanks so much for being with us. We'll be watching. Want to get those theaters back open. Coming up, we're going to talk ETFs with Tom Lydon, and we're also going to recap the day in oil for you. Welcome back. Time now to get the latest on the oil markets, which closed just moments ago, and some news crossing about Citi. Analysts there pretty bullish on the price of Brent. Jared Blickery is back with that and more. Jared, what are they saying?
That's right. They're expecting $70 Brent crude by the end of the year, and that is quite a far stretch from where we have come over the last few months. And crude oil, WTI just settled at $58.68 per barrel. That is the highest settlement since January of last year. So very much on the way to recouping those pre-level or pre-COVID losses when it was falling from basically $60 to $65 per barrel. So here's crude oil today. Here's our chart. This is actually over the last 5 years. We're going to narrow this down to the last 5 days. In fact, crude is up 8 days straight now. Haven't seen a stretch like that in some time. So we're up 3% over the trailing week. Year to date provides another interesting picture here, up 23%. So Citi looking for Brent at $70 a barrel. And I will bring up that chart here. We can see it's currently at 61.49. This is based on the Saudis really continuing to aggressively cut supply or make sure that there isn't an oversupply of oil. And once things pick up in the back half of the year, they expect it to soar. So here's a quote from the report. Physical markets have been reflecting tighter fundamentals with a strengthening backwardation. This leads to structural backwardation, and that further encourages financial flows to crude oil. What's backwardation? That's when the current price, the front month for a contract, let's say February, March, that is above the later dated months. That would be April, May, June. So it just points to a tightening demand increase and also dwindling supplies. So backwardation, good for the price of oil. Hopefully it doesn't get to be too high, though. $80 a barrel, remember that caused some consternation years back, Alexis.
Oh, yeah. Backwardation, the word of the day. See, we learn something new every day. Thank you, Jared. Time now for our ETF report brought to you by Invesco QQQ. Joining me for that is Tom Lydon, CEO of ETF Trends. Tom, good to see you as always. So 2020, we know, we talked about it ad nauseum, was a record year for ETFs. And already, we're about 6 weeks in. It looks like appetite for these things not subsiding. What are the latest numbers?
No, it's true. It hasn't slowed down, Alexis. Like you said, 6 weeks in, we're touching almost $90 billion already. We had a record year last year, as you said, over $500 billion. So more money flowing into areas like themes, technology, EV, cybersecurity. So we're moving away from traditional indexing for sure. Also, we're seeing some appetite overseas as the dollar continues to not look as strong. So that means local currencies are actually helping give areas in developed nations a boost, and especially in emerging markets.
So I know you always bring your picks along with you, which I just love. I love when we can get specific whenever possible. So in the emerging market space, what do you like right now?
Well, if you look at China, and there's a lot of discussion about China right now, and if you look at MCHI, which was the iShares MSCI China Fund, up 17% so far year to date. Again, it's more this emerging market boom. And then when you look to financial technology, we've talked a lot about Cathie Wood and the folks over at ARK Invest. There's the ARK Financial Innovation ETF. That's up over 21% year to date. When you think about online buying, mobile banking, there's a lot of high-tech companies that are in there. Tencent, Zillow, people are buying more homes. ICE, the New York Stock Exchange. There's a lot of trading that's going on, so that's really doing well. If you want to stick in emerging markets and specific online buying that's focused in China, there's the Emerging Market Internet and E-commerce ETF, EMQQ, Tencent, Alibaba. There's also Pinduoduo, which is another company that we don't hear much about, but it's the third largest online buying company in China. And then finally, bringing in our friend Kevin O'Leary, Mr. Wonderful. He's done a great job with a fund called OGIG, O-G-I-G, which is a global internet giants ETF stocked with FANG companies. And also you've got Microsoft in there, you've got Shopify. Think about all those companies that have helped the average small business redirect their businesses online this year during this COVID environment, where they've been able to thrive by embracing technology.
Yeah, you mentioned Kevin O'Leary. We had him on the show just a few days ago, and also Kathy Wood, our own Jen Rogers, did a great sit-down interview with her, and folks could check it out on the website. Before we let you go, we were talking to Michael Saylor earlier, a big advocate of Bitcoin with his company MicroStrategy. Do you think we're going to see a Bitcoin ETF?
I do. So Matt Hogan, who is one of my best friends in the ETF space, who's over at Bitwise, he spends a lot of time going back and forth to Washington, meeting with the SEC, talking about the prospects. Without no inside scoop here for sure, but the SEC is getting more comfortable as there's greater adoption of people buying Bitcoin. The big thing for you and I would be, rather than having to buy on a Coinbase account or buy a fund that actually owns Bitcoin but doesn't trade to the actual price of Bitcoin, it would be wonderful if one point in time there was a Bitcoin ETF which actually reflected the current price of Bitcoin and didn't gouge you from a pricing standpoint. I think it's coming, and the demand for Bitcoin, as you just talked about, isn't slowing down.
Yeah, sounds like a great idea, and I'm sure it's just a matter of time. Tom Lydon of ETF Trends, thank you.
Thanks, Alexis.
Coming up here on Yahoo Finance Live, the CEO of Signet joins us to talk about the outlook for the jewelry industry. Welcome back. Signet Jewelers, which owns Zales, Jared, and Kay Jewelers, among other brands, had a breakout holiday quarter led by a 60% surge in online sales. Joining us now is Gina Drosos. She is Signet's CEO and our very own Julia LaRoche, also here for this conversation. It's so good to have you here, Gina. Look, I know that you've been going through a transformation. You closed a number of brick and mortar stores last year and really poured resources into online. How are you getting folks to agree to buy things like diamonds over a computer?
You know, some people said it couldn't be done, but that's really not the case. I think there are two things that have unlocked our capability. One is building a trusting relationship with customers. Really what they're looking for in the jewelry business is connected commerce. Good example of that would be buy online, pick up in store. We saw a huge surge in that the week before Christmas, mostly among men who still wanted a touch point with the store environment, but liked the freedom of being able to shop for their product online. So we're really connecting commerce together and creating that trusted relationship. And then the second is visualization. You want to know how big, the pieces that you're buying. I mean, how long really is an 18-inch chain? Where will it fall on my neck? And we've brought all kinds of new tools to our website and digital experience, which are really helping customers be able to visualize the jewelry in advance of buying it.
Jenna, as Alexis was just referencing, a really strong holiday quarter. And I imagine now that we're heading into Valentine's Day, I should tell my husband, by the way, that folks are continuing these kinds of trends. Do you think the e-commerce part of it, though, will continue even as things start to open up, and why? And what are you exactly seeing as it relates to that?
I do. I think customers have become more accustomed to buying things online in every category. And the way I think about that is that challenges us to be an innovation leader so that we can bring the best service and experience to our customers whenever and however they want to shop. I'm encouraged that e-commerce will continue to be strong for us. When we started our Path to Brilliance transformation, we had only about 5% of sales in e-commerce, but we've been north of 20%, even with all of our stores reopened in our third and fourth quarter. And that's, I think, an important indicator that the digital experience that we're bringing is unique, differentiated, meaningful for customers. And so we need to continue to make that better and better.
Jenna, what would another round of stimulus checks mean for sales? I mean, the two that we've had prior during this pandemic, does it seem as though people were taking those checks and buying jewelry online?
Well, I think let's hope we get another round of stimulus checks. There are so many people in our country who desperately need that money and have really suffered through this COVID-19 crisis. We do usually see a benefit in our business from stimulus checks. And so whether those come, mid to late March or even after that, I think it's a good thing for the American people on all counts.
Jenna, we were talking earlier about the transformation under your leadership, of course, the digital transformation, but you've really transformed the company culturally. And, when it comes to diversity, I know you have some diversity news to share as it relates to some board appointments, but kind of share with us your own experience when it relates, as it comes to that, and what kind of results you have seen when you bring more diversity to the table, whether it's at the board level, the management level, and also the field level.
That's such a great question. Thank you, Julia. Diversity, equity, and inclusion has been a hallmark of my leadership career from the beginning. I believe that companies that are more diverse make better decisions. They have an ability to see 360 degrees, which allows them to see opportunities and act quickly on those. It brings a level of agility and innovation. It also allows companies to see risks or concerns faster and to address those head on with transparency and authenticity. I think it's an unlock for talent. Signet has a very talented organization. I'm so proud of our team and how quickly they've pivoted to the new capabilities that we've brought on. And that wouldn't be possible without a culture that encourages an entrepreneurial environment and the kind of innovation that we've been bringing. So people are bringing their whole selves to work, and we're really unlocking discretionary effort. So I think it's very important. What I think is really important about today's new announcement about adding diversity to our board of directors is that it better represents our company and the customers we serve. 87% of Signet employees are women or represent ethnic diversity, which is a tremendous statistic. Until this point, we had very strong gender representation on our board of directors, one of few public company boards with an equal number of men and women. And in fact, our women on the board take very strong leadership positions. 4 out of 5 of our committees are chaired by a woman. But we didn't have racial diversity represented at the board level. And I think that was a miss. I mean, we really want everyone in the Signet organization to be able to look up and see our values represented at the highest levels. So as we kind of embark on the next accelerated part of our transformation, we've brought on 2 new directors today who not only bring incredible skill sets, I mean, experts, great business leaders, entrepreneurial thinkers, agile, and lots of experience in the area of services and digital transformation, which we need. But they also represent a new level of diversity at the board level, which will inspire our entire organization.
All right, Gina Drosos, CEO of Signet, good to see you. We appreciate your time.
Great to see you too. Happy Valentine's Day.
Oh, you too. You too, Julia. Coming up next, Under Armour also had a pretty good holiday season. We'll talk about it right after this. We've got shares of Under Armour on the rise today after the retailer reported a surprise profit last quarter. Yahoo Finance's Sabine Marcellus has the details for us. Sabine?
That's right, Alexis. So right now we're seeing Under Armour shares. They're up about 5%. And this is after the company reported a surprise profit in the last quarter. That was not expected. And the way the company achieved this was by drastically cutting back on expenses and also strong digital sales. So just like Nike, Lululemon, and Target that have just been, riding this wave, big coattails of people wanting to wear athletic wear, even at home, even if they're not even working out. Under Armour has also benefited from that trend. So when you look at earnings per share, 17 cents, revenue 1.4 billion. Now for the fourth quarter, what we saw is net income, it grew to 184.5 million. And that is compared to a loss of 15 million a year earlier. So that's pretty significant. Now, when it comes to sales, they dropped 3% to 1.4 billion from 1.44 billion a year earlier, but it still beat analyst expectations. Now, when it comes to wholesale revenue, that fell 12%, but the direct consumer business grew 11% thanks to strong e-commerce sales. And another point having to do with sales, that North American sales went up 6%, but went down 6%, but internationally they went up 7%. So Under Armour, they're really outperforming when you talk about international markets.
Yeah, I'd say. All right, nice bounce back there for Under Armour. Sabine Marcellus, thanks so much. Looks like the market has now turned green All three major stock market indexes higher, with the Dow up now just about 90 points. Still to come on Yahoo Finance Live, we're going to be joined by the former CEO of TikTok. He's going to join my colleagues Adam Shapiro and Shauna Smith. They're going to talk about his new SPAC. He'll also probably, I would think, weigh in on what the Biden administration is going to do with the TikTok, Walmart, Oracle deal. So lots to unpack there. More to come right after this.
Democrats making their case that former President Donald Trump was responsible for the deadly January 6th riot at the Capitol. Anthony Scaramucci will join us with his reaction to day 2 of the trial and how he sees this impacting the political landscape going forward. Oracle and Walmart's deal to buy TikTok's U.S. operations is put on hold as President Biden reviews the Trump administration's efforts to address potential security risks. We're going to talk a little bit more about that. And later this hour, we'll talk to former TikTok CEO Kevin Mayer. He's joining us about his Forest Road SPAC making an acquisition of Beachbody, the deal valuing the combined entity at $2.9 billion. Welcome back to Yahoo Finance Live. It's the last hour of trading. I'm Shauna Smith.
And I'm Adam Shapiro, and in that last hour of trading, Shauna, we have gone positive on the indices. The S&P 500 up by 7 points. You got the Dow now up roughly 119 points, and the Nasdaq is up 17 points. We're going to keep an eye on all of that, but some of the stocks we're also keeping an eye on. For instance, United Airlines. So a couple of big things with United today. First, that stock is up by about 1.5%, but it's news that they're taking part in a SPAC with the electric plane maker Archer. Now, the deal is that the actual SPAC is going to be with Atlas Crest Investment, which is the SPAC. And when this closes, what you're going to eventually have is United Airlines committed to purchasing up to 200 electric aircraft that will be used for their hub flights when these things get FAA approval. It's a low carbon way to get to United's hub airports, for instance, Chicago O'Hare. So that's big news for United, and that stock up today over 1%. Then there's Boeing. Let's talk about the traditional kind of aircraft manufacturer. Shares are down by about 1%. A couple of different things hitting Boeing today. First, you have Emirates Air saying that they will not take delivery of what's going to be the 777X wide body that can seat up to 406 people. They're not going to take delivery until 2024. Originally, this plane was supposed to be ready at 2020, way beyond or way behind in schedule. A Boeing spokesperson, however, has said, and they told this to Reuters, that the plane maker still anticipates the 777 deliveries actually to start in late 2023. Shauna?
Adam, I'm taking a look at GM. So the stock under a bit of pressure today. A couple of things going on. They had earnings out this morning. They were actually better than expected. EPS and revenue beating on both the top and the bottom line. Adjusted earnings per share coming in $1.93. Revenue $37.5 billion. That's a 22% jump from just a year ago. GM saying that it does expect to spend between $9 and $10 billion this year. $7 billion of that on electric vehicles and autonomous vehicles. But you can see the stock under some pressure today. Shares off just around 1%, although well off the lows of the day. Part of that, though, has to do with the fact that GM warned that the chip shortage that we've talked about a couple of times here on Yahoo Finance, that could cut earnings by up to $2 billion this year. So worrisome sign here for investors. That's a big reason why the stock is in the red today. Then flipping over to Lyft and Uber. So two stories going on here. They both have earnings. Lyft was out after the bell yesterday. We're going to be giving you Uber's results after the bell today, but you can see both of the names in the green. So let's talk about Lyft's results first. Their 2020 revenue declined by 35% to $2.4 billion compared to a year ago. Instead, though, investors were really focused on the fact that Lyft has been cost cutting, the efforts there, and that, of course, could set the company up for a better future. There are some signs that the business is starting to recover from the pandemic. The average revenue per rider coming in at $45.40. That's a record high, actually, for Lyft. So Uber's results, of course, that's going to be a big name to watch after the bell today. You can see the stock up just around 6% ahead of those results. The stock hitting an all-time high earlier today of 63.45, so trading not too far from that level right now. But first, let's get to the latest when it comes to the Fed. We had Fed Chair Jay Powell speaking just a few minutes ago at the Economic Club of New York. He was discussing the state of the U.S. labor market. We know that we got that weak jobs report out last Friday. We want to bring in our Fed reporter, Brian Chung, for more on this. Brian, what can you tell us?
Markets are that moved by what the Fed chairman said in his first remarks since the Fed kept interest rates at near zero about 2 weeks ago. But the Fed chairman offering some thoughts on the labor market and where the economy stands, noting that the Fed has changed its framework of thinking, which will allow the Fed to keep its accommodative policy lower for longer. Here's what he told the Economic Club of New York just an hour ago.
This change reflects our appreciation for the benefits of a strong labor market, particularly for many in low and moderate income communities. Recognizing the economy's ability to sustain a robust job market without causing an unwanted increase in inflation, the statement says that our policy decisions will be informed by our assessments of the shortfalls of employment from its maximum level, rather than by deviations from its maximum level.
Now, all of that sounds fairly dry and boring, but he did add immediately after that, quote, "This means that we will not tighten monetary policy solely in response to a strong labor market." Translation, just because we see some hot employment reports at some point down the line, that does not mean that it's going to be a trigger for the Fed to raise rates. The Fed chairman added in a Q&A portion about 20 minutes ago that, quote, "We're not thinking about shrinking the balance sheet," to be clear, adding on both the balance sheet and interest rate policy side of things, that the Federal Reserve is not thinking about pulling that support. One other word that's worth mentioning that he said in his remarks today, patiently. Patiently is the word that he added with regards to the Fed's accommodative monetary policies. So for anyone watching, it seems like the dovishness continuing from the Federal Reserve. Adam, Shauna.
Hey, Brian, quick follow. Did he give any indication of what the Fed wants Congress to do regarding fiscal policy?
Yeah, well, I mean, obviously a hot topic with that stimulus package still being debated down in Washington, D.C. No surprise to hear that the Fed chairman shied away from offering thoughts specifically on fiscal policy. In fact, the Fed chairman again reiterated that it's not in his wheelhouse to be commenting on fiscal policy. But if you take a look at his prepared remarks, which are posted on the Federal Reserve website, you'll see that they did applaud what was in the last fiscal package, specifically the Paycheck Protection Program, arguing that a lot of the people who were on temporary layoff did appear to be supported by the PPP, which, as we know, had run out. So that could put some onus on some small business relief, at least in this next package, but nothing directly spoken to from the Fed chairman in the last hour.
All right, Brian Chung, thanks so much. Speaking of fiscal policy, we want to head to D.C. because we want to talk stimulus. But first, let's discuss what's happening as we speak right now. It's day 2 of President Trump's impeachment trial. Right now, we have the House impeachment managers laying out their case against President Trump. Jessica Smith is, of course, following this for us. And Jess, what can you tell us that we're hearing right now?
Yeah, Shauna, for the past few hours, the House impeachment managers have been making their case. They are trying to convince the Senate that President Trump did incite that deadly riot at the Capitol on January 6th. Today, they've been using the president's own words to make their case. They're pointing to his quotes, his tweets, his speeches in the weeks leading up to this event at the Capitol. When he said, the election was stolen, or when he implored his supporters to come to Washington, he told them on that day to go to the Capitol. He told them to fight. He told them to stop the steal. And when violence broke out, the impeachment managers point out that President Trump did not stop it. Let's watch.
If anyone ever had a doubt as to his focus that day, it was not to defend us. It was not to console us. It was to praise and sympathize and commiserate with the rampaging mob. It was to continue to act as inciter-in-chief, not commander-in-chief, by telling the mob that their election had been stolen from them.
Now, the impeachment managers do get 16 hours to present their case. We don't expect them to use all of that time. And once they wrap up, then the former president's lawyers will take over and present their defense. We have heard from some Republican senators today, speaking to reporters in between as they're leaving the chamber. And so far, several of them have said that they don't see anything, they haven't heard anything that would change their mind. You'll remember you need 17 Republican senators to join Democrats in order to convict former President Trump. Just 6 voted that this trial is constitutional. So we'll see if the manager's case convinces any of them to change their minds.
So a lot of attention on impeachment. What's happened with stimulus?
Yeah, well, today the House committees are all working on the different pieces of the COVID relief bill that fall under their jurisdiction. So we have the House Ways and Means Committee today debating things like the stimulus checks, the enhanced unemployment benefits, that expanded child tax credits. We have several different committees working on different plans for that nearly $2 trillion relief bill. Early this morning, the House Education and Labor Committee did pass their bill. They worked through the night to get that done, and that did include the $15 minimum wage. That hike would go into effect by 2025. It also included $130 billion to reopen schools, some $40 billion for higher education, money for childcare, and strengthened worker protections. The House is trying to get all of this done quickly and get this bill over to the Senate in time to send it to the president's desk before those enhanced unemployment benefits expire in mid-March. Adam and Shauna.
Thanks, Jess. We want to turn to the pandemic. The CDC out with a new study today that found that double masking actually works, and it really substantially reduces the risk of getting COVID. We want to bring in Dr. Awais Durrani. He's an emergency medicine resident physician at UT Health San Antonio. And Dr. Durrani, great to have you back on the program. Let's talk about double masks, because we've been debating this over the past couple of weeks. Now we have this report out from the CDC. So a 2-part question here. I guess 1, should we always be wearing 2 masks now at this point? And then 2, what type of masks should people be wearing?
Yeah, thanks for having me. Well, I think I'll kind of give you an example. When studies have been done amongst nurses and physicians in the hospital over the past year or so, the infection rates and hospitalization rates among doctors and nurses have been very low. And the reason for that is proper masking, wearing masks all the time. And we in the hospital obviously have N95 masks, but even over that, we wear surgical masks. And so I'm glad that the CDC came out with this recommendation today. My answer to your question would be whenever you're outside your home, I would recommend wearing 2 masks. Now, a lot of people I know wear bandanas or cloth masks. I would recommend wearing a surgical mask on top of that. Or wearing a surgical mask and then having a cloth mask on top of that. And that's really going to kind of help tighten any gaps around the edges and make sure that you're getting the maximum level of protection and making sure nothing is coming in from the outside. And if you happen to be sick, that you're not spreading virus particles as well.
Dr. Durrani, I want to go, I'm going to ask you to repeat for those of us who don't wear masks. I mean, I wear a mask every day because of the pandemic, but I'm not a doctor. So the cheap blue mask compared to the more expensive K95 or whatever derivative 95 that you wear, what order? Blue first and then the K over that, the 95 over that? Or if you've got a buff, blue mask and then the buff over that?
Yeah, so if you have a KN95 or N95 mask, you would wear that first and then the blue over that. That way you are protecting the lifespan of that N95 mask. Also, the N95 mask has a tighter seal. So you want that tighter seal to be closer to your skin to give you that maximum level of protection, and then having that second level of protection on top of that. Now, if you are wearing a bandana or a buff or anything like that, I would wear the surgical mask first. Once again, the surgical mask fits tighter around the nose and kind of bottom areas, and then wearing your cloth mask on top of that.
Dr. Durrani, we also got news out today, the FDA authorizing another Eli Lilly antibody treatments, of course, aimed to try and reduce hospitalizations. I guess the question is, to what extent do you think that this will help alleviate some of that pressure on our hospital systems?
Yeah, it'll help. Every little bit helps. I don't think it's going to be a game changer. For example, in our day-to-day practice, if you meet admission criteria, you get admitted. If you don't, you get discharged. There's a very small amount of patients that would qualify for this therapy and that would benefit from it. But that being said, when our hospitals are full and when we are needing every little bit of help that we can, this helps. And so I think it is a small piece in kind of the bigger picture that's going to help us kind of get out of this latest surge and back to some level of normalcy.
Could we, if we're going to do the double masking, could entertainment venues begin to open if you test the people who won't wear masks, who are singing or yelling or whatever? But if the audience is all double masked, would this be a protection in which we could get theaters and movie houses reopened?
Potentially, but not to full capacity. So we would still be recommending social distancing, 6 feet apart, making sure everyone gets tested, making sure that capacity is not reached and that we're kind of following local guidelines. So I think it could help. It could especially help in places that get to a herd level of vaccination and immunity quicker than other places. But at this point, I don't think it would be the kind of magic bullet that gets us back to normalcy. We need to make sure that we're still vaccinating, still social distancing, still making sure that we are not interacting with those that are outside of our pods as much as possible.
Dr. Owais Durrani, our thanks to you as always for joining us. We look forward to talking with you again soon. Coming up next, we're going to take a quick break, but when we come back, they're taking real estate listings virtual. Matterport's CEO on how they're helping buyers and sellers do deals safely and raising money in the process. We're back with that in 2 minutes.
Almost 40 minutes to the closing bell. Welcome back to Yahoo Finance Live. There's another SPAC deal in the works. This is a big one. It was $3 billion. Let's bring in the CEO of Matterport, RJ Pittman, to talk about the deal that's going to put several hundreds of millions of dollars into Matterport, about $640 million, when it links up with Gore Holdings 6 Inc. So congratulations. Thank you for joining us. What's Matterport going to look like after all of this?
Well, I think it's going to look like the same company that we have been for the last 10 years, transforming the built world, digitizing buildings, and creating, amazing 3D digital twins of properties all over the world.
RJ, this is going to unlock access to capital here. I guess, how does this impact your plans then to scale your business, at least in the medium to longer term?
Yeah, sure. I mean, Matterport today is in 150 countries. We are Matterporting everything from homes to high-rises, hospitals to hotels, and everything in between. And the business has been accelerating for the last few years. It's really exciting to see. With this transaction, we're really able to scale our growth. And that's exactly what this is all about. We've got a fantastic business model. We're working across all different types of buildings in all different countries around the world. And this now gives us the resources really to scale, because you've got 4 billion buildings out there in the built world, and that's our market. And so, this is one where scalability is really going to make the difference, I think, in getting to the market share that we are squarely focused on headed towards.
Help us understand that market. Is it mostly residential? I think it's probably commercial. And I know there's going to be a lot of commercial in Midtown Manhattan that you might be calling on you.
Yeah, I mean, let's remember, this is the largest asset class in the world, $230 trillion category, of which residential real estate, look, it's $160 trillion of that asset class. This is 3 times the sum total of all global equities combined, just to put that in perspective. And so residential real estate, 3D digital twins for that category has been where Matterport has really established itself as a category leader. But for the past several years, we've been expanding into manufacturing, industrial, as I mentioned, travel and hospitality, and for sure, commercial real estate as well, where there are literally billions of square feet of space to be Matterported, and we're well on our way.
RJ, what, I guess, direct impact has COVID had on your business, and how much more demand have you seen over the last 11 months or so as a result of it?
Well, we're a company that is setting out to transform this huge category through digitization. And I think one of the things that COVID has brought forward for many companies across many industries is that power of digitization, remote access to whether it's communications or doing business. We see this not as just a solution for COVID, but perhaps a way to be more efficient in business when we're on the other side of COVID. No doubt that this was a tailwind for us. Matterport has helped keep the real estate business moving forward in a really important way with our technology across all of those industries we've talked about, including in the design, build, and construction category as well. Everything was really affected by COVID. But now that our technology is in the hands of an even greater, broader audience, for us, it's just an opportunity to continue with what we've always been doing, but now we're going to do it at an accelerated pace. And I think COVID has awoken the world to these kinds of technologies that we should be using every day.
What kind of data can you share with us about when someone looks at a digital twin? I think I've got the definition of that correctly. The sales get closed without going to actually physically see a property, and the sales that go in conjunction with the digital twin. Do you share that data?
Well, here's a few things that I can say. First of all, why do customers like Redfin, for example, standardize on Matterport's digital twin for looking at homes, buying homes online? Well, because it is a dimensionally accurate, perfect digital twin in high fidelity 4K HDR imagery. We're the only company on the planet that can give you a true accurate model or twin of any space, frankly, with more information in it than if you were actually in the space yourself. You can take out our little digital measuring tool. You can measure the size of a wall, see if your artwork's going to fit on it, or if your couch is going to fit, in the living room. It's that precise on the one hand. And now what does that do for customers? Well, these online platforms like Redfin or nightly rental property platforms like Vacasa, HomeAway, VRBO are seeing 300% increase in engagement if you have that Matterport digital twin attached to your online listing.
We hear you.
Sorry?
We hear you. No, finish up.
Yeah, I was going to say, homes sell faster, 20% faster, and in many cases for a higher price, 10 to 12% higher price. And we move occupancy in the nightly rental category by 14 to 18%, which is just extraordinary for the world we're in today.
I don't think anybody minds moving a sale price about 20% greater. All the best to you, RJ Pittman. Congratulations on the SPAC. CEO of Matterport. When we come back, the National Black Farmers Association president will join us on why they are working to boost Black-owned farmland and end discrimination at the USDA. We're going to speak with him right after this.
Six Democratic senators introduced Justice for Black Farmers legislation this week. It's really an effort to expand Black-owned farmland. For more on that, we want to bring in John Boyd. He's the founder and president of the National Black Farmers Association. And John, it's great to have you on the show. First, just taking a step back, I guess, just talk to us about what you're hearing from Black-owned farmers or Black farmers, and also what does this generation of Black farmers need in order to succeed?
Well, farmers are struggling, and I thank you for having me. And there's been a long pattern in history of discrimination by the United States Department of Agriculture. And from the turn of the century, our numbers have been dwindling. We were 1 million Black farm families strong at the turn of the century, and we were tilling some 20 million acres of land. Today, we're down by the census about 45,000 Black-owned farms, tilling about 4.5 million acres. So the Department of Agriculture really needs to step it up right now. We've been out here protesting and raising the flag for assistance. And this past administration, Sonny Perdue, the Trump administration, has been the worst administration in history for Black farmers, where we've been totally shut out of the farm subsidy program, farm ownership loans from Farm Service Agency, from rural development. We've been totally shut out of these programs. So we're very hopeful that this president, the current president, Biden, will elevate our issues. And I had a chance to speak with him in South Carolina last February before I endorsed him. and he said that there would be much needed change for black farmers under this administration, and new blood and new leadership.
Let's talk about that. Let's talk about that, because it's not just the Trump administration. I mean, the denial of lending and subsidies to black farmers by USDA goes back decades. So this is a two-part question. How do we right that wrong? And you're opposed to President Biden's nominee, to the Ag Secretary, Tom Vilsack. Why are you opposed? It's a two-part question. I'll stop there to keep it simple.
Well, first of all, the Black Farmers Bill that's out there now by Senator Booker, and also the new senator from Georgia, put a separate parallel bill out there that I believe is going to help some of the issues that we're facing. So I'm really pushing that bill out there. Even as we speak today, there was a vote coming up 2 o'clock today that's going to be affecting us. So I've been on the phone all day today pushing that bill. But to answer your question, I'm not opposed to his nomination. I've got 2 telephone calls from the former Secretary Vilsack, and we spoke in depth about what I would like to see some changes from the way his style of leadership, based on the 8 years he was in there with the former President Barack Obama. When I was out there campaigning for the Claims Remedy Act of 2010 and riding my tractor to Washington and driving my mule and wagon trying to get assistance for black farmers, I expressed to the former Secretary Vilsack that he didn't do enough to help. But this is President Biden's pick. He explained that to me in a Zoom call, and this is who he wants there. And I'm going to give him a chance. I want to be perfectly clear. I believe there's a huge difference between former Secretary Vilsack and Sonny Perdue, who said he didn't want any tokens or lazy people on the committees and things of this nature. So I think there's a big difference in style of leadership, and we're looking for big things from this time from Tom Vilsack. So we won't give him a pass. We expect him to do something. And if he doesn't, I'm going back to the president and say, listen, this is the guy you want there, and we expect to get some much needed results. But I also would like to add, black farmers want fairness. We want justice. We want it to be included. So when these subsidies and programs are rolled out by USDA, we want to receive the benefits and services too. Nobody's asking for any handouts or anything like that. Black farmers are hard-working people. They're dignified people. They're deacons and preachers in their communities, and we're a very proud people. And we've been treated brutally for many, many decades by the United States Department of Agriculture. And this is a time for America to step up and get behind and help save the oldest occupation in history for black people, which is farming.
Hey, John.
Yes.
John, just real quick, because we only have about 30 seconds left, but I also just want to get your thoughts on the trade war with China and the tariffs that the Trump administration has implemented. It, of course, has affected black farmers, but it's really affected all farmers. What do you want to hear from the Biden administration specifically about that, and to what extent has it hurt farmers?
Well, we need the doors wide open with China because it's the largest trade partner for a commodity like I grow, soybeans. And under that trade war, we were devastated with soybeans selling $7 and some change a bushel. So we need that market open, and we also need new markets. So we're looking for President Biden to reestablish trade with China and open up new markets for America's farmers. And I'm for all farmers. What we're trying to say is we want to be included in all of these programs and all these rollout programs fairly and equally. Treat everybody the same, and you won't need a special bill to fix anything. That's what we've been saying. And the China trade war was really hurt America's farmers. It put the highest foreclosure rate in history for America's farmers was due to the China trade war. And we need to fix that and open up permanent trade between China and the United States.
John Boyd of the National Black Farmers Association, founder and president. Thanks so much for joining us. Well, coming up next, we're going to talk to Akamai's CEO. Shares falling today despite that better than expected report. CEO Tom Layton joins us next.
News on the move. Dallas Mavericks owner Mark Cuban confirms he told the team to stop playing the national anthem before all home games. Cuban made that decision last November after the NBA cleared the way, allowing teams to run pregame operations as they see fit. Several NBA players last season ran afoul of NBA requirements to stand during the anthem when they kneeled in support of Black Lives Matter. The U.S. Coast Guard rescued 3 Cuban nationals who were shipwrecked on an uninhabited Caribbean island. The 3 people spent 33 days on that island living on coconuts after their boat capsized. They were taken to a medical center in the Florida Keys where doctors say despite being dehydrated and suffering from fatigue, they appeared well. The Super Bowl champion Tampa Bay Buccaneers are celebrating their victory with a boat parade down the Hillsborough River today. Participants watching on shore are required to wear masks and to socially distance themselves from one another. Let's turn to something that should have been a celebration, and that would be Akamai. Their earnings beat yesterday was pretty good, but the stock under pressure right now, off almost 10%. The CEO is joining us, Tom Layton. It's good to have you here. And help all of us understand. You hit it out of the ballpark for annual growth in cloud security solutions. Revenue was up 25% year over year. What are the investors who are putting pressure on you today missing?
Yeah, well, they're missing a lot, and it is a little hard to understand. We had a great year. Security business now over $1 billion, grew at 25% last year. Overall company very strong, great financials, 11% growth in the top line, 16% on the bottom line, doing very well. And looking forward, the guidance we gave, a little bit above where the published street estimates were. Maybe they're looking for a lot more. Of course, our job now this year is to go deliver as best we can. I think, the combination of a great security business and a very strong CDN business that generates a lot of cash that we use to invest in new products for future growth makes Akamai a really great company.
Tom, you also announced a restructuring. I'm curious just to get a little bit more of your thoughts on this. I guess, one, why now, and why does it make sense for your company going forward?
Well, the first goal was to get all of our security product teams together in one group, and then just really focus on continued growth there. We had products we were incubating in enterprise security, our zero trust solutions, and in carrier security, and they're getting to be critical mass now. Put together, they'll probably do 100 million this year, which is double what we did last year. And now that they're getting to be at scale, we wanted to bring all security together. Be a lot more, I think, efficient. And also, we're starting to sell these products more together in bundles. Also, it's nice to bring our CDN-related products together with a platform team. I think we'll see greater efficiency, in getting, products out the door. And that team will be responsible for, the 5G products, IoT, new serverless computing applications. And also, we're unifying sales now. It made sense before to have, I think, 2 sales forces when media customers only bought media products and web customers only bought web products. But now all our customers are buying pretty much everything. Everybody buys security now. So I think these changes will make us be more efficient, and you'll see, strong growth from Akamai in the future.
Well, when we talked about your appearance with us today, and I think people often refer to Akamai as you make the pipes for the internet, those of us who are not perhaps tech savvy. Is it part of that, in combining the sales departments, is that maybe one of the hurdles you face, is getting people to understand what it is you actually are offering, or do they see you as a competitor against a behemoth like, say, Amazon because of their cloud services?
Well, Amazon is a competitor, also a very large customer. The cloud giant companies, many of them are our largest customers, and some of them also compete. And we compete very successfully and have, for 20 years. So I don't see, that, being an issue. It is sometimes hard to understand us in terms of what we do, but we're the market leader by far in web app firewall, in distributed denial of service defenses, in bot management and protecting accounts from bots that try to take them over, new services to stop malware from stealing data from enterprises and also from users that go to our customer sites. So I think very compelling story.
And we should reiterate that you did grow security revenue 25% to over $1 billion. As you said in the press release, puts you in rare company. So we appreciate your company here today, and all the best to you and the team at Akamai. CEO Tom Layton, thank you for joining us. Coming up, former Disney and TikTok exec Kevin Mayer discusses his SPAC's first acquisition, fitness company Beachbody, in a $2.9 billion deal. We got more for you right after this.
Former TikTok CEO Kevin Mayer, his Forest Road SPAC, making a big acquisition, setting its sights on Beachbody. It's a three-way merger that values a combined entity at $2.9 billion. We want to bring in Kevin Mayer, the former CEO of TikTok and former Disney executive. We're also joined by Carl Deichler. He is the co-founder, CEO, and chairman of Beachbody. And of course, our very own Brian Sazi joining the conversation. Kevin and Carl, congratulations to you both on this deal. Kevin, I'm going to go to you first. Just why Beachbody? Why does it make sense? And what's the opportunity that you see in this space?
Well, Beachbody really is the Peloton for everyone else, for the masses. They're adding a connected fitness bicycle to their already very successful business, which has been they've been in business profitably and growing for 22 years. And they have a great subscription video on demand business for fitness, which fits my background pretty well, having launched Disney Plus. They also have a great nutrition business that's growing and all takes advantage of social commerce. And that's one thing I noticed at TikTok, is that one of the highest growth opportunities in that ecosystem is for influencers to sell products that they believe in to their followers. And that's another thing that Beachbody does really well. And they're just a really well-positioned company with world-class executives, world-class product, and now 3 business platforms that are all very exciting. So when it came time for FRX to find a partner, we were inundated with more than 50 different companies that were interested in combining with us. Given my background and my partner Tom Stagg's background and the Forest Road team's background at Disney and premium IP and digital subscriptions and the rest, we felt this is just a great company to be partnered with.
Kevin, given that background, we saw what you did. You built Disney Plus really from the ground floor. So you understand markets and transitions. Why do you think Peloton doesn't have a lock on the connected fitness market?
Well, it's a big market with a massive TAM, and it's global, and no one has a lock on it. And one thing I noticed at Disney is that people will subscribe. There's no winner-take-all dynamic in the video streaming service business nor is there one in the fitness business. And there's no company, I think, that's better positioned already with a foundation of 2.6 million paying subscribers, which is bigger than Peloton. There's no company better positioned than Beachbody to take advantage of these tailwinds. And by the way, there are several growth vectors that are happening that are buoying the prospects of Beachbody. There is the streaming business that I worked on at Disney. That is a very high growth underlying marketplace that Beachbody is taking advantage of. There is a connected fitness. They're very similar to Peloton and bringing on a connected bike and at a much less expensive price point, a very high quality product, and also health and wellness. Generally speaking, there are three big growth opportunities, and Beachbody is positioned across all three in a way that I think is quite unique.
Hey, Carl, who are you going to target? I mean, some of us are more dad bod than beach bod. Who's the target audience for this?
Well, that's exactly the point, quite honestly, is as Kevin said, the price point of the Mix bike is around $1,300, which is exceptionally accessible, but it's not just that. What they are creating is very similar to what the Beachbody ethos has been for 2 decades, and that is making in-home fitness a gratifying and really enjoyable experience, a little bit less competitive than perhaps the leaderboard. And again, this is not a zero-sum game. Peloton does a terrific job, but what our goal is to get people results and reach the masses, probably 2 to 3 times the prospective audience that Peloton has because of our price point for our bike and our subscription service. And quite frankly, our approach to content, to Kevin's point, that is truly gratifying, interesting. It's like watching a reality show. This is what we've done for 2 decades to make that experience with the screen more than a workout that you dread, but instead an experience that you look forward to because it's going to be entertaining at the same time that you're getting results.
Carl, you have a big goal. Last year, if I have it right, 30 million sales. You have a goal to reach, 700 million sales just on the bike side. Are you having problems getting bikes to market? It's something that Peloton continues to highlight. They just can't get the supply to market in many respects to meet some of the goals they have.
Well, again, I can't speak to Peloton's situation except, it's a problem of their own making because the product is so popular. We're lucky that, in fact, one of the reasons that we decided to bring Mixed Fitness into this merger with FRX and Beachbody was the fact that their supply chain was so strong. They've literally got 4 times the capacity than they currently satisfy. And they sold 27,000 bikes in their very first year in business. So it's a really strong supply chain, but obviously we're going to go about this in a way that makes sure that it puts the customer first. We don't want people waiting 3 months for a bike. We want people to get their bike in a couple of weeks, 3 weeks on the outside. But that means that we're going to have to manage our marketing at the same time. That the good news is we've got 86 programs on Beachbody On Demand. We've got over 4,000 workouts on the OpenFit platform. We have every modality of fitness that we stream into households and on every connected device of our 2.6 million subscribers. We streamed 180 million workouts last year alone. So our job is going to be to keep people engaged, give them all the options that they want, and then also include a great piece of equipment that's connected to great content.
Kevin, switching gears just a little bit, I want to get your thoughts on the TikTok news that we got out this morning. TikTok's deal with Oracle on hold, Biden administration looking into this. First, just your thoughts on this. Did you see it coming? And then 2, what do you think the Biden administration should focus on as they look into this?
Yeah, look, I read the same headlines that you read. I don't know how accurate it is. Clearly it's not at the top of the agenda for the Biden administration. It probably shouldn't be. I'm not sure it should have been at the top of the agenda for the Trump administration. So I'm not sure what to make of the news. I do know what I think is the right way to go. And I don't think forcing a sale of a company is the right thing to do. I think that was a mistake. I do think that forcing or asking the social media companies, and it's not just TikTok, it's all of them, to be more transparent with their moderation policies, more transparent with how their algorithm works. So algorithms are very powerful. That's what consumers see. And those algorithms control the streams that people engage with. So transparency and accountability and security for data. So I think that's what the government should focus on, making sure that TikTok maybe leads the way in those three areas, frankly. And I wrote a blog in July when I was CEO of TikTok outlining that, and I still believe that's the right way to go.
Kevin, real quick, because you do know media so well, you were there with the acquisition of 21st Century over at Disney.
Yeah.
When you look at Fox and what they're going on, you think they're for sale? Fox News, would they be an attractive property to a Jeff Bezos or somebody?
I'm not sure Jeff Bezos would buy Fox News. That's probably not the politics that he shares. Look, I think that they are a standalone company. I have a lot of respect for Fox. I did, I led that transaction for Disney, like the other transactions I led. And I have no idea what their plans are. I think they're a good, profitable business, positioned pretty well in the market. You probably should ask the Fox guys what they think of that.
Kevin Mayer, always great to speak with you. And Carl Deichler, thank you so much for joining the show. Congratulations to you both again, and thanks for making the time to join us. And of course, our thanks to Brian Sazi as well. Coming up, we're going to take a quick break, but we'll be right back in 2 minutes.
So we were just talking about the TikTok sale that's been put on hold, Oracle and Walmart that's been shelved. Our editor-in-chief, Andy Serwer, has more on this situation and the politics perhaps behind it. Andy?
Yeah, Adam, I mean, this sale was actually something that many observers thought was a farcical sort of process. If you remember back during the last several months of the Trump administration, there are real issues when it comes to TikTok and questions about how it guarantees the security and safety of U.S. users and prohibits the Chinese government from accessing that data. But the solution, which the Trump administration and presumably Donald Trump himself had a hand in this, crafted, was to sell the U.S. operations to a consortium headed by Walmart and Oracle. And Walmart would benefit from the database of young users in the United States, and Oracle would safeguard the security, being, of course, one of the world's largest database companies. But left out of that equation, of course, was this larger overhang of Donald Trump's war with China on the trade side, and of course, a close personal relationship between him and Larry Ellison. And so all this sort of called into question that deal. And now the Biden administration is saying, as of today, that this deal is off because the Biden administration wants to study it within the larger context of the U.S.-China relationship, not to say that they don't have concerns, again, about TikTok and access to the data of U.S. users. But that particular transaction is on hold at the very least.
Hey, Andy, just real quick, any idea just on timing of this, like how long this could potentially take? And then when we talk about a potential deal, is it likely that it's going to look different than what it initially looked like a couple months ago?
Yeah, good questions. I mean, first of all, Shauna, Jen Psaki from the White House said there is no timetable. And also, remember a funny part about this was, well, funny, haha, was that Donald Trump even suggested that the U.S. government was due what he termed key money for the sale. So a lot of crazy things going on here. It's not clear that there will be any kind of sale at all, though. In fact, the administration has signaled that there would be some oversight here in the United States over those U.S. users and their data. But it might not be the case that company would be asked to sell this operation at all. You just heard Kevin Mayer saying, who used to run that company, that forced sales are really not a great business policy for a country to have. In fact, we criticize China for doing that same thing. So it's kind of ironic that we were looking to do that. It is also the possibility, though, or the case, I should say, that this deal could go through with Oracle or Walmart, but I suspect that it probably won't. Certainly not along the same lines that we saw initially, Shauna.
Andy Serwer, we appreciate you being here. Andy is our editor-in-chief, and when we come back, we've got the closing bell for you. We're coming up on that closing bell. We want to bring into the stream Bill Baruch. He is Blue Line Futures president. Also, Charles Lieberman. Chuck, it's good to have you here. He is the CIO at Advisors Capital Management. Before we get their thoughts on where this market is headed, we want to go to Jared Blickery, who's launching the action on Wall Street for us. Jared?
Well, let's see where we have been today. It's been an eventful day, actually. So this is a mixed picture right now. Only the Dow just barely in the green, up 14 basis points, but hadn't seen much action before that, except for this little hiccup we had around 10:30. In fact, it was I'd call it a medium-sized hiccup, but we did recover from that. No particular news, though, so kind of noting that for the future, might be getting a little bit of liquid at these levels, but nevertheless, we do have dealers, options dealers, long gamma, that tends to suppress index level volatility. So just something to mention and follow going forward. Now, the mega caps sunk into the red. Some of them have recovered. Alphabet and Facebook here, those are both in the green, up over 0.5%. But Microsoft, Apple, and Amazon in the red, nothing off more than 1%. But guess what is off? That's Tesla, minus 5%. Haven't seen one of those days in a while. Let's just take a look at the trailing month, because we are now back by these lows we had a couple weeks ago. And let's take, in fact, a longer term look. Here's 3 months. And something's going to be clear that, well, maybe it's not clear from that particular chart, but we have broken down through a trend line that you could make through these levels here. So something to monitor going forward as well with Tesla. Also looking in the EV space, we are seeing Apple down. We already covered that, about 6%. Toyota Motors, now that is up 5%. That is a company that is bringing 3 new EV models to the market. So we will take a look at that when they finally come out. Finally, a look at the cannabis space before we head into the bell. Lots of green there. Tilray up 50% today alone, guys. Here's a bell.
And that does it for the trading day today. As we shake out the final trades of the session, it looks like we're going to end the day mixed. We have the Dow holding on to gains, up just 62 points, so not too far from the flat line. The Dow was off just around 150 points earlier today, so a bit of a reversal here in the last couple hours of trading. S&P and Nasdaq, though, ending the day in the red. S&P just barely, Nasdaq off around 0.2%. A couple of laggards in today's market. Jared mentioned some of the selling action that we're seeing in some of those big cap tech names, Apple and Microsoft there among the bigger names in the red today. Amazon also closing in negative territory. Taking a look at the sector action today, consumer discretionary, industrials, and technology. No surprise there after we just talked about some of those big names in the red. Those 3 sectors are the laggards: energy, communication services, and real estate, on the other hand, leading today's action. We want to bring back in Bill Baruch. He's a Blue Line Futures president there, and Chuck Lieberman, a chief investment officer at Advisors Capital Management. Bill, first to you, just your reaction to today's movement here and the fact that we did see an initial dip with the Dow off 150 points, but we were able to regain some of that momentum into the close.
Yeah, we've seen a big bounce back the last 6 days, 7, 8 days almost now, from that low a couple weeks ago. And I think that overall, there's a little exhaustion after such a directional move. In fact, we were trimming some names on the advisor side where we're managing portfolios yesterday, and just looking at, I mean, across the board, everything from Apple to Chewy and Twitter ahead of earnings, just trimming a little bit up after some of this. And yeah, I mean, stocks still can go higher. Look at Twitter today, but it's just risk management. And then one of the things I think too was CPI came out. It was a miss. It was lower than expected, and that really helped the market right away just rip higher. And when you see something like that, it almost you think, oh, I want to buy. The only way to be is get long. And those are the days you really want to be worried about. And what, lo and behold, we reversed off of that. And that I think is a sign of some exhaustion just here in the near term.
Charles, there's a lot of analysts, a lot of people who say that second quarter of this year, we will be off to the races as the economy really takes off. And you point out to people that you might want to look at, if you're going to pick some stocks, to look within different sectors like financials. And you like Citi. Why Citi? I don't know if Charles can hear us. Do we have a tech? All right, let me throw that one then to Bill. Let me see if we can get Charles' audio fixed. But Bill, if you heard me, some people are saying financials are something to look at, especially as the economy takes off in the second half of the year. What do you think of that call?
I like the call, but this is something that we've sort of looked at. We've been ahead of the curve on at our sister company as an investment advisor, Blue Line Capital. I've expected yields to rise. 10-year Treasury, which I trade on the future side, and I've been all over. I in October was saying this thing is going to go up to 1.25%. And one of the ways you play on the equity side is getting long financials. JP Morgan was really one of the back benchmarks of what we used. Bank of America, and then KRE was a good broad way to get some exposure into the regional banks, and they've performed tremendous. I'm looking through here, trimming names now. When I look at allocating, I'm looking at what sector is going to perform the most, and And I think, the financials and industrials, we've been all over the past quarter and a half. I'm looking at who's going to be the next leader here. And I think that's because we've already rallied so much. I want to trim some back. And then now we're really trying to figure out where we want to be next. Where do we want to get overweight next? And I'm not sure, but I think it's a time to trim a little bit rather than being aggressive at these levels.
Hey, Bill, when you're trying to figure out where exactly you're going to put your money at next, what are you looking for? What are some of the key metrics that you're using right now?
Well, I'm looking at commodities broadly, and I mean, crude oil, copper, platinum, all three of them have just roared higher here. And I think so. Materials, real hard assets, energy is a great place. I just would like to see a lot of things at better levels. What worries me, though, and that's sort of playing devil's advocate with this path of least resistance higher, is, I mean, energy, it's recovered. It's been a big leader here recently, but we're getting right back to the damage that started last February. So technically speaking, we could see a little exhaustion, a little fallback there. The financials, I think, can continue to lead a bit if the rate story stays higher, which I do think that there could be a little bit of a pain move in the 10-year Treasury. If it gets above 1.25%, it could quickly go to 1.5%. And the banks would be about one of the only sectors that really, really like it. So I think here right now, again, it's sort of where just trimming back a little bit and looking at the broader macro backdrop. And, things haven't changed. Fed Chair Powell today, the unemployment's still below the curve. Above the curve, they're at 10%. More monetary stimulus is needed or fiscal stimulus needed. I mean, it's pretty dovish overall. So that's why we saw the market middle part of the day or towards the end of the day come back a bit from the lows. I don't like forcing things at these levels, but there's definitely good individual names throughout there that should continue to perform.
There are also some different ways to protect your assets. A lot of people look at gold, and I'm curious what you think about what's going on with gold, silver, and platinum. But with the dollar weakening, I overheard a discussion where people were talking about the way to protect your wealth, or I don't know if you have 45 grand to buy a Bitcoin, but you can buy the fractions of it. What do you think of the people who are doing that as opposed to the traditional stores of value like gold?
Well, I think it's a great way to diversify. And when you look at a portfolio, you have the traditional moderate benchmark of a 60-40, and you're long 60% equities and 40% in bonds. And that's a traditional backdrop, but I mean, there's not a whole lot of interest rates. Not a whole lot of yield in those bonds right now. So you can look at some short-term duration corporate bonds, get somewhere between 2% and 3%. But you got to couple that with maybe emerging market bonds, and then you get some good yields in midstream energy, real assets, and looking at gold and having miners in case the inflation does really pick up. And Bitcoin would fit within there, and sort of the hard asset outside the traditional equity box. And it makes sense to put anywhere between 2% and 5% in there, just depending on when you may need your money. If you're closer to retirement, if you're talking about it from a portfolio basis, if you're closer to retirement, then you're not. You want to be more safe with your investments, and you lean on 2% or maybe a little less on Bitcoin. But I think there's a lot of ways that if inflation is playing out to look at things, and the hard assets, like I mentioned, platinum, copper, and crude oil, and things tied to the energy space, I think are going to perform through this year and into next year. I honestly think crude oil, we could see $100 in the cards for crude oil. And I mean, it's been years since this market crude oil has actually weighed on the stock market because of price levels. So that could be something we see the turn of next year if it breaks out of this big downtrend.
All right, Bill, stand by. We want to get to some breaking news. Uber is out with its earnings report. Emily McCormick has those details for us. Emily?
Shauna, we are taking a look here at Uber's results coming in better than expected on the bottom line, at least. We saw that adjusted EBITDA loss total $454 million. It's better than the $509.9 million loss that had been expected. And Uber also saying that it remains well on track to achieve its 2021 profit goals. And remember that Uber has previously said that it expects to turn a quarterly profit on an adjusted EBITDA basis by the fourth quarter of 2021. So similar from what we've heard from peer ride-hailing giant Lyft earlier this week. Now, taking a look here on the revenue side, we did see that top line missing expectations, that coming in at $3.17 billion and a bit light compared to the $3.22 billion that had been expected. And those gross bookings also a bit light at $17.15 billion versus the $17.36 billion that had been anticipated. Now, I do want to call attention to delivery gross bookings because those were up 130% in the fourth quarter. This is the third consecutive quarter that we've seen Uber's gross bookings more than double on a year-over-year basis. So that really is continuing to be the growth driver here for this company, as it is still seeing pressure on the mobility side here. Taking a look at the stock action, we are seeing shares of Uber under a bit of pressure. Again, a miss on the top line, and those shares are down by about 2.5% in late trading. Shauna and Adam.
Emily, thank you. Bill, I don't want to put you on the spot, and I'm not sure if you can talk about a specific stock, but if you can, what do you think of what's going on with Uber? And what caught my eye, and they made it their headline, is that quarter over quarter growth grew 13%, but year over year, the pandemic obviously down 16%. But it seems like they I don't want to say right the ship, but on the right course.
I agree that they sound to be on the right course. The stock has performed pretty well here of late. I mean, what stock hasn't performed pretty well of late too. So that's also the question. That's really why I started the conversation with saying I was trimming names yesterday and sort of playing devil's advocate to the fact that this has been a tremendous 6-7 day bounce back. But the path of least resistance broadly remains higher. Uber. I like the stock longer term. I mean, but I do think at these levels it's getting a little overdone. Again, there's like little questions about you mentioned the year-over-year growth and where we're going to be in the pandemic. So that does overshadow some of the good performance that we've had here recently in the stock.
All right, Bill, we've got some more breaking news. We need to get to Jared Blickery, who has Zillow earnings for us. Jared.
That's right. And we're seeing the stock pop about 2% in after-hours trading. And that comes after it made a beat on adjusted earnings before interest, tax, depreciation, and amortization, also known as EBITDA. That came in at $170 million, beating expectations of $125 million. And adjusted EBITDA increased from $3.2 million loss a year earlier. Also announcing, and I think this is pretty key to the pop here we're getting in the stock, is that they've agreed to pay $500 million to acquire ShowingTime.com. And this is a company that makes tools for house hunters to arrange home tours with agents. And just a quote here from the CEO, Rich Barton, from the earnings announcement: Zillow's strong results reflect exemplary execution and continued growth during the scary roller coaster ride that was 2020. And let's just take a look at the charts here, because the stock is now up almost 4%. And over the last year, this has been a stock that has been on fire. Here's year to date. So this is up 26%. And over the last year, you can see up 240%. A lot of these stocks, including Zillow Group, at record highs, as we have a situation with huge demand for housing and historically low mortgage rates, guys.
Thanks, Jared. Bill, just to get take a step back and take a look at earnings and what we've seen come out over the last couple of weeks, the stock reaction specifically to names that just meet expectations. In some cases, they'll beat them by a small margin, yet stocks selling off. We talked about that with Akamai's CEO earlier today. What are your thoughts on that? And I guess, what's your view just in terms of the numbers that we've gotten out from companies so far over the last couple of weeks?
I mean, the reports have overall been good, and the market has performed higher. I mean, that's really what we've seen. But it's I think the expectations have been overall low, and what this could cause is some higher expectations as we move through the pandemic. Vaccine rollout continues to support a more optimistic narrative 6 months, 12 months out, and the Fed still remains accommodative. So I mean, the real question for me in looking back at yesterday was in starting to trim names that have just really outperformed overall, even outperformed a great market, is ahead of Fed Chair Powell today, and ahead of or after a 6-7 day rally is looking ahead and saying what is going to slow this market down. And the CPI data today was something that potentially could have been a hurdle, but in hindsight, maybe it is a little bit of a tailwind, and coupled with Fed Chair Powell's accommodative narrative. So I think the earnings have overall been good, but from beating a low bar, and that just makes you wonder: are that bar going to be raised down the road?
All right. Bill Baruch is Blue Line Futures president. We appreciate you joining us here on Yahoo Finance Live for the closing bell. Coming up, We got Anthony Scaramucci. He's going to join us with his reaction to day 2 of Trump's trial in the Senate. And also, we're going to talk about how this is impacting the political landscape going forward. And of course, he's big on Bitcoin. Got to ask him about that.
Uber shares are off just around 3% here after hours. We just got the report from Uber. They missed on fourth quarter revenue, Their Eats business, though, continuing to be a standout for the company with growth of nearly 130% from a year ago. We want to talk about this a little bit more with Yigal Aruni, and he's of Wedbush there, an analyst. Yigal, what stands out to you in this report? We're seeing better than expected numbers from their Eats business. The ride business still under a little bit of pressure. Stock here off just around 2%.
Yeah, I think the thing that stands out the most is I think following along what we saw from Lyft last night is the better EBITDA, and Uber didn't really change anything around their language on path to profitability like Lyft did yesterday, but continuing to kind of move along that line of getting to profitability by the end of the year overall, and reaching there with lower demand than was originally projected. The Eats business is on fire, and that's really important. That's carried them through the pandemic. That's been a really important piece for them as well.
So what will the analysts on the earnings call, what is the metric that's going to be the key metric? Is it going to be all about the delivery business, or is it going to be about gross bookings in the traditional core business?
I think it's going to be both. So, people aren't really surprised at the fact that, rides have been challenged. It's why you saw Lyft stock perform so well today, even though their revenue guide missed, their revenue numbers missed. The pandemic has gotten worse, and the demand for mobility has gone down. So, analysts are going to want to try to understand the trend coming out over the next couple of months, what they're seeing in specific cities, maybe cities where the pandemic hasn't had as much of an impact or it's gotten better. Also importantly, people are going to want to understand what's going to happen as we lap the strong growth from the Eats side and the delivery business. Uber's doing a lot there. It's turning into a lot more than just a restaurant food delivery. They're going into groceries. They just acquired Drizzly, which is an alcohol delivery service. So they're really turning that into a a last mile delivery platform well beyond restaurants. That's a big opportunity for them long term. But as people kind of come out of their homes and the weather warms up and people want to go out to eat a little bit more in the back half of the year, or even really starting in 2Q, what those numbers are going to look like is going to be of interest as well. And then of course the profitability, which is top of mind for everybody.
Yigal, I wanted to ask you a little bit more about that profitability. In their release, they say that they remain on track, well on track was the exact words, to achieve 2021 profit goals. Did this come to you as a surprise, or is this something that you were expecting to hear from Uber today?
Oh, it's actually not a surprise at all. This is, the pandemic was obviously a challenge for Uber on the rideshare business, and really overall, even though it supported Uber Eats so much. But what we saw from Uber and Lyft over the course of the pandemic is they both took the opportunity to right size the ship. They took out a lot of costs from the business, and even though they've been challenged in at least certain pockets, they're going to come out of this much better positioned. With a lower cost profile, taking a lot of those expenses, the unnecessary expenses, and the fat out of the business, and that's really going to let them leverage the growth to profitability in a much stronger way than they would have been able to without the pandemic hitting and kind of right sizing.
I'm trying to find that number for Uber. I know the Lyft number. They talked about eliminating $360 million in fixed costs in their report. Let me switch to this. Given the fact that delivery is so key to them at this point, is there room for another acquisition to grow that side of this?
It's possible. I mean, we've seen a couple of things, and I think they're much better positioned here than we were a year ago or a year and a half ago, where the delivery business was just so cutthroat. They acquired Postmates. There's been some rationalization within the restaurant delivery side. They acquired Corner Shop, which is a Latin American company, and they're building that out in the U.S. as well to deliver groceries. And now they have alcohol delivery. There are likely other pockets where they can kind of continue to tack on, but now they have really important pieces to a lot of last mile delivery options. They've also launched some things internally, like delivering essentials from pharmacies and partnerships with CVS and Walgreens. They've done a lot to move Eats from just restaurant to last mile as a whole.
Yigal Arounian of Wedbush, thanks so much for joining us today. Again, Uber shares off just around 2.5% after hours. We're going to take a quick break, but when we come back, from a one-person startup to a business with over 200 employees in 2 continents, how Farm Girl Flowers is taking it to the FDS, and also 1-800-Flowers of the world, really taking on the competitors. That's the easier way to put that. We're back in 2 minutes.
What would life be without videos of cats riding Roombas? Let's get iRobot earnings. Let's go to Jared Blickery for that.
Adam, I don't want to live in that world. So let's get straight to the results. We got the stock popping about 10%, 15% in after hours trading. You can see it right there, currently at 9.9%. But let's go through the numbers here because we got some nice beats. Adjusted EPS for the fourth quarter came in at 84 cents, quite a bit higher than the estimate of 20 cents. Average gross selling price, $327. That's up almost 2% year over year. And I just checked out their website. Hadn't seen one of these guys in a while or hadn't been in the market. They have one with an $800 price point. So definitely adding the features, but getting more expensive. Revenue coming in at $545 million. That's up 28%, handily beating estimates of $484.6 million. And then their forecasts are saying 2021 adjusted EPS at $3 to $3.25, vastly beating estimates of $2.19. And on the revenue front, full year guidance coming in at $1.635 billion to $1.675 billion, much higher than the estimate of $1.47 billion. Finally, some commentary from the earnings report. As we continue to execute on our plans, we are excited about our prospects to sustain solid top-line growth into 2022 and convert that expansion into 2022 profit margins and EPS that exceed 2020 levels. Now let's take a look at this chart here. This is a stock that got caught up in the whole GameStop Reddit episode just a few weeks ago. And I think as a lot of these smaller, heavily shorted companies come out with their earnings, we're going to see a lot more pops like this, a lot of prime candidates for some more Wall Street bets, guys.
Let's turn to a bet that some people passed on 10 years ago and now probably regret. It's a $64 million business when some said it was unfundable. Let's bring in the founder and CEO of Farm Girl Flowers. Congratulations on 10 years and saying to all those naysayers, you got it wrong. Okay, Valentine's Day is Sunday, but today you've managed to actually survive through the pandemic, but you had to shut down your headquarters. Tell us about that.
Yeah, thanks for having me, Adam. Yeah, it was a rough year for us, like a lot of companies, and very happy we came out on the other side, but we did have to shut down our San Francisco location where 90% of all of our orders were made in a span of about 12 hours. And we really quick just ran as fast as we could and set up more distribution centers in time for Mother's Day, 4 of them in 5 weeks, actually, so we could meet the demand and have the supply for it. And my team just worked really, really hard. I'm really proud of them. And we were able to grow 100% year over year last year.
Hey, Christina, one of the things that have happened because of COVID, we've seen a jump in shipping delays. It's not only affected your business, it's affected a lot of the bigger retailers. I'm curious, one, what you've done about this and how you've been able to kind of weather the impact from that, because I would imagine it's probably had a serious impact on your business.
It's huge. Actually, it was just what I was dealing with 5 minutes ago before this interview. We are seeing huge delays. Some days it's over 50% of our orders that are not delivered on time by our shipping providers. And I think every company is being impacted by this. We heard about it a lot in fourth quarter. Valentine's Day is a huge time of year for us, and it's a huge gamble. I feel a little bit like every day I'm playing the roulette table because it's out of our control completely. We send the orders out on time, and then we hope that millions and millions, like tens of millions of dollars of orders are going to make it to the recipients in time. And when they're not, unlike most companies that are shipping like a sweater or something that's non-perishable, ours might die in shipment because they take extra days to get there. And so we have to reship at our cost because our shipping providers do not take any financial responsibility for it whatsoever because of COVID. And so, it can be a gamble of $12 million in a span of a week that we are taking a risk as a company. And so that's what keeps me up at night. It's the biggest thing out of our control that could jeopardize our ability to stay in business even.
We're glad you're staying in business, though, and I got to ask you because Valentine's Day is coming. Are roses really the way people go? It seems like the lazy man or woman's choice on Valentine's Day. What are the other choices there? But I got to imagine roses are the most popular.
Roses it's because people like you are ordering for Valentine's Day. Typically, over 80% of people that buy flowers are women buying for women throughout the rest of the year. But for Valentine's Day, that shifts to being over 90% of the consumers out there are men. And they have, experienced over 100 years of seeing images of red roses and being told you have to get red roses for them to show that you love them. And that's actually not what women want. Over 90% of the women that we polled did not want red roses. They want beautiful anemones or ranunculus or calla lilies or more delicate, intricate, less cliche flowers. And so what we do is we mix roses with other varieties. So that way we make the male sender happy and the recipient happy at the same time.
I love red roses, but I guess I'm a little cliche. As we wrap this up, I'm curious just to get your thoughts on leading a business during COVID. You talked about some of the challenges that your business faced, but just you personally as a leader over the last 11 months, how have you navigated that? And I guess what's the biggest lesson that you've learned during this tough time?
That's a great question. It's personally just been the most challenging year as well. I personally contracted COVID this summer, and while it was horrible, it did provide me a better perspective, I think, on not only how to keep my business going, but how to keep my team members safe while working. And so what I learned from that was that it's my responsibility to not only provide a paycheck, but to provide a safe place for them to work. And so we implemented twice a month testing, technology that even traces how close you are to other people in our facilities. We pay more than the 2-week government mandate on if people have COVID. As long as they're sick, we pay them while they're out. We've just implemented a lot of policies that are better for our team members at a huge cost for us. Over $100,000 a month we spend on these things to keep our team safe. And so I think being a leader during COVID has been challenging, but I hope what my team has seen from my leadership is that I care about them as people first, more than just the bottom line. And I'm very fortunate we're a bootstrapped company, so I don't have a board to report to, and I can make decisions on what's best for my company and not just what's best for the bottom line.
It's an inspiration. We're looking forward to when you can come back and join us when revenue is 128 million. But I got to let you know, too, I got to fess up. I was just looking up an image of a calla lily. I know the quote, the calla lilies are in bloom, Katharine Hepburn. I had no idea what the flower looked like. So thank you for the lesson here, and all the best to you, Christina Stempel, founder and CEO of Farm Girl Flowers. And happy Valentine's Day, by the way. When we come back, the Mooch is in the house. We got Scaramucci joining us to talk about a lot of things. We're talking about Bitcoin, but of course we're going to talk about his former pal, the former president, Donald Trump. Got some problems in the Senate right after this.
Day two of the impeachment trial, Democrats making their case that former President Donald Trump was responsible for that deadly January 6th riot at the Capitol. You're looking at live pictures there on your screen. For more on this, we want to bring in Anthony Scaramucci. He's a Skybridge Capital founder there, also former White House communications director. And of course, we have Yahoo Finance correspondent Julia LaRoche joining the conversation. Anthony, great to speak with you again. We have a lot to talk to you about, but first, let's just start with the impeachment. Let me just get your thoughts just on what we've heard over the past 2 days as the prosecution lays out its case against former President Trump.
It's a devastating case. It's very well thought out. The prosecution is doing a very good job of laying down the facts. And again, not just the speech that the president made on the 6th of January, but all of the additional action items that he did after the election. And, you know, not to throw out legal jargon, but it's important for people to understand that he is the but-for causation in that tragedy. Without him, you don't have the tragedy. Moreover, if he just abided to his oath to the Constitution and accepted the election, the free and fair, non-fraudulent election of Joe Biden, now President Biden, you would not have had that tragedy and you would not have had those 5 deaths. And so the president, the former president, is the proximate cause to that insurrection and to that violence. And additionally, he disavowed his oath to the Constitution by not accepting the free and fair election. So they have all the elements there, all the base evidentiary elements to convict him. But unfortunately, because this is a political trial more than it is one based on objective, clear-eyed assessment of fact, he is still got a good chance of being acquitted, although his defense counsel is doing a horrific job. And Senator McConnell left an opening this morning by suggesting that he has yet to decide how he's going to come down in terms of a verdict. So I think that's going to give a little bit of ceiling to some of these other Republicans, which would be good news. And so it's not over yet.
Well, certainly not over yet, but, you know, irrespective of the outcome here, Anthony, I would like to kind of hear your perspective, especially as someone who has worked not only on campaign or in the White House, but also kind of disavowed President Trump afterward. What do you think his legacy will be? And what do you think that impact might be on the future of the Republican Party and also just kind of the country in general? And we're talking about a lot of divide and how we can kind of bring folks back together.
Well, I think this will certainly be his legacy. This will even eclipse the 13 million jobs lost. It'll eclipse the malpractice of the pandemic. I'm not trying to make light of the 430,000 people that died, which are unbelievably tragic, but you can't blame every single death on President Trump, but you can blame this on him. He'll go down in history once people have a moment to reflect on this as a domestic terrorist, as an insurrectionist, and this will be a stain on him and his family forever. As it relates to the Republican Party, they have an opportunity here to save themselves and to rebuild, but the likely acquittal that will come will cause a further destruction of that party. But what I will say about the country, which is what I like, and the optimism, is very bad for the Republican Party, but quite good for the American people, because laying out this case, there are 75% of the American people know where things stand. The president has 80% approval in the Republican Party, but remember, the Republican Party is only 30% of the registrants. So it's sort of 76-24 right now. I would make the case to your viewers and listeners that Donald Trump is a great unifier. He just happens to be unifying all of us against him. And so that will be his legacy. It'll be one that will be on the infamous side of the ledger in American history and American politics.
Hey, Anthony, it's Adam. It's great to see you. About 2 weeks ago, a reporter at another network was trying to get you with a gotcha question for working with the Trump administration. And you said, I made a mistake. And I'm curious, because it was so perfectly handled the way you did it. Why can't the Republicans like a Josh Hawley or a Ted Cruz say, look, this is a mistake? What holds them back from doing that?
Well, you know, some of what holds them back is that judgment. Obviously, the reporter that you were referencing coming hard at me, I supported Donald Trump, so therefore there's a binary thing, even though
I took back my support and worked super hard campaign against him. And you'll remember, Adam, that I started that project about 2 years ago. So, for some people, it'll never be enough. And I understand that. But I think that's a resistance block. The other resistance block is these people love power more than they like their own principles or our Constitution. And so they've been told by their political consultants to stay the course. This is the right course. This is a way to get the base transferred over to you. The coward and traitor Josh Hawley and the coward and traitor Ted Cruz were told by the same political consultant, go up there and speak about this election and take seriously these fraudulent claims. And if you do that, you'll be in pole position to accept the baton of Trumpism. And of course, that backfired on these two cowards because it was a principleless and amoral decision that they were making. But that's where we are right now. These people, Adam, are more concerned about their positions of power and ruling than they are service and serving the public. And so the American people are on to them. And so the good news is that party, unless it reforms itself, it will split into two pieces and it will become a minority party for at least a generation.
Well, Anthony, I am going to shift topics and we're going to start talking about something else in your wheelhouse besides politics. And of course, is the managing partner of Skybridge, recently launching a Bitcoin fund. I want to hear how that went for you. Did it exceed your expectations? And what's sort of next for you as it relates to that?
Well, first of all, I'm very jealous of the palm trees in your background. So I just want to point that out.
I'm in Miami.
Getting out more snow here, but listen, I mean, I did a tremendous amount of work on that, Julia. You've been to our SALT conferences. We've had a whole series of people that have come to our conferences that are Bitcoiners. I started out as a Bitcoin skeptic. I want to confess to everybody that I'm not a Bitcoin evangelist, but I'm a Bitcoin investor. I've looked at the landscape and I recognize that there is a spot now for Bitcoin. And I'm trying to encourage my colleagues, I'm trying to encourage investors that have been with Skybridge for many, many years to think about it that way. And what I would say to money managers that are listening, you're going to be benchmarked off of Bitcoin, meaning in your mosaic of stocks and bonds and alternatives and gold, there'll be a few percentage points related to digital currency. And since Bitcoin is the winner of that battle, it'll likely be Bitcoin. And so if you're not going to be an investor in Bitcoin, you're effectively short Bitcoin for the purposes of that evaluation. And so we made a decision back in October. We put, as you know, several $100 million into Bitcoin across our product line. Now we have just under $500 million in Bitcoin. Our Bitcoin fund is heading towards $100 million. That's the Skybridge Bitcoin Fund. And that's a Bitcoin specific fund. And so, yes, we're very happy with the progress that we've made, but I want to remind everybody that this is a volatile asset. Some of what you're seeing this week is short squeeze, very akin to what happened to Tesla, where the non-believers in Tesla were squeezing out of their shorts. Same thing sort of happening here to Bitcoin. The coin is down probably 5% today. Expect volatility, invest in Bitcoin at the size and scale of money that you don't need in the short term. But I do think it has a very big future, and there's no reason why those coins couldn't trade into the $100+ million zone over the next 12 months.
$100+ million zone. So wait a second. Can we get an update
I meant
on
to say the $100,000 zone. I was mixing my metaphors. I meant to say it's an $800 billion total market cap. I was thinking that when I spoke, but I see it going up over $1 trillion, and it could easily trade $100,000 per coin.
And then following up on that, of course, we had the news of Tesla on Monday, the $1.5 billion bet on Bitcoin. Curious, just one, it sounds like you think it was a pretty smart move by Elon Musk, but then two, just the responsibility, I guess, for companies. Is it responsible for them to put Bitcoin on their balance sheets?
So I think the dilemma for those companies is fiat currency. They're watching the American government produce dollars at an alarming rate. We have 23.6 more dollars in production and in our money supply than we did 6 months ago. And if you really analyze the $1.9 trillion stimulus, it's very likely that we'll get another 17% more dollar production. So you'll be sitting here in a 12-month period of time, you'll have 40% more dollars or 40% more fiat currency. And so if you're looking at dollars in your bank account, you're like, okay, wait a minute, this may not be the store of value that I need from a corporate standing. And Bitcoin, which is an expanding monetary network, now fully robustly scaling pursuant to Metcalfe's law, you could be saying to yourself, okay, I'm losing value in dollars, but I'm not necessarily losing value in Bitcoin because of its scarcity. It's sort of tracking and it's sort of standardizing in terms of a store of value. So, Ross Stevens was speaking to Michael Saylor early in the week. He's the CEO of NYDIG, a personal friend of our firm's. He basically said, listen, your Hamptons real estate's going up in fiat currency, but Bitcoin is pacing it. And I think that's the dilemma for CFOs right now, is they're watching this dollar production, this proliferation of dollars. They're saying to themselves, okay, maybe I need to have some of this. It's very fungible. It trades in a liquid manner. It trades in a millisecond, and it is scaling. Over 100 million people are using Bitcoin today. Very likely that 1 billion people will be using it in 5 years. As everybody on this presentation knows, there's only 18 million coins, 21 million in total, 3 million of which have been lost, and there's a few million coins left to be mined. So it's a fairly scarce asset, and I think this is the reason why you're seeing such an upward pull on price.
When you just got to the question I wanted to ask you, there's only a few coin left to actually be mined, so that would make the $100,000 call much more within the next year, 2 years. What do you think?
Well, I think so. If you look at a stock to flow chart and you look at demand that is building, and you see Elon Musk as a leader in this space. Remember, he was buying the coin 6 weeks ago. His average cost is probably $33,000. It'll come as no surprise to you that the market intel out there is that there are many corporations that are thinking about adding Bitcoin to their balance sheets. And there are institutional investors like BlackRock. BlackRock has already signaled last month that they gave approval to purchase Bitcoin in some of their larger mutual funds and to purchase Bitcoin futures. So, you could be a Bitcoin realist. You don't have to be an evangelist to see that there's way more demand for Bitcoin than there is supply. Remember, Warren Buffett doesn't like it. He says that it's rat poison, but his very good friend Bill Miller, 20 years his junior at the age of 70, is saying, yeah, it may be rat poison, but the rat may actually be fiat currency. So you have to live, Adam, as we always do, in the world that we're given, not the world that we want to live in. You guys will remember that my performance was smashed last March, as a result of the pandemic. The Skybridge Series G fund is up 33% since April 1st. And some of that, frankly, has been the move in Bitcoin that we took advantage of in the fourth quarter of last year.
All right. Anthony Scaramucci, always great to speak with you. Thanks so much for taking the time. And of course, our thanks to Yahoo Finance correspondent Julia LaRoche. We're going to take a quick break, but when we come back, we'll talk remote learning with Stride. That's up just over 30% since the start of the year. We're back with that in just 2 minutes.
We could all learn a thing or two from the businesses and the people who are making a profit with the digital learning phenomenon. And one of those companies is Stride Learning. They reported not too long ago their fiscal second quarter earnings. And just to let you know what they've seen in over quarter growth year over year, revenue in fiscal second quarter was up quite a bit. It came in at roughly up 46% to $376.1 million. Let's let somebody who should brag about that join us and tell us a little bit more about digital learning. And that would be the CEO of Stride, James Rue. It's good to have you here. And we should point out that when we think of digital learning, a lot of people think K through 12, but you're much greater than just that. Tell us more about who you're targeting.
Yeah, that's right. We recently rebranded from K-12, being called K-12 as a company, to being called Stride. And part of that approach is because we believe that K through 12 only represents a portion of the market segment that I think we can really go after. It's a really important segment for us. It's our history and sort of how we were founded. But as we look forward, our strategy is really predicated on career learning. And as we know, career learning is largely today an adult market. Now, we believe also that the K through 12 market is ripe for more career learning. And we all know the stories about the escalating student debt and the student debt crisis, high dropout rates in our four-year colleges and universities, 6 years for most kids to graduate. And so, but we feel that our country really is at an inflection point where our kids really need to get employable skills, career-ready skills. And so we've really moved in that direction. Our high schools have career learning programs in them. They can get employable skills right out of high school. We have adult learning programs. We did a series of acquisitions over the past 15 months to bring on adult learning specifically targeted towards the most in-demand careers, technology and healthcare, obviously. Those are the ones that are most in demand. And so, so our strategy really is predicated on employability skills and really empowering students to get into the workforce at higher salary levels with your career trajectory.
Yeah, James, I want to ask you a little bit more about that. More so if we just take a step back and take a look at all the changes that have happened over the last 11 months. Has there been a structural shift, do you think, in this country just around how we view education? And then what do you think that's going to look like once we get to the other side of the pandemic?
Yeah, listen, I sure hope so. And I sure believe so. I think with anything, and we've seen this across numerous industries, where as consumers shift their behaviors increasingly from, I'll say, an analog world to a digital world, they rarely go back. And we're seeing that in education. We're seeing that in K through 12 education. We're seeing that in higher education. We're seeing that in adult learning. And so I really don't see, once people start shifting towards the digital environment, that they want to shift back into a wholly analog environment. Now, education probably is a little bit different in the sense that for certain age groups and certain learners, it is probably more appropriate for them to be in a physical brick and mortar environment. But we also know that over 80% of the school districts, those same brick and mortar school districts, they need to have, and they are planning to have, online learning options for the foreseeable future. Because when you say, when we get onto the other side of this, I'm not really sure what this is that we're getting onto the other side of. Like, we already know that the current most prevalent strain of COVID-19 has morphed into new strains. So once
you get the majority of the population vaccinated, that will be on the other side of it.
Well, we don't know yet how those vaccines will adapt and for how long they will adapt to the different strains. So I just, and listen, I'm not a doctor. So what I know is that our education model, I think, will survive and will thrive irrespective of what happens, I think, with this pandemic, because what we see this through our demand. We see this through the call center activity that we have, the website traffic activity that we have. That demand, I think, has permanently shifted towards digital education.
And we appreciate your being here. James Rue, the CEO of Stride, all the best to you. We'll be right back.
Welcome back to Yahoo Finance Live. As we turn our focus to tomorrow, a couple of things that we are closely watching. Adam, what's on your radar?
Always got to pay attention to the initial claims for unemployment. We've been keeping an eye on what's going on in Congress with Jessica Smith on the $1.9 trillion stimulus deal and COVID relief package. And the numbers tomorrow could add, some evidence for those who are pushing for the bigger bill. It could also add evidence for those who are saying we need to do a smaller, perhaps targeted kind of bill. Shauna?
I'll be taking a look at Disney earnings. We're going to get them after the bell tomorrow. A lot of that focus is going to be on the Disney Plus numbers. They had 86.8 million paid subscribers as of the beginning of December. There's some estimates out there that maybe Disney could get above that 100 million. So that, of course, will be something to watch here. And Disney, at its investor day earlier at the end of last year, I should say, laid out a lot of ambitious plans that I think analysts will be closely watching and want to hear more about tomorrow during the earnings call. That also included plans to raise their subscription based here in the U.S. to $7.99. That's up by $1. They're planning to do that in March. So analysts, of course, looking for some more color on that. Also coming up tomorrow, we're going to be talking to Leon Panetta. He's the former Secretary of Defense. He's going to be joining us at 3 p.m. tomorrow afternoon. You won't want to miss that. And tomorrow at 9 a.m., starting the day off, you're going to want to tune in. We have Julie, Miles, and Brian. They're going to be taking a look inside the C-suite. They're going to be joined by Patrick Spence. He's of Sonos, Hugh Johnston of PepsiCo, a bunch of other names there on the screen that they will be talking to. That all kicks off at 9 a.m. tomorrow. Have a good night.